Twitter and stock tweets. I know I post charts daily. Sometimes I get critiqued on them, and I talk backwards and forwards with traders. And if anyone asks me any questions, or if I have any questions for myself, I talk to other traders. I find that's a great tool as well. Being able to talk to other traders on social media these days is priceless.
No doubt. No, I completely agree with that. So you're very technical in your approach. You know, like I said, 95% of what you do is based on technicals. What are you actually looking for on a chart? I know you've kind of mentioned 52-week highs and lows and that sort of thing. Is there anything else? I noticed that you use trend lines to some extent. Can you tell us a little bit about that and maybe some of the other things you're actually looking for on a chart?
Basically, on the charts, keep it very simple. I'm looking for smooth charts. I look over a year or 2 years daily chart, and I really just want to see a smoothish line where it's higher in the right hand side than it is on the left hand side. And I don't want to see any major whipsaws. And if you look at some of the charts I've posted, they are just slowly creeping up. It's not very exciting. It takes time for these trades to sort of cross the threshold where they actually start making money. But I find real trading's not exciting. This isn't the Wolf of Wall Street or anything like that. You know, they're just in the background. It's not my primary day job. And I'm in a position where I can, like as they say, cut your losses and let your winners run.
Okay, so I just want to ask you a couple of questions about actually using trend lines. Just so I do have this right, trend lines are something you use. Is that correct?
Yeah. I use trend lines, but I mean it's more lip service. I don't buy or sell when they bounce off a trend line channel. They're on there purely for lip service, just so I can see that it's in a channel. But regarding entry or exit, I don't really use them. They're on my chart, but as I said, they're more for lip service really, and just for me to be mindful of them. But yeah, I don't do or die by trend lines.
Okay. No, that makes sense. So they're more there just as sort of a loose guide, essentially.
Yeah, it's precisely, Aaron, just a loose guide. They're on there, I'm looking at them, I'm aware of them, but do they actually really do much with my trading? Probably not, because I mean, when I run the scan, all the stocks that hit the scan to the long or short side, they're all hitting the parameters, so they're all essentially possible trade ideas, and then I go in and I filter the scan to look for the smooth charts that I like, and also as I said before, look for the same stocks that have appeared previously on the scans, and then I'll decide about opening the position or not.
Okay, so let's talk about how you actually do open the position, because I got a feeling that you open your position just on the market open the following day. Is that how you approach that?
Yeah, that's correct. So for example, tonight I've run the scans. I've seen some stocks I like. I'm not too sure if I'm going to open positions tomorrow, but hypothetically, if I was to open trades tomorrow, first of all, I have to worry about my trade size. I risk between 2 and 4% per trade. So I have to look at where my stops, because as you said, I open at the market open, so I don't even know where I'm going to get in. But because I'm a trend trader, and as I'm sure most trend traders will tell you, because you hold for such a long time, entry isn't that very important, really. I just click the button, and wherever I'm in. Because I'm not day trading, and I hold for weeks and months, if I get in and the market's, I've lost a couple of cents here or there, it's not the end of the world. So basically, yeah, the night before, I look at where where the stop needs to be placed, because I know where I'm going to get out before I even get in. So I know where the stop's going to be placed. I calculate where from the previous night's close to where the stop's going to be placed, how much I can, what my trade size is going to be. I note all that down. The following day at the market open, 2:30 UK time, I just open the trade with the trade size, add the stop, and it's off and running. Very simple.
Okay, so I know everyone does this slightly different. How do you decide on your risk and position size for each trade? You mentioned there 2 to 4%. How do you decide what trades you're going to risk 2%, what trades you're going to risk 4%? Just walk us through that a little more. I think that'd be really interesting.
Well, yeah. So, I mean, it goes back to looking at the charts. You know, if some of the charts I've looked at previously are a bit whipsawy, I might risk slightly less. But if it's a nice smooth chart, like obviously bottom left-hand corner, and it ends up in the top right-hand corner over the last year or so, roughly, then I'll risk a little bit more because I like smooth trends. You know, it's a very softly. Trading, in my experience, isn't a get-rich-quick scheme. So I'm looking for soft, smooth moves, no stress. I don't have any stress in the market now. And then I calculate where the stop is from the previous and where my stop's going to be from and where the previous close was, and I can calculate how much I can actually trade on that trade for i.e. 2 or 4%. So I know my trade size, and then as I said, the following day open the position, and that's pretty much my part apart from moving the stops.
Okay, got it. So let's discuss how you balance long and short positions. Is this something you give any consideration to, like not to be too heavily weighted on longs versus shorts, or?
Yeah, no. I think about this a lot because another reason why I used to trade long only. The thought of shorting a stock was just my brain couldn't program that right. But I soon got rid of that, and I'm happy to long or short a stock. And over the course of the whole portfolio, I do try to be evenly weighted because I want to be hedged against general market conditions. Because in the past, I've had days where my longs have been absolutely shredded, but I've been paid off on the shorts and vice versa. So I do try to weigh it up. But if the scans are giving me more long trade candidates and shorts, then I have to do what my system's telling me. So I may lean towards being more slightly net long than short, but then that also happens on the reverse side sometimes. But I do try and even it up as much as I can at all times.
Yeah. Okay. No, that's really interesting. And what about like a maximum number of trades that you have on at any one time? Is that something you also give some thought to?
Yeah, I mean, I do because the more positions you have, the more sort of maintenance it takes, and it takes time and stuff like that. So, and I don't want to be doing too much of that because I like it very mechanical. So, I like maybe 8 positions at the max. But in the past, I mean, I've had 20 positions, and it was absolutely crazy. I just felt like I couldn't. It was taking a lot of time to move the stops and checking the prices each day. So, but I used to basically try to trade like a one-man hedge fund, and I essentially still do to this day. But I try and have a concentrated portfolio, maybe of 8 positions. If I can, as I said, equal weight, it's long and short. And also, I'll try and diversify through the portfolio as well. I don't want to have too much in one sector.
Okay, right. No, that's really interesting. And I guess the last part of it is how do you think about exits? What's your thought process around exiting trades? How do you determine where that point will be? And we're talking about profitable trades here.
Yeah, of course. Well, exactly. Do you know what? I literally just in line with the turtle trading guys. I use Donchin channels, and I follow certain Donchin channel timeframes. And every day when the market closes, I look if the stop needs to be raised, obviously for the long trades, or lowered for the short trades. And I literally get stopped out on every trade for a winner or a loss. And as I said, I've had lots of winners, lots of losers, and I don't worry about either way. I see a trade's close for a winner, pat myself on the back for 30 seconds, 5 seconds, and then I move on.
I like it. And just for anyone listening, if you don't know what Donchian channels are, they're essentially just the highest high or the lowest low over X number of days. And that's what I want to ask you about. Do you change the parameters of Donchian channels for each stock that you're trading, or do you have a generic time frame that you apply to each and every stock?
I literally trade exactly the same strategy for every single stock. So my long strategy is literally a mirror image to my short strategy. I literally could not trade any other way outside my strategy now. Otherwise, I'd start having sleepless nights. I wouldn't know where I've got in. I wouldn't know where to get out. So I'm very OCD like that. I've got a system, and as they say, if it ain't broke, don't fix it. And I've got a system, and I stick to it. It's all about the process.
Okay, so with the Donchian channels though, like the actual settings for the number of days highest high or
I've
lowest
found
low?
between the 20 days pretty good. I've looked at the 40, but yeah, between 20 and 40 days because I'm holding for weeks and months. I have to have a wider Donchian channel. If you're going to be trading like a swing trade, maybe you can use a 5 day or something like that. But yeah, I find the larger number day, the longer running day Donchian channels work for my system because I'm holding for weeks and months.
Okay, cool. Now, there's something I want to ask you about, and that's how you view your trades or your overall trading performance as like sort of from a portfolio level instead of actually being worried about how an individual trade performs. So could you tell us a little bit about how you view and how you think about that side of it?
Well, what you mean talk about in terms of growth? I mean, I run a lot. I run lots of positions. One closes, I open another, and I've said before, I have a lot of losers, small losers, and I have big winners. And I mean, I literally when I open a position, I do not know which ones are going to be the winners or which ones are going to be the losers. I just run the trades, I manage the risk, and over time, all going well, the portfolio grows. Basically, it's a very simple approach. I don't try and overcomplicate things. I don't get in my own way. I'm just looking. As long as I stick to the process, I know it's simple mathematics. If you have big winners and small losers over the long term, because it's all about longevity at the end of the day, you're still going to be in the game. Because if you haven't got any money, you can't trade. So as long as you've got money and in your account to trade, then you're still in the game, and that's what it's about for me. Because I want to be doing this till the day I die, which hopefully is a long way from now.
100%. No, I totally agree with you. One of the things which you kind of preach is that you must follow your rules, and that's very, very important. I think the thing that a lot of traders probably struggle with is that they doubt their rules and they don't know why they should trust their rules. So I guess what I want to ask you is, how did you validate your rules to have the confidence to be so disciplined in your trading? Where did that come from? Like, you obviously came up with this strategy. How did you know to trust that strategy and follow through with it, even when it's losing?
Well, I mean, essentially, I read about a lot of successful traders. I said Jesse Livermore, Nick Darvis, the Turtles, Richard Dennis. I mean, these people were successful people. So if you're going to follow people, learn from the successful ones. So I already knew that their approach was sound, and I just had to give it a go myself. And you have to be patient. That's what I find where a lot of new traders go wrong. They're too much in a rush because they think they're going to get the Lamborghini and the mansion in 6 months. And unfortunately, that's not always going to be the case. So I was very patient. I knew it was going to take time. And fortunately, because trading wasn't my day job, and obviously I won the money from the trading competition, earning the money wasn't exactly a major factor at the beginning. So I could sit back and sort of, put the chart time in and the screen time and stuff like that. So it was just, I found patience is the key, especially at the beginning.
Yeah. And that's a good spot to be, where you're not forced to be making money from your trading, because as we know, that can lead to many irrational decisions. So no, very good point. Now, last thing, just to take us out here, I'd love it if you could just expand on what you mean when you say don't get in your own way, because I've heard you say it a couple times throughout the interview, and I think it's a really valid point.
Well, what I mean when I say get in my own way, I was guilty in the past of getting in my own way. Like I've had stops in place, and the trade was about to hit the stop, and I'd get in my own way and change the process. I'd move the stop, I'd lower the stop or raise the stop if it was a short, and I'd start tinkering around with the trade because now I have a plan, I stick to it. I don't know how to trade outside that plan, but when I mean get in my own way, start tinkering around and have a plan, stick to it, have a process, and have the patience to ride that process to the good and the bad, because you're going to have some bad drawdowns and some bad times, especially with trend trading. You're going to have lots of losses while you're waiting for the big trades to come. So basically, just let your system be, keep it simple. Don't start tinkering with it every 30 seconds or every week because you've had a losing trade thinking something's gone wrong. Give it time to breathe. Give your trades time to move around. I buy a trade, I enter a long position sometimes, and they pull back a little bit before they go ahead. And people say to me, "Oh, why do you get in now? Why not wait for the breakout?" But I'm happy to get in the trade, ride the pullback, and then I'm already in for the next leg up, and I just let them do that. I don't get in my own way by waiting for this or waiting for that. I'm in the trade and I let it do its thing.
Good stuff. Good stuff. Brilliant answer, John. Do you want to share with listeners where they can go to find out more about you?
Yeah, so obviously I'm on Twitter. You can find me at @John Walsh _. Same as Stock Twits. I'm also known on Twitter on Stock Twits as the Black Cabbie Trader. And I'm just launched a website, blackcabbietrader.com. It's an educational website where I talk about trades. There's also a subscription side to that. My email address is john.walsh@blackcabbietrader.com. I'm happy to talk, answer any questions, and just generally chat trading. I can talk trading day and night, as I'm sure your listeners will tell. And please get in touch. I'm happy to chat.
Awesome. John, would you be open to answering questions that any listeners might have maybe in the comments section below this interview?
Absolutely, Aaron. That's a great idea. I never thought of that. Yeah, please, any questions anyone has via the comment section, please do, and I'll get back to you as soon as I can.
Good stuff. So chatwithtraders.com/ whatever number episode this is, scroll to the bottom of the page and leave a question in the comments area. John will get back to you on that. Obviously monitor that very closely myself as well. And one thing I just want to point out is that you've mentioned the turtles a couple times. Jerry Parker, who was one of the original turtles, has been on this podcast. He was on for episode 67. So if you want to check that out, it probably complements this episode nicely. So that's chatwithtraders.com/67. Awesome interview with Jerry. All right, John, well, it's been a blast to have you on. Thank you very much for doing this, man. Are there any final words, or are we good for now?
Yeah, no, we're good. As I said, thank you for having me on. I loved all the work you do. Keep up the good work, and I look forward to future episodes too. So good job on your part.
I appreciate it, man. Thank you very much, and let's stay in touch, eh?
No worries, take care.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey traders, what's up? What's going on? Thanks so much for listening in to the Chat with Traders podcast. For this episode, I had the great pleasure of speaking with Dan Azen, one of the co-founders of IEX and one of Forbes 30 Under 30 in finance in 2015. Dan got his start at RBC Bank, where he developed their flagship execution algorithm, Thor. This was also where he met and worked under Brad Katsuyama, one of the other co-founders and the CEO of IEX, who was heavily profiled in Michael Lewis's book, Flash Boys. As many of you may already know, IEX is an alternative trading system, an ATS, or more commonly referred to as a dark pool. However, IEX is currently in the midst of filing for exchange status. During our talk, I asked Dan more about the projects he worked on at RBC how IEX went from nothing more than an idea to an operating trading venue, and why they're on a quest to make markets fair. We also discuss the speed bumps which have been implemented at IEX, the mechanics of dark pools, and general chat about the broader market structure. Now, just before we go to the interview, I have a very special announcement that I'm excited to share with you. I recorded a second interview with Peter Brandt, a legendary trader of 45 years who originally appeared on episode 36. Now, this interview will not be released on the podcast as per normal. This is a special interview for subscribers only. Yes, it's still free, of course. So if you'd like to hear this, and I strongly encourage that you do, go to chatwithtraders.com/Peter, where you can download it for free. It's a full-length interview which runs for over 80 minutes, and it's loaded with a lot of wisdom, as you could imagine and expect from someone who has been a market speculator for such a great amount of time. Again, this will not be released on the podcast like usual, so go to chatwithtraders.com/Peter to download it for free. Okay, team, I really enjoyed this conversation, so I hope you will also. Dan does a really great job of explaining some fairly complex topics in a way that's easy to understand. So I'm your host, Aaron Fifield, and here is my interview with Dan Azen. Yeah, we'll just talk shop.
Cool. Sounds great.
All right, so Dan, welcome to the podcast, man. Thank you very much for coming on.
Thank you very much for having me.
No trouble at all. I'm thrilled to be speaking with you. I think I'm going to learn a lot from you, and I'm really interested about what you guys are doing there at IEX. So, I mean, first things first, let's start from the very beginning. What was your intro to financial markets? How did you get involved in this? Where did it all kick off for you?
Got it. Okay, so I guess it goes back to college. I started off college pre-med. Both my parents are doctors, so no background at all in finance in my family. I didn't really know what a bank was or what the industry did. And then in college, probably my second year, my third year, I had a couple friends who were leaning towards finance, and they got me involved. They kind of taught me about the different roles. And so my first actual experience in finance, I did an internship in school in wealth management, but really my first kind of getting my feet wet was my summer after junior year of college, which is kind of like the main year that you do an internship in finance in the U.S. I got a job at RBC, working in equity trading in New York under Brad Katsuyama. So basically, my first job, not knowing anything about the industry at all, happened to be working for this guy who I wound up kind of following my whole career so far. So just kind of very, very fortunate, lucky way that worked out. So I worked at RBC in trading, in equities, in New York. And my background in school, after I moved out off of pre-med, I went into, I started studying math and computer science. And they wanted someone with kind of sort of a programming background to help out with some quant kind of side projects that Brad wanted to do, some studies. And so I worked closely with also with Rob Park, who was kind of his main technical person on that team, who's now the CTO of IEX. And so I would just kind of help Rob out with whatever Brad wanted. So he would have us do studies around trading activity around the open, or he'd have an idea of something that he'd experienced as a trader, and he would just want us to study it or build a model around it, just try to kind of help inform what he was doing. And so I spent the whole summer working very closely with both of them, and that was my first intro into the stock market.
Right. Very cool. So I'm curious to know a little bit more about some of those studies. Like once you sort of performed those studies, what did you do with those? What did Brad have in mind to do with those studies? Were you building algorithms around those? Like, can you share a little bit more about that?
Sure. I mean, at this point, I didn't know anything about how trading worked. And Rob had a little bit of background in trading through his career to that point. But it wasn't like a formal part of the mandate of that team, of kind of Brad's team. Brad was in charge of all the manual traders at that time. So he had a team of probably 15 or 20 traders, and they were broken out by sector, and he was kind of the boss. And so, yeah, I mean, this was just one summer. So what were the projects we were working on? Yeah, again, I think it was just kind of like random side projects. He'd have an idea of, maybe he recognized that if there was a big imbalance leading into the open, that the stock tended to dislocate on the open and then come back right afterwards. And so he'd try to like have us look at data and see if we could develop a model for this. But again, it wasn't like a big part of that team. It wasn't like this was like we were going to put a lot of money behind this and start trading it. It was more just various like analyses that we were doing just to kind of learn more about how the markets were working and test out some of his theories. But it never really turned into anything super material. But it was a really great learning experience to kind of see the kind of data that we had available to us.
Okay, sure. No, I imagine it definitely would have been. So, no, that's very cool that you were able to land such a great job like that straight out of university. That's very cool.
Yeah, so I mean, that was actually while I was still in college. And then I came back to work for Brad and for Rob full time after I finished college, so after my last year. So during my last year of college, of university, Brad got this promotion to leave the manual trading side and move on to the electronic trading side. And so he had the mandate to basically kind of rebuild that whole platform from scratch. RBC at the time had an existing electronic trading platform. This is all kind of detailed in Flash Boys a little bit. But Brad took over that team and basically kind of rebuilt that platform. And so I was part of that starting team that took what we had and basically just re-engineered it all. And that's really when we got into it, because now, instead of it just being little side projects, it was the main product that team was responsible for was trading algorithms for buy-side trading firms to do their execution.
Okay, so let's talk about that a little bit more. I think what you're referring to there is what was called Thor. Am I right?
Yeah.
Okay.
Yeah, so that was kind of our flagship product. So when we started off, we had an existing suite of algorithms. They weren't very good. It was our job to rebuild them all and come up with kind of a new platform. And the very first thing that Brad had as focus was he pulled from his previous experience this notion this experience that he'd had where every time he saw 50,000 shares of Intel stock for sale and he clicked his button to buy all of those 50,000 shares, he would never actually buy 50,000 shares. He'd always wind up only getting 25,000 shares, and the rest of those shares that looked available disappeared. And he kind of, I guess this experience hadn't always been that way, but maybe in the last 2 or 3 years it had gotten worse and worse. And so he wanted to figure out what was going on there and build a tool so that wouldn't happen anymore, so that you could actually buy what you saw available. And so we didn't really know at the beginning when we started that process. We were just kind of researching, trying to figure out what was happening. Are those shares actually available? Like, who are those sellers saying that they're willing to sell? Based on our understanding of the market, it should have been possible to actually buy from all of the sellers in the market at a given time. But the tools that we had available certainly weren't doing that. And so we started just running these experiments, trying to understand what was happening that led to that outcome and see if we could come up with a way to fix it. And so that was like the very first project when I joined, was us running these experiments, testing out our theories. Our very first theories, right when we started this, was that there were high frequency traders, fast traders that were so fast that if NASDAQ had 10,000 shares for sale, and that 10,000 shares represented 100 individual orders of 100 shares each, that when we sent an order to NASDAQ to buy 10,000 shares, that there were traders so fast that they could see our first, trades as they were happening on the NASDAQ, and then react to those trades and cancel their orders that were kind of in the back of the queue, all at that single price level. And so we ran experiments where we would try this, and we would send all orders to just one exchange at a time, and then we'd send orders to 2 exchanges. And as we were running these experiments, we realized that definitely wasn't the case. If you sent one order to one exchange, you always interacted with all of the shares that exchange had available. So no one was fast enough to get out of the way once our order got there. And that's when we realized that it wasn't traders so fast they could react to our trades on that single market. It was traders reacting to our trades on other markets and then changing their order composition on the markets we hadn't arrived to yet. And that's how kind of Thor came about.
Right. Okay. So building this flagship Thor algorithm, did this get around that problem? Did it actually solve the issue that you're highlighting here? Yeah.
So basically, once we had kind of eliminated a few of our early theories and realized that what was happening is it was very fast traders reacting to orders that we had sent to, when we sent orders to multiple markets at the same time, our orders that arrived at the markets that were closest to us, the trades that happened from those orders created a signal that allowed those fast traders on the other side to cancel their orders on other markets. Once we realized that was happening, it was pretty quick to come up with the idea that if we kind of time our orders such that they all arrive at all the different markets at roughly the same time, there won't be enough time for anyone to get out of the way to react to earlier trades and get it out of the way for later trades. If they're all happening really close together, there will be no chance to react like that. So that was the idea of Thor. Once we built it, so it was a cool experience because we'd run experiment after experiment every single time. You're running the experiment and kind of liquidity is disappearing, or these quotes are disappearing and we're not able to trade with them. And then it was the very first test. One of the programmers coded up this algorithm that would just time it, and it was a very crude algorithm. Wasn't super precise at all, and it was just like the very first time we clicked button to send out orders to all the markets with doing this timing, and it just bought all the shares that were available, and we got every single share. It was just kind of crazy because we'd been testing this for a couple months at this point, and we never had that experience. And we'd run a lot of experiments, and none of them had gotten anywhere close to have it just go from not working at all to 100% working in just one step. It was pretty fun and pretty exciting. But once we had kind of built this test algorithm, it was only a couple more months to kind of productionize it, get it available to our customers, and that was like the main thing we sold for the next probably year was. We built up algorithms around this one concept, and it was quite successful.
Okay. Interesting. Now, I probably should have asked this a lot earlier, but what actually was RBC and who were these algorithms trading for? Were these algorithms that were executing client orders, or was it RBC's money you were trading? Can you add a little context around that?
Yeah, it's great. That's a great question. So at RBC, we were in the role of the broker. So these were... my initial job as an intern was on the manual trading desk, but again, trading on behalf of clients. And the clients were mutual fund companies, pension funds, hedge funds, large institutional investors. So we were an institutional broker. And then when we moved over to electronic trading, it was still the same client base. So Brad already had all of his existing relationships with hedge funds and mutual funds. It was the same clients he was serving. It was just now building computer programs to do the trading instead of having humans do the trading.
Okay. So tell us about what led up to the decision of leaving RBC to go and start IEX. Like, where did that idea come from?
Sure. So I was at RBC for probably about 2.5 years before we came up with the idea for IEX. And, from the very first month, we would talk about startup ideas all the time. Rob and I would go into Brad's office, and Brad would have some crazy idea for, let's say, an exchange that would list golfers, and you could buy shares in a golfer, and if that golfer was successful, you'd get a portion of their winnings. Or an idea for an iPhone app that concert goers would all download this app and hold up their app at the concert, and it would be a light show in the crowd, and just kind of crazy off the wall ideas for startups, totally unrelated to what we were doing. And we would talk about these all the time, and they would be with kind of varying levels of seriousness. But it was just kind of something we did all the time. And then IEX was just it started off the same as any of the other ones, where it was just, here's another idea. We've got kind of a great amount of knowledge around how the stock market works. And at RBC, we'd built a good brand, and we had good products, and great relationships with our customers, and people really trusted us. But we were still somewhat limited in kind of the scope of the solutions we were able to offer, because RBC is just one out of many brokers, and most buy-side firms trade with a lot of different brokers, and they weren't going to just move all of their trading activity to RBC. That wasn't a particularly realistic proposition. So this was just an idea. Maybe we could use this expertise and this knowledge about how the market works to come up with a solution that all brokers could use together to kind of give our end client the same kind of experience that they were getting with us, the same kind of trading experience, but on a bigger scale. And so it started off just as another one of these ideas, and it just got a little more serious and a little more serious until it got to the point where we were very serious about it, and we decided to jump ship.
Okay, so one thing kind of led to another. Okay, so where did you even begin to start? Because from the way I see it, like having the idea that you're going to build a new trading venue from scratch seems like a huge task. What's necessary to make that happen? Like, what were the first steps? Where'd you even begin?
So when we started off, we were in a very fortunate position because, number one, we had great relationships with kind of our end customer, which is the buy side. So we already kind of knew the market extremely well from a customer perspective. And then we also knew kind of how the stock market works very, very well. So we had a great amount of knowledge around that. I'd say the very earliest iterations of what this was going to look like. The main technology that we were kind of known for was routing technology. Thor was an order router. And so we were thinking we'd build this sort of generic order router that would be broker agnostic, and the buy side could access this order router through all of their brokers. And then, doing actual matching of orders, kind of more of an exchange function that we'd kind of have on the side as like a little side business, that as the main business grew and grew, we'd have more opportunities to have where we'd have a buyer and a seller at the same time. We can match them with each other and, generate additional revenue that way. So that was kind of how the idea evolved. In terms of the logistics and starting a stock exchange or an ATS and hopefully soon to be a stock exchange, it's very, very capital intensive, very, very intensive from a regulatory perspective. So there's a lot that went into it. I guess one other thing we were lucky in is that we had a very big team to start with. So we had 9 people in the beginning, most of whom came from RBC, including 4 very senior people from RBC who'd been in the industry for a very long time and really understood how the markets worked. And it was really our COO, John Schwal. He just so diligent and so knowledgeable about the regulatory landscape. Just had us in a good position where we were well aware of all the regulatory hurdles we would have along the way to getting to this point. And it was just, still multiple years of work with a lot of people working on it to kind of reach all those milestones along the way.
Okay. Yeah. No, I imagine that definitely would have been a big help. I can only imagine how much of the regulation and that sort of thing you've had to deal with. So, let's just be very clear here. So let's talk about what actually is IEX, and how does it differ from other exchanges?
Sure. So right now we're not yet an exchange. We're in the exchange application process. Right now we're something known as an alternative trading system, or ATS. A lot of people would also probably call us a dark pool. The main difference between an ATS and an exchange from a trading perspective, or the main difference between a dark pool and an exchange, is that the exchanges all disseminate quotations, whereas dark pools typically do not disseminate quotations. So a quotation is if you're a buyer and you're sitting in the market, you're bidding for stock, or you're a seller sitting in the market offering stock. On an exchange, most of the buyers and sellers will display their orders. So they'll say out loud, I want to buy 1,000 shares of Microsoft at this price. And then the exchange will disseminate that quote out to the world, advertising that this buyer is there with a firm order ready to buy. In a dark pool, typically, in dark pool, kind of by definition, all orders are hidden. So you might have that same buyer, it might even be the same firm, willing to buy the same number of shares at the same price in the dark pool, but the dark pool won't advertise the presence of that buyer. And so the trade will only happen in the dark pool if a buyer and seller happen to intersect, not knowing each other was there. So we're kind of in this fuzzy middle ground right now where we're still in ATS, but we're technically not a dark pool because we do disseminate quotes. Our quotes are not protected quotes. There's a lot of regulation in the US around if there's another market out there with a quotation, you can't do a trade at a price that's through that quotation. So for example, if there's a buyer at $10 on NASDAQ, New York Stock Exchange can't do a trade at $9.99 unless they also ship an order in NASDAQ at $10. So they can't let a seller come in and trade at $9.99 on NASDAQ unless that they're also sending shares to interact with that buyer on the New York Stock Exchange. In our situation, even if we had a buyer at $10, they could still do a trade at $9.99 because our quotes aren't protected, so we don't contribute to the national market system.
Okay, got it. So why do you decide to display your quotes at IEX, considering that you're technically a dark pool at this stage, whereas other dark pools don't display their quotes? Why do you decide to do that at IEX?
So when we started, from the very, very early days, we had kind of this end goal of becoming an exchange. And so our path to becoming an exchange, the regulatory hurdle to becoming a dark pool or an alternative trading system is a lot lower than the hurdle to becoming an exchange. So we were going to start as an ATS, and then eventually we'd become an exchange. And the reason for us publishing quotes now, so I guess just to be clear, we don't publish, not every single order that we receive is displayable. So we only publish quotes for orders that are sent to us with the specific instruction that this order should be advertised. 90% of our trading activity is still hidden orders, just like any other dark pool, but 10% of our volume is displayed orders. So that's a customer saying, I want you to advertise my order, knowing that it's not a protected quotation. So the reason for us so we started off as fully dark, and then we started offering this ability for customers to send us displayed orders, just like an exchange, because it's just part of our transition path. We want it to be a smooth transition from dark pool to exchange, and we're in this middle ground now where we're kind of halfway there, where we're publishing quotes just like an exchange, but we don't have exchange status. We're not protected like an exchange. But it should make the transition to when we do become an exchange a lot smoother.
Okay, so why would a participant decide to display their order if they've got the option to hide it?
So, I mean, the idea there is it's typically a market maker who's displaying quotes in general, but the reason to display an order versus keep it hidden is if you want to buy stock at a price and you display that order, a seller will know you're there so they can know where to find you. You're not just relying on chance for them to interact with you. It's kind of a double-edged sword in that, if you want to buy a lot of stock and you display that, people are going to know a big buyer just entered the market. And so usually institutional investors aren't going to display their entire intention all out loud, all up front. But for a market maker who's kind of always in the market, you want other participants in the market to know you're there so that they find you and they interact with you. So it really just depends on what kind of strategy you're running. Okay.
Yeah, great answer. That makes total sense. So what's your involvement these days as co-founder / quantitative developer? What are you doing on a day-to-day basis at IEX?
It's changed a lot since the early days. I would say in the beginning, my role was primarily as a developer. I built some of the applications in our system, like the smart order router, for example. Then I would say probably maybe 8 months ago or so, it transitioned into more of a data science role. So I do a lot of quantitative analysis now. Analyzing customer behavior, analyzing kind of how trading is happening on our market relative to the rest of the stock market. So I do a lot more of that these days, although in the last, I would say 3 months or so, as this process of going through getting exchange approval from the SEC has ramped up, I've had more of a role in that as well. So basically kind of understanding we've been going through this public comment period where companies around the industry and individuals outside the industry have been commenting on our application to become an exchange. And so we've had to kind of manage that process, submitting our own comments and responding to those comments. And so I've been involved in that as well. And then finally, through this process, we've decided to change the trading behavior of our router as kind of a concession we're making. And so since that was an application that I built originally, I've had to make a lot of changes to that in anticipation of once we're in exchange that behavior is going to change.
Okay. Now, I just want to ask you I just want to ask you a little bit about some of the terminology. So you've mentioned the smart router or order router a few times. Can you just explain to myself and any of the listeners who don't quite understand what that's actually referring to? What is a smart route order?
Sure. So I would say from a trading perspective, there's kind of two main applications in our system. And one is the matching engine and the other is the smart order router. The matching engine is the system that takes buy orders and sell orders from all of our customers and throws them together. And when there's a buy order and a sell order that can interact with each other, it matches them and it puts up a trade and then it reports that trade. That's the matching engine. The smart order router is responsible for connecting to the rest of the street. So like I was mentioning earlier, there's this concept of protected quotes. Every exchange needs to know what's happening on all the other exchanges, and they need to know if there are quotes available at better prices at other exchanges, so that it knows at what prices it can trade at. And then in addition, pretty much every exchange offers a smart order router. A smart order router is a technology that actually will send orders to the other exchanges. So it's the logic that says our customer wants to buy 10,000 shares, and it's giving the customer's instructing us to route this order out. So we'll match as many of those 10,000 shares as we can on IEX at a valid price. And in addition, whatever's left, we'll try to buy those shares from the other markets. And so we need the smart order router consumes quotes from all the other markets, knows what's available, takes the balance of that order and breaks it up and sends orders externally to those other markets on behalf of our client.
Right. Okay. Cool. Got it. Okay. So one of the things IEX try to position themselves around, or from what I gather, is bringing fairness to the market. So I'd like to ask you, in what way are markets currently unfair?
That's a good question. I think kind of our big concern is just the evolution of the markets over the last 5-10 years is the main thing that we focus on. And if you look at the exchanges 10 years ago, their business was matching buyers and sellers, matching trades. And every time an exchange matches a trade, they get a tiny commission, and that's how they make money. And over the last 10 years, it's really shifted where that's no longer their primary source of profits. Nowadays, the exchanges make most of their money from selling kind of tangential technology services. So things like co-location in their data centers or proprietary market data feeds. Services like that generate more revenue and more profits for the exchanges than the actual trading itself. And so it's just this strange ecosystem that's evolved where exchanges now have this incentive where if they make those technology services more valuable, and they can charge a higher fee for those technology services, and they make more money that way. And so their incentive is to make those technology services as valuable as possible so that they can charge the most for them. And how do you make your co-location space more valuable or your proprietary market data feed more valuable? Whoever's buying that has to be able to extract value from it. So they're in a situation where there's really a pretty big conflict of interest where the more money that someone can make using all of these technological services, the more profitable the exchange is. And we've just kind of seen this evolution, and it definitely kind of rubs us the wrong way. And so I guess in terms of what we're doing at IEX to kind of counter that, part of it is just like philosophy is just we're very transparent about what we're doing, very transparent about how we're making money. It's just from trading. We just try to foster kind of fair trading on fair terms. One of the big things that we focused on is this idea of when the market's in transition, when the price of a stock is changing. That's a very, it's kind of a window of time where a very fast trader might recognize that the price is changing and profit off of that knowledge. So for example, if the price of a stock is moving up, while it's in the process of transitioning up, that fast trader, knowing that it's moving up, might send a buy order at the old price. And if there's an exchange or a dark pool that doesn't know about the change in the price, they might still have sellers that they're willing to match at the old price at the lower price. And that's a profitable opportunity for the fast trader. And so one big thing at IEX is making sure we always have as up-to-date a view of the market as possible. And even more than that, not only have as up-to-date a view of the market as possible, but also make sure that we have a more up-to-date view of the market than our very fastest customer. And so that's kind of the big thing that we've done here from a trading perspective is that we delay all of our customer orders before they come into our system so that by the time it actually gets into our system and we're willing to match it, we have a more up-to-date view of the market of what the fair price in the market is than that customer did when they generated that order. So a very fast trader, if they see, hey, the market's moving up, I'm going to send an order to buy at the old low price. By the time that order actually gets to our matching engine, we know that the market's moved up. We won't trade them at the stale price anymore.
Okay, so how does, even if there's a very fast trader, let's say the price is $9.99, how do they know that the next tick is going to be $10? Like how do they know that?
So I guess, yeah, a very simple case would be if the market's already moved. So let's say let's just use midpoint trading as an example, because that's kind of the main trading activity in dark pools. For us, 2/3 of our trading happens at the midpoint. So the midpoint is the kind of halfway between the best bid and the best offer, the highest price someone's willing to buy it and the lowest price someone's willing to sell at. So let's say the midpoint was $9.99, like you said. So there are buyers in the market at $9.98 and there are sellers at $10. And that price is changing. So let's say that price is moving from a $9.99 midpoint to, let's say, a $10 midpoint. So let's say the spread is moving from $9.98 by 10 to $9.99 by 10.01. So that change is happening. Really, the main scenario we're worried about is that change has already happened. So a buyer, that offer of $10 was on NASDAQ, and a buyer went to NASDAQ and bought all of the stock at NASDAQ and then bid for stock at $9.99. So they bought the stock at 10 and then they bid for, or someone else bid at $9.99. So the price has already changed. So the price used to be $9.99, the midpoint used to be $9.99, but it's now 10. After the price has changed, NASDAQ, if NASDAQ's quote just changed, NASDAQ is disseminating that quote to the world. They're saying, hey, someone just bought our offer at 10, our best offer is now 10.01. It takes time for all the different players in the system, both the other dark pools, the other exchanges, and the other traders. It takes time for everyone to actually get that message. That message has to leave NASDAQ's data center and then get processed by your servers. If you're a dark pool, wherever your dark pool servers are located, you need to process that information that NASDAQ's quote has changed. So if a very fast trader is able to see, hey, NASDAQ, they have a new quote, using that new quote, like that knowledge of the new quote, I know there's a new buyer in the market at this price. That trader can send an order to a dark pool that might still have orders trading at the old midpoint. And it's basically that discrepancy they're taking advantage of. It's not that they know that the market's about to move. It's that they see that the market's already moved, and they use that knowledge, knowing that some dark pools are a little bit slower at recognizing that, using that discrepancy of knowledge to execute a trade on the slower dark pool.
Understood. Okay.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So the delay that you place on all the orders that come in to IEX, what's the length of that delay or the speed bump, as you call it?
So it's roughly 38 miles of coiled cable, and that equates to about 350 microseconds of delay. And the reason we picked that amount of time is we have a sense of where, we know where our data center is located. We know where our servers are located. We know where all the other exchanges are located. And we know our network connections to the other exchanges. And so the idea of that 350 microseconds of delay, we know that when an event happens in the market, wherever it happens, whether it happens in the New York Stock Exchange or NASDAQ or BATS, whatever exchange it happens on, when their quotes update, it takes us about 320 microseconds at the longest to recognize that those quotes have changed. For the most part, there's also a stock exchange in Chicago that trades some stocks out of Chicago. So that, it's a very tiny part of the market. So excluding them, for the rest of the market, it takes us about 320 microseconds to recognize when a quote changes. And so we wanted to give ourselves a buffer a little bit larger than that. So that if an event happens in the market, even if someone could instantaneously recognize that event and send us an order, which is impossible, but even if they could do that, we would still have enough time such that by the time their order got into our system, we would already, also recognize that change.
Okay, so the delay is actually occurs because of the cable that you have coiled up. It's not actually delayed by a computer program or anything like that. It's actually the coil, is it?
That's correct, yes.
Okay, interesting. And just so we can get our head around this and put it into perspective, How long is 350 microseconds? I mean, you often hear comparisons to these like very small time frames compared to kind of the blink of an eye. Is there anything you can compare 350 microseconds to?
I think I've heard 1,000th of a blink of an eye. I think a blink of an eye is about 350 milliseconds. So it's a very, very small amount of time.
It's hard to get your head around, isn't it? So it's just
definitely
crazy at how fast these things happen. So, I mean, part of the idea of putting the speed bump in place is part of the motive for doing that to keep high speed or high frequency traders out of the IEX dark pool.
So I guess to that point, I don't like bucketing kind of all automated trading strategies under a single term, high frequency trading. There are a lot of different types of trading strategies that use computers and that are very focused on speed. For example, if you're doing a cross-border arbitrage strategy, so in the US, for example, if you're trying to arbitrage the price of a Canadian company as it's trading in the US and it's trading in the Canadian markets, and you're doing that FX conversion and you're trading in both markets and you're trying to kind of profit anytime those markets fall out of line. That would be a strategy that's very dependent on speed, but it's not necessarily trying to take advantage of, say, a structural flaw in how the stock market works, where there's an exchange or a dark pool with slower technology such that they have a blind spot when they're willing to match trades at unreasonable prices. So I'd say those are two very, very different types of strategies. And I would say we're trying to kind of pinpoint and with a scalpel cut out the strategies that we consider structural arbitrage or kind of structurally unfair, taking advantage of a flaw in the system, and still allow the other speed-based strategies that are providing some value to the market, like a traditional market making strategy or a strategy that a statistical arbitrage or a cross-border arbitrage or an index arbitrage strategy that's taking related securities and keeping their prices in line, that very much cares about speed as well, because whenever there is an opportunity for one of those types of arbitrage, only one trader can successfully profit off of that trade and bring the market back together. So two traders competing in the same strategy, they're both going to be very concerned with speed. So I wouldn't say that all speed-based trading is bad per se. I would say just the situations where someone's taking advantage of a flaw in this dark pools technology that really shouldn't exist. You're not adding any value. You're just taking advantage of their inability to match trades at fair prices. We're trying to prevent any of that type of trading from happening while still allowing the rest.
Okay. And do you think that any other exchanges may follow suit and implement a similar kind of tactic as your speed bump? Do you think that's ever likely to happen?
It's a very interesting question because you've had, as we've gone through this process of filing for an exchange license, and the other exchanges have all commented on our filing, and one of the comments that they've made, or that a couple of them have made, is that if we're allowed to have a speed bump and that gets approved by the SEC, that they may want to follow suit and introduce speed bumps of their own. So they've said that they might. I think one thing to think about is that, like I said earlier, so much of their profits are now derived from selling these services that are so focused on speed. And so if they ever in a meaningful way try to introduce a speed bump like the one that we have that kind of reduces the value of pure speed, it would potentially compromise those other revenue lines. And so I think if our model really takes off and we start to capture real market share from the other exchanges, I think they may follow suit at that point. But I don't think they'll proactively sacrifice those lines of revenue, before that happens.
Yeah. Okay. So I'd like to sort of go back to something we talked a little bit about earlier, and that's actually dark pools. So just the subject of dark pools in general. Why would a participant choose to trade in a dark pool instead of just trading on a recognized exchange like, New York Stock Exchange, for example? Why would they go to somewhere like IEX?
That's a great question. So I'm going to focus my answer on just an institutional investor, because the way retail trading works is totally different. So an institutional investor, say a mutual fund company that's buying a big chunk of stock or selling a big chunk of stock, why would they choose to go to a dark pool, or why would they ask their broker? Because they're trading through brokers, why would they ask their broker to go to a dark pool instead of just sending their order to an exchange? So first of all, that decision isn't really typically made by the investor. It's typically made by the broker. That's kind of a low-level trading decision. The investor will say, buy me 100,000 shares of Microsoft, but it's the broker who's actually managing that trade and breaking it up and choosing which pools and which exchanges to go to with that trade, deciding when to trade and at what prices. So typically it's the broker making the decision, not the investor. But I mean, we do try to cater to those institutional investors, and we do try to encourage them to come straight to us and ask their brokers to come straight to us. The reasons why someone might want to go to a dark pool, and keep in mind that orders on dark pools are typically hidden. If you're trying to buy 100,000 shares of Microsoft in a single go, I want to buy all 100,000 shares at the current price. It's basically impossible to do that on an exchange. To buy a huge amount of stock, much more than is typically quoted in that name, you can't just go to an exchange. If you go to an exchange with that order, with an aggressive order, you're going to immediately, rip the stock. You're going to create a big immediate impact. If you go to a dark pool, you have a chance where there might be another institution on the other side of that trade who might happen to find you. You could patiently wait in your dark pool all day, and maybe you'll get, especially if you use a minimum quantity on your order. That's a thing that you can do with a hidden order that you can't do with a displayed order. Is you can specify, say, I want to buy 1 million shares of stock, but only in chunks of at least 100,000 shares at a time. So I can send that order to a dark pool, and I'll have a chance that another institution will bump into me, and I'll get a big trade with no market impact. And the cost there is that, the stock might move away from me and I might not get anything done. But that's kind of the big value proposition that we talk about, is that a large investor can send a large order to us and have a chance of getting a very large execution without having any market impact at all.
Okay. Now, this might be somewhat of a newbie question, but do the prices on a dark pool, and we may have actually already covered this, but do the prices on a dark pool vary from the prices on an actual exchange by much? I think we probably already covered this, but
we sort of covered it, but it's a great question. And basically, all dark pools and exchanges are all covered under the main regulation in the U.S., which is Reg NMS, which stands for National Market System. And what that says is that all trades have to happen within the best bid and the best offer across the market. So this is all the exchanges with protected quotes. Whatever the best bid, the highest buy order among those exchanges that's displayed, and the lowest sell order, the lowest price of the most aggressive sell order, that creates a range of prices. And all the exchanges have to trade in that range, and all the dark pools have to trade in that range. So the price that a stock is trading in a dark pool, just like an exchange, it depends on, is there a buyer and a seller that are both willing to trade at the same price? But in addition to that price, where they overlap, needs to be within that range as dictated by Reg NMS. So it has to be within the NBBO, the National Best Bid and Offer. So yes, they all trade in line with each other. It's not that every single trade happens at the exact same price all the time, or for a period of time. It's just within that same range. But in a liquid stock, that range is a penny.
Okay. Yeah. So how much volume is traded in dark pools, in the US compared to recognized exchanges?
Most volume happens on exchanges. I think it's something like 60% of the volume happens on exchanges, and most of that is concentrated. There's 3 exchange families, really. The New York Stock Exchange, NASDAQ, and BATS, and they each have multiple actual exchanges, but between those 3 families, they each trade about 20% between all of their markets. And then on dark pools, I believe it's something like 15 or 20% of the market trades in dark pools, and most of those dark pools are operated by brokers. So like Goldman Sachs has a dark pool, Morgan Stanley has a dark pool, firms like that. And IEX, I would consider that in that realm, as part of that off-exchange ATS volume. And then the remaining 20% or so, a lot of that is retail order flow that's executed off-exchange directly by retail market makers. So that's kind of a separate ecosystem that is still held within the confines of Reg NMS. So that ecosystem trades in there have to happen within the MBBO, just like trades on the exchanges and dark pools, but it's basically kind of completely segregated flow. And in addition to that, there's also upstairs trading, so trades that don't happen on an exchange or in a dark pool, but just that a broker just matches two orders and reports it to the tape directly. So that's probably the last 5% or so.
Okay. So you said something interesting there, which I think may have almost been referring to payment for order flow, which is something we've actually talked about on the podcast in the past with Haim Bodek. Now, you guys do something a little bit differently. You don't accept, I'm not entirely sure how it works, you don't accept payment from brokers for executing their orders or something along those lines. Can you tell us a little bit about how you're different in that way?
Sure. So you've touched on two different topics there. And so I'll start with payment for order flow. Payment for order flow is the term that refers to the typical relationship between a retail broker and a retail market maker. So like I just said, the retail world, using E-Trade or Charles Schwab to, buy stock for a person at home, that world, basically all of that stock in the U.S. trades completely separately from the rest of the market for the most part. And so in the retail world, E-Trade has arrangements with high-frequency trading firms where those firms will pay them and E-Trade will send that firm kind of all of its order flow, or a subset of its order flow. So for example, you go on your E-Trade account and you say buy 10 shares of Apple at market. E-Trade will take your $7 commission, and they will also send that 10 share order to a firm like Knight or Citadel, and that firm will execute your order for you, give you your price, and then E-Trade will deliver those shares to you at that price. And Citadel or Knight, whoever the market maker, the high-frequency trading firm on the other side of that trade, will also give a payment to E-Trade. So E-Trade's getting paid on both sides, and that's called payment for order flow. That world is pretty separate from what we do. So I don't have a ton of experience or knowledge about it beyond kind of what I just said. The thing that we do that's different from the other exchanges is that we don't offer maker-taker pricing. And so the pricing model that's kind of evolved as the new norm on exchanges is that they pay market makers on it. So every time there's a trade, the exchange takes a small commission. And in the past, that commission was kind of a flat commission. Both the buyer and seller, whoever was sitting in the market and whoever entered the market, would both pay a fee. But the way it's evolved is that nowadays, on most of the large exchanges, they pay the person who's sitting in the market a small rebate, and they charge a fee to the person removing liquidity. So in a case where New York Stock Exchange has a buyer at $10, and then a seller sees that quote and sends an order to sell at $10, the buyer who was already in the market will get a rebate, the seller will pay a fee. And the fee is slightly larger than the rebate, and that's how they make their money from trading. Like I said, the profits from trading have come down a lot because the fee and the rebate are very close together usually, but they make a lot of money in other ways, like selling technology services, so they're okay with it. The problem with having this structure, so this structure incentivizes people to make markets, to have out loud quotes on the exchanges, and so there's just been like a huge proliferation of new order types, that are all geared around harvesting rebates, getting as many rebates as possible. I guess the problem the main problem that we see from an institutional investor perspective is that this kind of strange fee rebate structure that's evolved. There's different fees and different rebates on all the different markets. Some markets have an inverted structure where the market maker actually pays the fee and the remover of liquidity gets the rebate, where it's backwards. A broker who's charged with trading an order on behalf of an investor, that broker, the broker is the one who incurs those fees and gets those rebates. They typically don't pass those fees and rebates back to their customer. So it creates this conflict of interest for the broker in this case, where a broker, if they get an order to buy 1,000 shares and they see 10 different markets, and those markets all have different fees and some will give rebates, that broker is going to try to go to the ones that give rebates because they'll make more money that way. And if it's a small order, that's probably fine. But if it's a large order and they're kind of favoring certain exchanges and trying to avoid other exchanges, they might wind up missing out on liquidity that's available. and their customer might get a worse experience. And so we just see maker taker, these complex pricing structures, as creating conflicts of interest for brokers that wind up hurting investors. And so we don't want to contribute to that. So we just have a simple flat fee model for trading on IEX.
Okay, now that sounds really good. So just jumping back to the subject of dark pools, is there any downside for other market participants by taking trading activity off the exchange and into dark pools? Is there any sort of negative flow-on effect to traders who are participating in your recognized exchanges?
That's a really interesting question. I think if you asked any exchange, they would say, yes, there's a huge problem with that. And I think if you asked any dark pool operator, they'd say, no, it's great. I guess from my perspective, it's basically the same participants in the dark pools and on the exchanges for the most part. All the same market makers are in the dark pools. The same high frequency traders are in the dark pools that are on the exchanges. The dark pools markets are basically in line with the exchanges all the time. I think if you had a huge shift where 97% of trading was happening in the dark, there would be price discovery would be a little bit tougher. So I think if it went too far, in that direction, that would be bad. I think dark pools provide a service, but for the most part, they're not really used for that service. The service I'm talking about is what I was talking about earlier, where a dark pool offers an opportunity for a very large trader to put a large order into the market, have a chance of executing, but not have any kind of adverse impact in the stock if they don't execute. I don't think dark pools are used. I think they're used a little bit for that, but I think for the most part, like I said, most dark pools are operated by brokers, and brokers use them as a chance to kind of execute trades and internalize trades without having to incur fees on the exchanges. So that kind of goes back to the maker-taker fee model on the exchanges, because it's kind of shifted to favor market makers and hurt removers of liquidity, which are typically investors. The brokers who would typically incur those fees, they want to try to avoid those fees, so they create this dark pool and they create this environment in the dark pool where the same market makers will be in their own dark pool, but they can do the trading in their own dark pool and avoid having to pay the fee to the exchange. I think that dynamic, doesn't really add any value. So to the end investor, it's just kind of a broker preferencing their own dark pool. It just kind of fragments liquidity without adding tremendous value. So I think that's not necessarily super valuable to investors. But having no dark pools, their dark pools do offer this one good service. So I think having a balance. I think the other great thing about having dark pools, kind of the path that we took, where we start off as a dark pool and now we're an alternate trading system that has lit in dark trading, and hopefully soon will be an exchange. The barriers to entry to becoming a dark pool are a lot lower. They're still quite high, but they're a lot lower than the barrier to becoming an exchange. So it offers this path where if you have a new model, you can start off as a dark pool, kind of test out your model, see if it catches on, grow your model, and then eventually move on to becoming an exchange. That's the path that we took. That's the path that BATS took, which is the next newest entrant into the exchange world. So I think it offers this avenue for new competition in the market. So that's good. So I don't think it's I think too dramatic a shift in either direction would be bad, but having this path to becoming an exchange is definitely a good thing.
Okay, yeah, I think that's a great answer. Well said. So what is your motive, and what are the benefits of actually filing for exchange status?
The big one is that I think it'll open up new avenues for us to offer the protections that we currently offer to our customers to kind of new types of customers. One example is the retail world. So I was saying most of the retail world is completely segregated, through these payment for order flow relationships between a retail broker and a retail market maker. But some retail order flow makes its way to the exchanges. These days, almost none of it makes its way to IEX, but once we're an exchange, some of that order flow might come to us, and we can potentially target that segment of the trading world. So basically the same protections that we're offering now, the same kind of products and services that we're offering now, we could probably offer them on a larger scale once we're in exchange, hit more segments of the market. That's number one. Number two is, as an exchange, you're a self-regulatory organization. You just have a much bigger role in kind of the policy making side of this world. So it kind of will give us a seat at the table with the regulators as they're coming up with new rules in that rulemaking process that we don't exactly have now. There's still ways for us to have influence, but I think we'll have a much greater potential for influence as an exchange. I think those are the two big ones. Another thing about being an exchange is you can do listings and IPOs. So right now, pretty much all of our services are targeted at traders and investors. Once we're an exchange, we can come up with ways to help the actual companies whose stock is being traded as well. So it opens that up.
Okay, yeah, that makes sense. So filing for exchange status, have you hit any roadblocks? Has there been any pushback in going about that? Like, where are you currently at with that?
So the process formally started last September, so it's been going on for quite a while. Even before that, we were already talking with the SEC, kind of socializing this idea that we were going to apply to become an exchange and kind of going over our model with them. So it's been going for quite a while. Our exchange application, so the way an exchange filing works is you write your kind of formal set of rules for when you'll be an exchange, and you write this formal proposal to become an exchange, and you send that to the SEC, and then they publish it. They publish everything that you've written, and they open it up for public comment. In the past, the past 5-10 years, every time a company's filed to become an exchange, there's only been a few. There's been very little public comment. For the most part, all of the exchanges these days are very, very similar to one another, and so when a new one pops up, nobody really has much to say about it because it's so similar to everything that already exists. Our model, from kind of a pure trading perspective, there's a couple key differences, like the speed bump that we talked about earlier. It's not that different, but there are a couple differences. So we're kind of more different than any of the other recent exchange applications, and that's led to a huge number of comments. I think having the Michael Lewis book come out about us create a lot of controversy in kind of our segment of the industry. And so a lot of people have a lot of strong opinions about us already, even before this process started. And this was kind of a great opportunity for those critics to kind of come out and make their feelings heard. So our exchange filing has had by far the most public comments of any exchange filing in history. We're up to almost 500 comments now. The comments are overwhelmingly positive. I think over 90% of those comments have been in favor of our approval. The ones that are positive have mostly come from institutional investors, pension funds, mutual funds, hedge funds, brokers, and then a lot from just kind of the general public. So people who'd read the book and gotten excited about what we're trying to do. So overwhelmingly, the public comments have been positive, but then the other 5-10% that are negative have been very, very negative, very, very critical. Those have come primarily from other exchanges, from a couple of high-frequency trading firms, and from a couple of kind of high-frequency trading interest groups for the most part, which is not surprising at all. Kind of basically our direct competitors, and then the people that were kind of trying to limit their ability to run their strategies. So it makes complete sense, the people that have come out critical of us. But yeah, our application has generated a huge amount of controversy, and it's been a very long, drawn-out process as the SEC is trying to kind of sort through all of these comments, positive and negative, and come up with kind of their own opinions on whether or not we should be an exchange.
Okay. So once they go through all these comments, like, what's the next step from there? And when do you actually find out if you'll be accepted as an exchange? And if you are rejected for any reason, what's the path forward from there?
That's a great question. I'm not sure I have a great answer for you. They were initially supposed to come up with a decision in December. They asked us for an extension, and we gave them an extension until March last month. And then March, I think it was March 23rd or something, on that date, when they were supposed to come up with a final decision, they asked us for another extension. We said no. They initiated some proceedings. I believe it's proceedings to approve or deny IX. It's kind of this formal legal process, and that basically extend the process by another 3 months. So now the deadline is June. I think it's June 18th now. And that was kind of like the last legal card that they could use to extend the process. So I think at this point, there's not really much precedent for the SEC to further extend our application process. So we expect a decision to come in 2 months, in June. So hopefully we'll be approved. If we are denied, I don't know. I guess we'll go back to the drawing board and see what's next. I think we're very hopeful at this point that we'll get approved. We firmly believe that everything we're doing is kind of well within the regulatory constraints of how the market works. We're a free market solution. We're not asking for any special privileges or any special sanctions or anything like that. We designed this model from the very beginning to fit nicely within all the existing rules. The reason they keep delaying it is because there's been just so much controversy around it and so much noise that it's completely reasonable from their perspective that they just need time to consume all of this information that they've been bombarded with. But I think we're pretty confident that we should get approved when the day comes. I think our bigger fear is not that we'll get rejected, but that they'll come up with another reason to delay the approval, and then the waiting game continues.
Okay, sure. Well, I bet you're hanging out for June. I wish you all the best, man. I really hope that all comes through for you. So, all right, Dan, well, let's call this a wrap. Is there anything else you wanted to add, or do you think we've covered some decent ground for now?
We covered a lot of stuff.
Okay, excellent.
These are great questions. Thank you.
No trouble whatsoever. So where can listeners go to find out more about you and IEX?
Our website is iextrading.com. It's probably a good place to start. The book Flash Boys tells our story from the beginning. So I'd say those are probably two good resources if you want to learn more about IEX.
Absolutely. And you're also on Twitter as well. What's the IEX Twitter handle?
It's just at IEX.
Okay.
Very easy.
Awesome. Well, I'll make sure to include all those notes at Chat with Traders. And Dan, I just want to say thank you very much for coming on the podcast. I really do appreciate it. And I think you did an awesome job of making some really complex subjects very understandable. So I appreciate that.
Yeah, thank you. This is fun.
Thanks for listening right through, guys. I trust you enjoyed this interview with Dan. I certainly learned a lot from speaking with him. He's a great dude. And full show notes for this episode can be found at chatwithtraders.com/75. Now, just to repeat the announcement I shared with you right at the beginning, I've recorded a second interview with Peter Brandt. This will not be released on the podcast like normal, though. It's a special subscriber-only Chat with Traders episode. So to hear this, go to chatwithtraders.com/Peter, enter your email address, and this will give you full access to the interview, which runs for over 80 minutes. Again, that's chatwithtraders.com/Peter to get this interview for free. All right, that's me for now. I'll catch you on the next episode.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey, what's up, team? How you doing? I'm Aaron Fifield, and it's so good to have you listening. Now, my featured guest for this week's interview is Saul Knapp. Saul originally started out as a runner on the floor of the Life Exchange in London when he was just 16 years old. Later, moving on from there, he's had various roles as a risk manager for proprietary trading firms, at times monitoring positions for as many as 120 traders. Today, Saul lives in Spain, where he runs a small prop firm of his own. In regard to how he trades, Saul is a spread trader who's most active in the energy markets. So spread trading is something we definitely cover during our conversation here, as well as his observations from being a risk manager and helping other traders to improve as his role as the owner of a prop firm. If you have any questions or if there's anything which you'd like further explanation on, just write in the comments at chatwithtraders.com/76 and Saul will respond to you as he's kindly offered to do so. All right, well, let's get to the interview. Here is episode 76 with Saul Knapp. Hey, Saul, how's it going, man?
I'm good. Yourself?
I am doing really well. Thank you so much for coming on. I know we're going to cover some really interesting and quite important topics, but let's start, as per usual, with how you first got started in this business. I think you may have only been 16 at the time, but Saul, share with us how you first got started.
For some reason, I always wanted to be a trader. I think maybe from the films when I was young, and just, general interest in trading. And I got started on the life floor in 1992. My dad's friend was a broker there. He got me an interview, which was in a small pub in Cannon Street. And I started the following week as a runner.
Okay, and I'm just curious, what were some of those movies that got you into trading?
Silly as it sounds, Trading Places with Eddie Murphy. As much as it wasn't completely focused on trading, I just liked the look of it.
Okay, excellent. Yeah, I actually watched a movie on the weekend, kind of old school, Rogue Trader. It just popped up on Netflix. I like Rogue Trader. Yeah, great movie. Really, really cool. So you were very young when you first started out on the floor. What were your first impressions like as a 16-year-old? Was it anything like you'd kind of seen in the films, or was it a totally different experience?
It was quite strange because I've never been a shrinking violet. I've always been fairly confident, but being a 16-year-old boy, I look back now and think, really, I was a boy. And the minute them doors opened when I walked onto the floor, I couldn't believe just the sheer noise coming from the trading floor, and how on earth was I going to work in this?
So how did you go during those first couple years? Did they sort of, did you understand your role fairly well, or was there anything that was particularly challenging or you struggled with? Maybe if you could tell us a little more about what your actual position was as a floor runner.
Well, originally I was a floor runner for about 10 traders. They traded Euromarks, Bunds, BTP. There was 10 traders. They weren't very big traders. And to be honest, at first I didn't have a clue. I was just sort of thrown in the deep end. There's your 10 traders. Go and click their cards, write their positions down, work their positions out, work their P&Ls out, and make sure their trades match off. There wasn't really someone showing you how to do it. It was just, there you go and do it. So, I didn't really have a clue to start with.
Right. So after a couple years, from what I understand, you actually moved on to become an actual trader on the floor. How did you go with this? Did you pick that up fairly quickly, or did it take you some time to actually reach a level where you were profitable on the floor?
To be honest, I was never actually profitable on the floor. I started in the Bund pit on the tail end of when the Bund migrated to screens onto DTB or Eurex as we know it now. So I went in the pit when a lot of people were finding it tough. And I never really made any money, to be honest, on the floor.
Okay, so did you lose significant amounts of money? Like, what do you think prevented you from actually being able to make money on the floor?
I think it was going straight into the Bunds when the Bund it was the life Bund. and it was being overtaken in volume by the EURUSD, and I think it was just getting very difficult to actually trade it. Even the big traders, experienced traders, were either going to a different pit or just leaving the floor. I didn't lose significant amounts. It was, it wasn't a lot at all really, but it was just very difficult. And to be honest, I don't think I was prepared enough as an 18-year-old and not really knowing what I should have known.
So you eventually left the floor. What was the reason behind this? Was it due to the fact that you were struggling to make money, or did it have anything to do with electronic markets coming in, or tell us a little bit about the reasons why you moved on from the floor?
A bit of both, really. The company I was working for, they were leaving the floor to go completely electronic. They pretty much had their setup, and I wasn't really part of it, to be honest. And I was offered a job with one of the big clearers as a floor manager, and then subsequently they took me on as a assistant risk manager up in the back office. So I managed all the traders on the floor and all the traders, electronic screen traders, and the new groups of traders that had sort of been created. So I went into the main office of the bank and was a risk manager.
Okay, interesting. That's really cool. So how long were you there as a risk manager for? I know you've also done this later in your career, which we're going to get to, but for that point, how long were you a risk manager for? Was it a couple of years?
Yeah, it was about just under 2 years, I would have said. I was assistant risk manager, and the head of risk, he was a really good guy and really good at his job. We used to sit down every day. He used to teach me about options risk and what I needed to know about options risk. So I learned a lot more than just basic vanilla futures and just buying and selling basic strategies. I learned a lot more about options risk as well. And I've done it for about 2 years.
Okay. So tell us about your next move on from there when you I think you went to join a prop firm of some sort. Tell us a little bit about that.
That's right, yeah. In 2000, end of 99, I got made redundant as the company decided they didn't want to do proprietary trading anymore. It was only going to do banking business. So I had a contact from the life floor, and he was starting a small prop shop. So I went to see him about January 2000, and I started with him in February 2000 in a small office above Cannon Street. I think there were 6 of us, and a risk manager and an IT guy, like a small attic with us crammed in, and that was like a little sweat room really, but it was good.
Okay, and I believe the guy who funded that prop firm, it was a kind of an interesting story, actually lived in the States. He was a wealthy individual. Is that correct?
Yeah, well, do you know what? I never actually knew who the funder was, but he was a wealthy individual from the States, yeah. I don't actually know who he was. He funded it. It was kept quite quiet from me. And yeah, that's as much as I know to this day, to be honest.
Okay, awesome. Now, what were you doing at the prop firm? You were a risk manager in your past job. You come into the prop firm. Were you actually a trader on the desk there?
Yeah, when I was working for the bank previous to this, I used to watch all the on-screen traders. So I had all their live trades in front of me, their live positions. I used to be able to see who was doing what orders they were working, just be able to see everything. So I sort of learned. I used to watch the bund traders and the bobble traders. I used to have the graphs and the charts in front of me just to see what the market was doing. And I used to watch how these guys traded. I used to try and watch how big a market move there might be, how much these guys run their positions, how much they cut them for, did they average, did they build big positions, were they waiting on key levels. I used to try and work out what most of these guys were. I couldn't work out what they were doing, but I was trying to work out a pattern to what they used to do. So then when I went into work for Saxon, which was the little firm, I was a Schatz trader, Schatz and bobble, and a little bit of bund.
Okay. And, you'd mentioned previously that you struggled to make money as a floor trader. You then went to be a risk manager, and now you're actually a trader again. So how did you go as a trader? Did you still, experience your fair share of difficulties when you came into that role as a prop trader? Or were you pretty much profitable, straight out of the gate?
I started trading again in February. and I was profitable by the end of April, maybe beginning of May. I just found it, I think in my time off as well from being a trader on the floor to going into the office, I learned a lot more about the actual dynamics and the mechanicals of the trading, as opposed to not really knowing enough when I went in the pit. But going back onto the screens after 2 years watching people trade, I thought I then had a feel for it. I could almost envisage what was going to happen. Not obviously, I couldn't tell what was going to happen, but I'd watch these guys so much day in, day out. It gave me a good idea of what was going on. Right.
Okay. So who were the other guys at the firm that you were trading next to? I mean, were they more experienced, bigger traders than you were at the time? Did you learn anything significant from these guys?
Not really. I had a senior trader who he was no more senior than me in his experience, but he'd been with the group a few months longer, because the group started about 3 months previous to when I joined, and he became my senior trader just because he was there before me. But he was a very good guy. He had a real good approach. He was a programmer by trade, and very analytical, and he likes his probabilities, and he was a real good mentor, to be honest, to have. Even though he weren't much more experienced in trading than me, he was very calm. If ever the market went a bit haywire, he used to just say, sit back, hold on, don't panic. He was very calm, which was good compared to what the people like I dealt with before on the floor.
So can you share with us perhaps your best and your worst day while trading with this firm? I think that might be interesting to hear about.
One of my worst days was, we called it the super spike, and it was in the shats. And even though we knew this trade would be busted at the time, it wasn't particularly nice. We all got very, very short in a very short amount of time, because the shat spiked 800 ticks. We knew it was a fat finger, but it still didn't make it any nicer at the time, because you didn't know what you'd done, and we were short quite a lot more than we should have been short, and quite a lot more again. And the market did eventually come back to within 50 ticks of where the move started, and they busted any trades above there, but we were still 50 ticks offside on quite big size, and we had to work around it for the rest of the afternoon. We actually ended up making money, which was it's quite amazing, really. But that was one of my worst days.
Okay, and what about one of your best days? Let's take it from the other side.
I've had lots of good days, not just financial, not just making money. I mean, I've had some good days where I remember there was an earthquake once, and everyone thought it was an earthquake in New York, and we all managed to make a lot of money on it. It wasn't. It was an earthquake out at sea. No one was hurt. Nothing, there was no problems. It was a big false alarm, really. But that was, I think, the first few days back in January. I think I'd sat down after about 30 seconds and the news came out, and I think it was probably my best day ever.
Now, in your answer there, you mentioned you used the term fat finger. I think some listeners may not be familiar with this term. Would you mind explaining that for us?
There's lots of different fat fingers you can do. A typical trader fat finger like I'd make would be, you might you're trying to bid a price. Say you're trying to bid a price of 52, and you accidentally lift the offer by mistake. So you buy into the offer and buy 54s or 55s, putting yourself immediately offside. And it's quite frustrating. But when there's a big fat finger like this particular day, I don't know the exact story, but the rumour was that someone meant to buy 2,500 shats and bought 25,000 at market, and it set off a lot of long-term stops. And I've seen lots of fat fingers like that before. I've seen someone in the DAX was meant to sell one lot at 3,500 and sold 3,500 at one instead, and dropped it literally to 9-0. So, these trades normally get busted, but they do have a knock-on effects across other products and other contracts. So they can cause a lot of problems.
Okay. Now, during your time working with this small prop firm, you mentioned that you became profitable after about a few months of consistent trading. I'm sure, as time went on, your trading began to improve more and more as time went on. Were there any moments that kind of, any like game-changing moments or any aha moments that really made a big impact to your success as a trader during that time?
Yeah, I can, and a lot of people are going to hate me for saying this. And back in 2000, I think the end of 2000, maybe 2001, we noticed the flipper, the Eurex flipper, and we read it very well. My group of traders, there was probably only 7 or 8 of us in my little group, and we read what he was doing extremely well, while we'd hear all the other traders in the office shouting, screaming, swearing, banging desks, and genuinely losing money. We actually really liked this flipper being in there, and when he wasn't in there, we used to worry. We like him in there. We used to make really good money when he was in. So when we spotted that, it was almost like a strategy that we knew we could make money from, and it was good.
Okay, now this is probably another somewhat of a new term to listeners and something we haven't really discussed much on the podcast. What are you referring to when you're talking about a flipper there?
The flipper, it works, in my opinion, it works best in slower moving markets than like the bobble or the shats. He was big in the bunds as well, but you basically would bid a price for a very large amount. If the average bidder offer price had 500 or 600 lots on it, he would bid it for example, 2,000 lots. Anyone short would immediately pay the next price, but he would slowly drip feed offers back in the price above where he was bid until he got enough people long and got himself short. And he would pull his big bid out and turn that big bid into a big offer. So anyone had just paid the current offer before was now caught long and had to now sell into the price 2 prices lower. But we used to read it very well and take advantage of it. He changed his game a lot, and the guy was very good at changing his game, but we just tried to keep changing and evolve with him.
Okay, now when you say he, you're obviously talking about another really big trader who's almost kind of manipulating the market. I don't know if that's maybe the right word, but kind of pushing the price around. Yeah,
definitely. I mean, I know who the guy is or the group was, and there wasn't one of them. I think there was a few of them, and I suppose in the day, yeah, it was manipulating, and people hated it. There was uproar about it because people were just losing money left, right, and centre, and he was making a lot. But we read it differently to everyone else for some reason, and we liked it. And them days it was flipping and bullying the market. Now I suppose it's manipulating, spoofing, layering. It's illegal now.
Okay. So how long did you stay on at this prop firm before you moved on to other things?
I stayed there right up until 2010, so 10 years.
Okay, and then what was your next move from that point?
Well, I was still a trader with Saxon, which is the group I was with for 10 years. I was also the head of trading, so I'd mentor and help junior traders. I'd even help senior traders, train new traders. And once I'd finished trading, and I found it difficult for a while, I stopped to give myself a bit of time out, and I became the head of risk management there. And then when I left in 2010, I went and worked for another small commodities firm called Timoris.
Okay, interesting. Well, let's fast forward to your situation these days. I know you're no longer living in the UK. Can you tell us a little bit about what you're doing these days?
At the minute, I run a small proprietary trading firm with graduate trainees, a few experienced guys, and you just mentoring juniors, training them, helping the senior traders. We look for different strategies in the markets every day, trying to evolve and stay with the times, really.
Excellent. And that's in Spain, is that correct?
That's right, yeah.
Awesome. Now, so let's move on to a little bit more about how you're actually trading today. So can you share with us how you trade now, and also maybe how this has changed over the years?
Today, mainly spread trading, mainly in the energy complex, WTI on NYMEX and Brent on ICE. I spread trade a lot more, just find outright trading increasingly difficult, and the volatility is it's just not for me anymore. Maybe because I'm older, But we try and take a lot of arbitrage from different products and spread stuff off on different exchanges, and just create synthetic strategies which are more mean reverting than what the outright trading is.
Okay, now I've got a bunch of questions around spread trading for you because, again, this is something that we haven't actually really discussed on the podcast in past episodes. So I think it'll be really interesting if we can actually dive into that. So, Saul, could you really dumb it down for us and explain how you make money as a spread trader? Like, what are you actually doing when you take a spread trade?
Well, a lot of spread trades, take the energy complex, for example. There's so many different permutations of trades you can do. You can trade right out till, I don't trade out till December 21, not 2021, but a lot of people do. You're basically, you're mitigating your risk a little bit by spreading one outright off with another, or calendar spreads I trade. I don't actually trade the outrights. But if you trade two calendars against another, one calendar against another, you're creating a fly. You can create double flies, condors, boxes. You're sometimes dumbing down the range of what you're trying to trade. You're taking the volatility away by spreading it off against other products or other months or other deliverables. You're just making it less volatile in the long run.
Okay, and when you do this again, this is probably a newbie question. Are you, so you're trading two separate contracts as a spread trade from two different deliverable dates, like two completely separate contracts. Are you necessarily going long one contract and short the other? Or is there sometimes where you might be long or short both?
No, you're always in a spread, you're long one and short the other. So for argument's sake, if you had at the minute, the front month in WTI will be April-May. So if you was to buy the April-May spread, you'll be buying April, selling May. So that has much less of a range than the actual two outright contracts in themselves. You might have a range of, for example, 20 ticks a day as opposed to 200. There's a lot more size on the bids and offers. So there's a lot more liquidity there to do more size and to get in and out. Yeah, so it's a safer way of trading a lot of the time.
Okay. So what type of market activity are you actually monitoring to find these opportunities? I guess to add on to that, like a technical trader may look for certain types of chart patterns. What do you look for as a spread trader?
Yeah, a lot of spreads are very technical as well. It depends what spreads you're looking at. A lot of the oil spreads are very technical. They'll react off big levels, a lot of moving averages. Also, then with a physical commodity, you have to take into account the deliverables. And if you're trading things like softs, the cocos, sugars, coffee, anything like that, you've got to worry about, same as oil, you've got to worry about supply and demand issues. So it's fundamental factors massively affect the spreads. For argument's sake, the Iran stuff now, the sanctions on Iran, that affects the oil prices. Any threat of war will affect the oil prices. Any cut in production will affect the oil prices. Any oversupply will affect them. So they're very fundamental driven in the outrights, which then does have a knock-on effect down to the spreads.
Okay, and what time frames do you operate on as a spread trader, and is speed a factor at all?
For me, it's not particularly a factor. The only speed for me would be if I was trading synthetics, which would be one calendar against another, maybe against another. An auto spreader needs to be quick, so you get all three prices in one go, so you don't get any slippage and you get the price you wanted. Your speed's not it's not a big factor for me anymore. Time frames, it depends again what spread you're trading. So some spreads move a lot more than others. It tends to be the longer the duration between the 2 months, for argument's sake in oil, a December 16, December 17 spread moves a lot quicker than a March, April or an April, May. So some of the wider dated spreads, you can get quite quick moves intraday, even in a few minutes. Some flyers and stuff, which would be one calendar against another calendar, you might run them for a few days, depending on, again, what duration they were. Well, 1 month fly, an April an April, May, June, for argument's sake, you might have to wait a few days to get any decent movement out of it. But a longer duration fly, you might get 50, 60 tick movement in a day.
Okay. Now, what appeals to you about spread trading over outright directional trading? You sort of touched on the topic of, risk a little bit earlier. Are there any other reasons that attract you to spread trading?
There's so many different permutations of spread trading in the oil complex. There is so many different ways to skin a cat. There's so many different spreads you can build. So if you do get in trouble with a spread and you can see what leg is hurting you, if it's a 3 or 4 legged spread, you can lighten one leg. You could take a leg off. You can adjust it. You could turn it into something else by cutting that leg and adding another leg in from a different maturity. As where if you've got just outrights on, you're either right or you're wrong pretty much, and you've got to be so right nowadays and pick your levels so well. Sure.
Okay, now, I mean, when you're spread trading, does this carry, you kind of said before that it mitigates your risk to a certain extent. Is there any chance that it can increase your risk that over, what you might risk as a directional trader, because you could potentially be wrong on, maybe 2 contracts now?
Yeah, I mean, the worst case scenario for a spread trader is if your long leg goes down and your short leg goes up, they completely do the splits. And that does happen. But it's no different from an outright trade where you either have a monetary stop or a stop where you say, if it gets here, I'm wrong, or you have some percentage stop on your account. You should manage it the same way.
Sure. Now, that's a good answer there, Saul. Is there any quantitative and or automated element to your spread trading, or is it purely discretionary?
I run an auto spreader, which that automatically executes a lot of stuff for me. I do write some code in some of my front end systems that allows me to trade automatically if I need to. And I do set a lot of stuff up to alert me when there's trades, and I can set it to auto, but I tend to do it manually.
Okay. No, that's cool. Now, are there any resources you'd recommend to someone interested in learning more about spread trading? Is there anything that's been helpful to you?
To be honest, no. There's not many people who you can speak to about spread trading. There's lots of stuff on the web, and it tells you the basics of you're buying one delivery month, selling another delivery month. It explains the basic flies and condors, but no one really tells you what you're looking for and how to implement your trades and when to execute and why. No one really tells you. It's just something I've learned over the years. I learned mainly as a market maker when I was market making in 2010 for an oil company, and we had so many different strategies then. It's trial and error to see what ones are the best.
Do you think there's a reason why it's not really discussed as much as, I guess, more of outright directional trading is discussed?
That's when I sound skeptical. I know in the energy complex is a lot of big funds and people don't really trade the outright as much. They trade a lot of spreads, and the big players trade spreads. I'm not saying they don't trade outrights as well, they do. But there's some real big players in the spread trading arena. I don't know. No, I don't really know if there's any sort of insider club or anything like that. But I know the big players do trade spreads.
Okay, and when you bring in new traders to your prop firm that you have there in Spain, what type of traders are they? Are they also spread traders, or do they focus on other styles?
They start off as outright traders. They learn about fundamentals, technicals, even to the price ladder reading still, because there's still a lot of information you can glean from reading a price ladder. I find it increasingly difficult now because the markets are a lot faster than when I used to be a really good price ladder reader. But no, they start off on outrights.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Now, Saul, you've worked many years as a risk manager for a couple prop firms, so let's spend a little time on this. I think it will be valuable for listeners to get some of your insight on this subject. So the first question I have around this is, were there any specific risk parameters or rules that you would not budge on in order to protect the firm's capital and, of course, the trader?
Yeah, normally it was stops. I used to like to run almost like a traffic light system. So if a trader would agree a predetermined size that he could trade and the maximum he could have on, it didn't mean he had to trade that maximum all the time. But if the need be, he could trade up to an agreed size. But if he had, let's say, for example, let's just call it £1,000 stop loss for the day. If he got to, say, £400 down, I would approach him or Skype him, or normally he was in the office, so I'd go and see him and just say, look, you know, you're 40% of your way towards your stop. Why don't you take it easy for a bit? Maybe cut your size, just get a little bit back. So that would be not the first warning, but that would be the first point of contact. And then if he got into a bit more trouble, maybe sort of £650, £700 down, I'd go over to him, I'd suggest a break, get out your positions, pull your orders, clear your head for a little bit, and definitely cut your size now until you get it back, 50% of your money back. And then if they got to their stop on the day, then that was pretty much nailed on. The only time I would ever budge on it is if it was a really absurd market move where something unbelievable would happen and they just got caught instantly on a blip and they've got stops out. I may let them trade again after they'd had a little break on reduced size and with a really tight stop for the rest of the day. But a lot of the time the guys made that back.
Right, okay. Now, just out of curiosity, when you were a risk manager, I think maybe the first time around, how many traders were you actually looking over and monitoring?
In total, probably about 120.
Okay. Now, were the risk parameters the same for everybody, or how did you decide when to allocate more or less risk to certain traders?
It depended on the products they traded, how much of a relationship we'd had with them already. You know, if it was a new trader who had joined us from a firm recently, we'd be a lot more, you know, hands-on with him and make sure we kept an eye on him until we learned his trading style, how he dealt with losses, how he got out, you know, how much he abided by the rules we'd set him. Also, how much the trader had in his account, and obviously the size that they traded. The rules were never the same because everyone had different stops. And certain traders, we used to give big stops because we knew if they even got to near their stop, there was a good chance that they'd make their money back.
Right. Now, is there anything you've noticed that often gets overlooked by less experienced traders when thinking about risk management?
Yeah, a lot of the time, I try and explain to trainees a lot of the time, you don't have to be right that often to actually make money. You know, if you've done 10 trades, you say you lost a tick on 9 of your trades, but you made 10 ticks on your last trade, you actually made money. So you haven't got to be right as much as people think, but your losses have obviously got to be a lot smaller than your winners. So either you've got to cut your losses short or manage your losses and run your winners. And a lot of people struggle with getting that whole package together. So it's a combination of running your winners, keeping your risk tight, and obviously, you know, just put it all together in one go.
You know, we often hear people talking about risk management, okay, and they say, you know, it's a very important aspect of trading, which, you know, they're definitely right. But is there more to good risk management than just where you place your stop loss and how you size your positions?
Yeah, I mean, everyone's got their own opinion on risk management. I have people that say they'll have a hard and fast 3% of their account as their stop. Some people will say, you know, I want £1,000 stop loss. Some people say I'll have a stop loss depending on how big I trade, or I'll trade this big depending on how much I'm going to risk. So there's no real hard and fast rule. Everyone does it differently. It's a tough one to call, but it's very individual. As long as you can't be too restrictive with your risk, because you'll constantly stop yourself out. And you obviously can't just let it run away, because you need such big winners to cover the losses.
Yeah, no doubt, no doubt. So what would you say is the key thing that separates good risk-taking from bad risk-taking? I know that might be a bit of a tricky question, but do you have any insight you could perhaps share on that?
Some of the best traders I've ever met and risk managed and worked with, and, you know, just had the pleasure of meeting, the best ones I always found didn't care for the money. They didn't care if they lost. They didn't really care about earning the money. It was just the game to them. It was just about winning. So when they made money, they had won. They didn't, you know, some of these guys I know have made a hell of a lot of money, didn't buy anything extravagant, didn't really spend a lot of money considering how much they had earned. They didn't seem to do it for the money. And when you're not doing it for the money, you seem to earn more money. And when you're backed up against the wall and you need the money, you'll find it very hard to make money.
Yeah, that's a really great point you bring up, Saul. I appreciate you mentioning that. And I know it's a really good outlook, but it can be quite tricky to get your head around.
Oh, yeah.
Is there anything that independent traders might be able to learn or take away from someone who's on the in the field of professional risk management that they can perhaps apply to their own trading?
Yeah, I think you've got to take a look at your trades and say to you, you've got to take a look. You've got to have a plan, because one guy in our office used to say to us, if you don't have a plan, you haven't got anything. You can't go anywhere without a plan. Fail to prepare to fail, he used to say. And I think as long as you've got a plan, and with every trade, if you know the risk you're going to take on this trade, I don't always like to call it risk. I like to call it, you know the potential downside to it. You should never be worried about taking that trade. If you know this trade has got a $500 risk on it, or a £500 risk on it, then that's the risk you've got to accept for that trade. Your risk reward, you hear people saying, you shouldn't run anything less than a 3-to-1, a 5-to-1, or whatever it may be. Some traders run a 1-to-1 risk reward ratio and make a hell of a lot of money. So as long as you know what your plan is and you stick to that plan, you carry it through and execute it exactly to the T with your profits and your stops, then I think that is very important. It's not all about getting the trade right. It's staying in the game and having the right risk management.
Absolutely, yeah. Brilliant answer again. Like you mentioned earlier, you do run a prop firm in Spain now, and part of your day-to-day life is managing other traders. What are some of the common mistakes you see being made by less experienced traders outside of managing risk?
A lot of the time it's accepting a loss. You get a trader who... Now, most traders find it hard to start with. You get a good trader, he'll have a good little run, and there's one bad day and it seems to really affect him. But I tell them that's part and parcel of what goes on. You're never ever gonna be a trader if you can't accept taking losses. And someone told me years and years ago when I was a trader on the floor as a young lad, it's good to accept small losses, and at the time I thought you're mad. But he said you should enjoy taking small losses because it's much more enjoyable than taking a massive one. And that always stuck with me. And I think it's accepting that you will lose at some point. And, you will lose. If you trade 10, 15 times a day, there's going to be a point during that day where you're wrong, but you just got to accept that you're wrong. And as long as them wrong trades aren't big and they're not bigger than your winning trades, then you shouldn't have nothing to worry about.
Excellent. I like that answer, Saul. That was really good. Now, just one last question I have for you here, and this is a question I've been asked a little bit lately, by people sending emails and just asking about like what platforms do some of my guests use in their day-to-day trading. So what is the trading platform that you use, and perhaps what type of trader is this best suited to?
At the minute, I use CQG Trader with a spreader, and I really like it because everything's in one package. So I've got all my charts. I use the CQG integrated client. So I've got all my charts, all my settings, all my ladders. Every single thing is the same. So if I want to type in a ladder for a DOM trader, for argument's sake, like a market depth trader, if I want to type in a ladder for the Bund, I type in a code for the Bund, which is the same as the chart. So everything's standard. It's all the same. It's got, originally CQG was a charting system, and they developed it into a charting and a trading system. So for me, it's an all-in-one package. It's light. I can even boot it up on my laptop when I'm not in the office. It's just very user-friendly. It's very simple, and it's got so much functionality. That's the reason I use that, and because it's good for spreading. It's easy to create synthetic spreads. A lot of other guys I know use TT as well, which is another fantastic system. But I haven't used that for a while now because I'm more of a spread trader.
Great. Okay. So CQG, is that something that can also be utilized by traders who are not spread traders?
Yeah, I mean, there's a few different versions. You can use just a CQG Trader, which, if I remember rightly, it just gives you 4 ladders. You can use CQG as a charting system on its own, or you can use the combined one, which I use, is CQG integrated client. So anyone can use it. It's available for anybody.
Awesome. Okay. All right, Saul, well, it's been awesome speaking with you. Thank you very much. I've really enjoyed this conversation. Is there anywhere listeners can go to find out more about you? I know I struggled to find any information about you online prior to the interview, and it's thanks to Cam Data for making this intro. So is there anywhere listeners can go to find out more about you?
There's not a lot about me on the web, to be fair. I'm obviously on Skype as we're talking now. I've got no qualms in anyone. If they want to talk to me, you're more than welcome to give them my contact details.
Okay, well, let's do it this way. So if you guys maybe have questions or there's something you want to ask Saul, leave a comment leave a question in the comments area on the website. Or if you want Saul's direct contact, just email me. My email's pretty easy to find at chatwithtraders.com. And we'll just play it that way. All right, so once again, I really appreciate you taking the time to do this, and thank you very much.
You're welcome.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
How you doing, guys? You're listening to episode 77, and I am your host, Aaron Fifield. As per usual, thank you for being here. Now, what you're about to listen to is a really interesting conversation I had with Dennis Dick. For a little context, Dennis first started out meddling with penny stocks before soon joining a well-established prop firm known as Bright Trading. This was in the late 90s. Now, astute listeners may actually pick up on the fact that this was also where Jeff Davis from episode 70 got his start too. To this day, Dennis remains with the same firm, still as an active short-term equities trader, but also as their market structure analyst. And if his voice sounds somewhat familiar, that's probably because he's the co-host of Benzinga's Pre-Market Prep live morning show. Some of the key talking points that come up over the next 60 minutes here include scalping. Is it still a viable strategy? Surviving as a short-term trader in a high-frequency world, various order types and the pros and cons of those, and the opportunities that can be found trading the open, because this is actually where Dennis makes roughly 50% of his money each day within the first 5 minutes. All right, traders, I hope you enjoy this episode. Here is my chat with Dennis Dick. Just pretty much things that we spoke about the other week. You know, how you came up as a trader, prop trading, how you trade today, particularly around the open and after hours, and also really keen to speak to you about some market structure topics as well, seeing as you're a market structure analyst. So how does that sound?
Yeah, sounds perfect. I tend to go on tangents, so I guess if we go on a few tangents there, those make it interesting as well. So
yeah, no, that sounds good. That sounds good. So yeah, feel free to do that. I mean, we're keen to hear what you've got to say. So let's just start it off. So the first question I'd like to ask you is, how did you get started? Like, what was it about trading that got you interested?
I was trading my parents' money in university. So my parents had a stockbroker, and I was taking finance in university. So I started getting interested in the stock market and started playing the penny stocks. I think everybody starts with penny stocks, it seems like, but there was, a couple of penny stocks. There were advisories, newsletters, email newsletters, and it was interesting to me. Like I'd see these newsletter come in my inbox, and I didn't know at the time, but it was basically just a pump and dump scam. But looking back on it in 1997, so I'm going back 20 years ago. You'd get these emails, and they basically would be just trying to pump a stock, and you'd look at the stock, and you'd get the email the night before, and you'd see it the next day, and it would go up, and you're like, holy cow, this newsletter is awesome. They're literally, sending me information on a stock, and it's going up the next day. But really, it's just because they're sending it to thousands and thousands of people, and it's actually pumping up the price of the stock, looking in hindsight. But that got me interested just in the markets, just playing the penny stocks and seeing how everything moved. So I was starting to trade my parents' money, and I was just trading basically during the internet bubble. So they gave me a little bit of money to play with, and just by sheer luck, and just because of the environment we were in, it seemed like everything that I would buy would make money because it was in such a raging bull market. Like I can remember stocks, that are probably long gone now, but like Excite at Home and these other search engines that were trading publicly. And, these stocks would, go up tenfold in a year. Like the tech bubble of the NASDAQ was really something. So that's kind of how, what spurred my interest. And I was just trading retail then, obviously my parents' money. And then I graduated from university, and instead of getting a real job, I had a friend who was trading at Bright Trading in Detroit, Michigan. And I was Canadian, so there was going to be a little bit of to do with visas to go across the border and that. But, I worked that out and actually went over and met the office manager there, who, coincidentally, I've been with, for a long time now. I now do a radio show with him, Joel Alconin. And I met him, and there really wasn't much to it back then. This was 1999. There wasn't any licensing or anything that was necessary. So I went in and just interviewed with him, and I saw the trading office. There was like maybe 12 or 13 guys trading in there. And I was like, this is fantastic. So you had to have $25,000 to trade at Bright Trading. So you put that $25,000 performance, that deposit into your account. And then that was the money that your losses or your gains would go to. So with that 25,000, they would give you access to the firm capital, and that could be upwards to 500,000 to $1 million. So you really got by. If you were on a retail account, imagine trying to use $25,000 to make a living would be impossible. But that $25,000, now that you have access to the firm's money, can make you a lot of money. So and obviously that capital. You can employ a lot of different strategies as opposed to buying one or two stocks. You can employ a plethora of strategies when you've got access to $500,000. So that's how I got started at Bright Trading in 1999, and it's now 2016, 17 years later, and I'm still at Bright Trading. So
that's awesome. That's a really cool way to kick this off. So I've got to ask you, were you ever nervous trading your parents' money?
Yeah, for sure. Even back when I was retail, but not so much. I think I wasn't nervous because in the beginning it just seemed like everything worked. And like I said, looking back in hindsight, it was just the market environment we were in. The NASDAQ was going straight up, everything was going straight up. So you bought some little tech stock, and it just went up. So it seemed like I was very confident going in because I didn't have a lot of losing trades. So, but I can remember when I first started at Bright, and I was trading with my parents. I actually borrowed the $25,000 from my parents to start at Bright Trading, and I can remember being nervous then. So, and starting up Bright, and it was kind of completely different. I remember actually on my second day of trading, and you're trying to get used to the interface. I trade on it's Goldman Sachs Ready Plus platform, and that's what we were trading on back then as well. And I remember you're just trying to get used to it, and I accidentally, what you could do is if you click in the montage and you click on the offer, your order entry window automatically populates. And it would populate with the size of what you clicked on. So I accidentally clicked on a 2,000 share order, and I accidentally bought 2,000 shares of Microsoft. I wanted to buy 100 shares of Microsoft. So now I'm thinking whoa. I'm trying to buy 100 shares of, $100 stock. I just bought 2,000 shares. And I can remember trembling at the mouse. I was literally shaking at the mouse. I'm a 22-year-old kid here. And I just, on my second day of trading, I've just thrown $200,000 on Microsoft, which, we were in the tech bubble. Microsoft really moved a lot back then. So that was a big position. And I quickly got out of it. And I think I actually ended up scratching the trade, so no damage on that. But then I had to sit back and sit back and really analyze and make sure you learn how to use the configuration and everything of the platform before you just start clicking randomly. So very dangerous when you're on a prop account. If you're in a retail account, there's like a confirmation window. There's something different happening. So you make an accident. Now you have a confirmation screen. It's like, oh no, I didn't want to do that. And in Goldman Sachs Ready Plus, you click, you own. So it's that quick. So it's a little bit different, but that trade actually didn't end up breaking me. But I can remember my first week, I made like a little bit of money just by luck. And then I remember my second week there, and I just was losing on everything. I think I had the office record. I lost on 17 consecutive trades. And I'm like, how, if you think about it, trading really is kind of like 50-50. I mean, if you're buying, it could go up or it can go down. How do you statistically lose on 17 trades in a row? You're doing something really bad. I'm like, holy cow, I'm really bad at this. But it didn't deter me, and I stuck with it and slowly started to learn, the different systems. And we were kind of playing market maker back then and learning how it goes. And after 6 months, I started to become profitable. So it was a little bit of a learning curve to it, but I did gain the profitability. I never really lost that much money. The most I ever got down, I think, in my trading account was about $3,500 on the 25 grand. So I never really got down that much. And that was because I really followed, Bright Trading's lessons. They're like, trade with 100 shares. You trade with 100 shares, you can last a long time. Because a good day, you might make $200. A bad day, you might lose $200. But it's not like you're going to blow your account out in one day.
Mm-hmm. Okay, so I want to dig into a few things you've said there a little bit more. So just backing up a little bit, what were some of the advantages you saw at the time by joining a prop firm? Like, why did you decide to go into the prop industry instead of continuing to trade as a retail trader?
Big advantages back then. The advantages aren't as much as they used to be now because we've had the internet. There's so much advancement with retail brokers that you probably can do a lot of stuff that we do now through a retail broker. The biggest advantage back then was just the speed. So we had T1 connection, which was everything back then. So you're getting the information faster. You can send your orders directly into the system, where you literally, like in my and obviously in your first 6 months of trading, you're still learning. But in my first few years of trading, I was basically just trading the news. And we were the fastest. So when news would break, like I can remember even, for instance, if there's a Fed decision at 2:15, they're always at 2 o'clock now Eastern, but they used to be at 2:15 back then. And they're raising interest rates. So we'd have like spreadsheets to go to buy like all, a whole pile of the S&P components. And they would sit there for a few seconds. Like it wasn't like high frequency trading is now, where it's gone in milliseconds. Those opportunities were there for seconds, and that was everything. And we were fast. So you could, literally pick off, anybody who's sitting out there with a limit order that's, they're kind of like a sitting duck, and we're just picking those off. So, and basically making the money from, because those orders that are sitting out there aren't priced for the new information that, hey, they just lowered interest rates, so everything's going to go higher. So, so that was the number one advantage, was the speed. The second advantage, which I talked briefly about at the beginning of the interview, is the capital. So, like I said, if you're trading retail, and if you're a 2-to-1 margin or 4-to-1 margin intraday, it's hard to make a living with a $25,000 account. If you even say you had 4-to-1 margin, that's $100,000. Well, you got to do 10% on your money. You're only going to make $10,000. You're not going to live very well on $10,000. So that's why, that access to capital was key too. So, and obviously the other big thing is, at a retail broker, you have a ticket charge. And the ticket charge is that $7.99 a trade, or $10.99 a trade, or $5 a trade. No ticket charges at Bright. It's just flat out. It's just flat out. Well, now it's profit sharing, but back then it was commission based. So we'd pay 1 cent a share. So if I'm buying something, and it was in fractions back then too. So if I'm buying a stock on the NYSE at 25 1/4, and I sell it for 25 5/16, I'm actually going to make 6 1/4 cents minus my 2 cents. I'm pocketing 4 1/4 minus the little SEC fees in there. I'm clearing 4 cents for sure. So, on a minimum tick, which was, a 16th back then, I'm making money. You wouldn't be doing that at a retail broker. The ticket charges would kill you. So that's the difference, is that it's, there's no ticket charge at a prop firm.
Okay. And I just want to pick up on some of the terminology you said in your response there. Can you just expand on what you mean by picking off?
Okay. So this, if you have a limit order that is sitting out there, and this is going back to, like, if you want to talk, like, it's like adverse selection risk is what it really is. So an adverse selection is just the risk that your order is going to not price in the information fast enough, then another trader might be able to take your orders. So for instance, let's just use the example that I cited earlier, where you had the Fed decision. So there will be orders sitting on the limit order book at any given time. There's going to be bids and asks on. There's going to be buy orders out there and sell orders out there. So if all of a sudden the S&P futures drop 10 points because of the Fed decision at 2:15, that's all of a sudden all those buy orders that are sitting on the limit order book are mispriced, because they were out there before that information was there. Before that information of the interest rate rise, or the interest rate decision was publicly available. Once that information becomes publicly available, then what you have is, and you'll see this in the high frequency trading world, that they'll come in and obviously take out whatever is down there. So if the S&P futures fall 10 points, that means all your S&P components, for the most part, like obviously as a whole, are going to drop by that percentage. So it might be easier to say in percentage. Let's just say, hypothetically, for simplicity purposes, S&P futures drop 1%. The S&P 500 components as a whole have to drop 1% as well. It didn't do that instantaneously, though, in 1999. It took a few seconds for that to happen. So what we would do is, if General Electric was bidding 25.50 before this information came out, S&P futures all of a sudden fall 1%. There's still a 25.50 bid sitting there. I'm going to hit that 25.50 bid because it's mispriced now for the new information that was just given to the market. I'm going to probably hit the 25.45 bid, probably the 25.40 bid as well if it's there. And then, watch, as other traders come in and the arbitrage comes in and reprices G possibly down to 25.25 or 25 30 cents lower, or maybe approximately 1% lower, because its beta is approximately 1 for that interest rate or that movement in the S&P futures. So basically, I was just playing the arbitrage of the S&P components versus the actual tradable futures contract, which is obviously the 500 components combined. And now the difference is why you can't do that now is high-frequency traders are repricing that in milliseconds. So that's why speed is so important to high-frequency traders, because they're trying to beat the other high-frequency traders. So, really, in the evolution of the markets, they're just doing exactly what we were doing manually in 1999 or, obviously on the floor before that as well. They were doing the same thing. It was just a lot slower. Now it's been sped up and it's so quick that all those, microseconds matter.
Sure. Yeah, and we'll pick back up on that in a little bit as well. I'm keen to hear more about your views on HFT and that sort of thing. I know you've commented on that regularly. So just continuing with the prop firm, what were some of the things that they taught you as you joined the firm, and some of the things they taught you in terms of like trading methods? Did you just continue trading the way you had been trading when you were more a retail guy, or did they teach you some new ways of trading that you actually put into practice?
I think both. I think I learned a lot on the job too, and I kind of put my own spin on a lot of things. But Bright Trading is great, and they're still great like that. They do conference calls every morning. We used to do them every morning to talk with our traders and discuss what's today's action, what are we seeing today. And they would do regular. You could go out to Las Vegas, regular trading workshops. Now we have them online because it's just simpler. But back then, people would actually fly in, and you'd learn different strategies. And some traders would share strategies, some wouldn't. I've always been one that, from my own personal, I would share any strategy that's capital intensive. If it wasn't capital intensive, I wouldn't probably share it. That even goes for the radio show that I do at Benzinga. I always share the capital intensive stuff because if there's more, if I don't want all the action, there's more for everybody, that's fine. But, if I'm in some little strategy or some little small cap stock where everybody else is going to matter, then that's a strategy I probably wouldn't share. So I think that's probably, the traders at Bright probably follow that mentality a little bit, where they might share some of the more capital intensive stuff and overall strategies. But Bright themselves was great. We had Don Bright, who passed away a couple of years ago, but he had a strategy called the opening OPG strategy, which was the opening only order strategy. And that's a strategy that I still employ today. And it was basically always, if you just talk back to 1999, it was a strategy that tried to put you on the same side as the specialist, the guy on the floor. They call those guys designated market makers now, but back then there was a specialist that was running each stock. And on the NYSE in 1999, 80 or 90% of your order flow went through that guy. So he's trading, but he's also trading his own account as well. So if you can trade on the same side as him, it's a definitive advantage. And what Don Bright had figured out is, when a stock is opening too high or too low, relative to fair value or where the pricing should be, the specialist would often have to provide liquidity to that. So if a stock was opening too high, for instance, specialists would provide liquidity to that by selling the stock short the extra shares, or if the stock was opening too low, specialists might have to come in and provide liquidity by buying the shares. Well, if if the specialists just buy the guy on the floor who has the order book and all the information, because that wasn't public back then, the order book, the specialist held that book on his own. If he's buying the stock, you probably want to be buying the stock. So we traded a lot just trying to figure out which side the specialist was on. That was even through my regular tape reading. I would be trying to figure out, okay, is the specialist long or short here? Because he's probably going to try his best to push the stock higher. Now, they have rules. They can't just physically come in and start buying the stock up, but they can buy stock from themselves and then naturally let the order flow take it higher. So and the bottom line is there was a big advantage back then to figuring out which side of the trade the specialist was on and trading along with him. And that's all short-term trading. Like our trades were typically, in minutes or even seconds. We weren't in trades for hours. We were scalping.
Got it. Okay. So one of the things you said a little bit earlier was that you were pretty much profitable, like consistently profitable within about 6 months, like within your first year of trading. I mean, that's pretty abnormal, when especially from my experience talking with traders, that they actually become profitable within the first year. How do you think you were able to pick it up so quickly? I know you'd had a little bit of experience, on the retail side before coming into the prop firm, but even still, it seems as though you picked up trading fairly quickly compared to most. Why do you think that was?
1999. That's why it was. It was a lot easier back then because the evolution of the markets, you just got to think of, what's happened. So it's come from the floor, and it is in its infancy in 1999 when I started. It's just getting started at the computers. So we, are fast enough where we're sending orders, we're doing stuff like that. We have so many advantages over even the floor traders back then. Like, really, when I think about it, Bright Trading and firms like ours were your first high-frequency traders. We really were. We were employing the same strategies that they employ today. They just do them faster. So they did all this stuff on the floor beforehand. So it was just the evolution of taking these strategies from the floor and coming to the computer, and we were at the beginning of it. So the reason, that I was doing so well in 1999 was because it was just a lot easier back then. We were quicker. We were the fastest traders. We were picking off the uninformed order flow that wasn't priced for all the correct information. And that's exactly what high-frequency traders are doing today. So, it's just changed a lot. And coming back, you could ask me this later, but I think, a better question for me is probably how am I still profitable today in this environment, not trading any of the strategies that I used to trade? Because back then it was kind of like shooting ducks in a barrel, to be honest. I can remember, there's traders in the office that wouldn't have a losing day the entire year. So, and that was just simply the information advantage, trading on news and being quicker than the next guy. And I'm sure a lot of your high frequency traders, you hear about stuff like this, how Virtue or different high frequency traders don't have any losing days. And I get that, they're not cheating. It's just this when you're trading and you have a statistical edge, and let's say it's like 55% or 53%, if you employ that edge enough times during a day, there's a very, very low probability that you're going to lose money on any given day. So, so that's why, I think I was able to pick it up back then. It was a lot easier back then. Trading is a lot more difficult for a human being now because of all that high frequency competition.
Right. So at what point did, how do I say this? At what point did the high speed traders force you into trading higher time frames? Like you said that you were trading sometimes. Your trades would be over and done within a matter of seconds.
Yeah.
I know as time went by, you sort of got forced out of that space and began trading, minutes to sometimes hours as the years went by. What point did that start to happen, and how did you, I guess, notice that?
It was after the financial crisis. So we're talking 2008, 2009. I would say in 2010 is when it really started to hit us. So I'm, 11 years of, basically probably being the fastest. And we had automation too. So like I said, we were those initial high frequency traders where we're trading automated, we're speed. But then, it's moved to co-location and it's just got sped up and kind of taken away from us, and now there's off-exchange trades, all kinds of other stuff, where there's definitive advantages over there. But it all really started, I would say, like some people say Reg NMS, 2006, I think it was. But it was probably, maybe that was the infancy of it. But really when we started to feel a pinch, where, okay, we got to start adjusting some strategies. It's 2010. I used to run a manual trading system, and I had a second account. And my second account was fully automated. So I could totally, and this was probably 2004. So, when I'm fully automated in 2004, I'm way ahead of the curve, from where we were today. So, and I can remember my automated account would make money every day. 2005, 2006, 2007, 2008, it got interesting because of the financial crisis. I wasn't running as much automation in the financial crisis because it was a different environment. But in 2006, 2005, 2006, those were relatively stable years. I was running different, automated like market making type systems. Those systems would make money every day. And, and now, that's kind of how I understand high frequency trading so well. Maybe not the minutia of, how the speed all works, but I understand the strategies because it's my strategies. They're using our strategies, and not that we created them, but traders like us were using those same strategies, which were taken from the floor originally. It's all, market making strategies there. So, in 2006, 2007, and then you're trying to run automation in 2009, 2010, and it's not working as well. And that automated account I eventually closed, I think probably in 2010, because it wasn't making money anymore. I wasn't fast enough to, my computer systems weren't fast enough to make money with it. But you know what? As a human being, I still had a definitive advantage because I have, any automated computer system that's trading on a program, that has to be programmed in and figured out, where a human being can change their thinking on the fly. The program can't think for itself. It's just going to do what it's made to do. So I think that's why I'm still profitable today, is because I'm always quickly adapting to the new environment. And I would say I actually use a lot less automation than I did 10 years ago, and that's counterintuitive, because a lot of people and a lot of traders say, oh, you can't trade unless you're automated now. I would say you're late to the curve. Automation, the party was back into the early mid-2000s for your regular Joe. And now I would say any automated systems that I run are very difficult, because I'm competing against the fastest firms in the world, and only one firm can win the race. So there's 5-6 firms dominating that space. There's a lot of other high frequency trading firms. There's 5 or 6 probably dominating it. So, and I can't compete with those. And they have not even speed. They have relationship trades where they've got payment for order flow. They're sending orders, buying order flow from retail brokers so they can have the first chance to interact with those orders. There's a lot going on. So I think I went on a pretty good tangent here. But back to your original question. When my automated systems weren't working as well, probably in 2010, 2011, I realized, hey, I've got to do some adjustments here. And then, my scalping strategies weren't working anymore, because I can't get filled to my bids or offers, because, there's other traders that are quote matching me and beating me to the price. So I adjusted, and I went from from being mainly a scalper to adjusting my time frame from seconds probably up to minutes. So I'm still not trading in hours. I'm still not trading in days, but I'm probably trading in, minutes, maybe, up to a little bit longer than that. But, there's still a lot of advantages for a human trader, just not in the scalping world.
Okay, so just to summarize what you've said there, essentially you're saying that scalping isn't a viable strategy any longer?
Not for a human being, no. And not even most of your automated programs, because like I said, I was running automated scalping strategies for 5-6 years, from probably 2005, and I might be getting the dates wrong, but mid 2000s up till 2010, 2011, my automated systems weren't making money anymore either. So, and it's just because market making is all about getting fill on the bid and fill on the offer. And when there's participants, we can jump into some of this, but a lot of your order flow is now going off exchange. And you have it's funny, everybody talks about the speed race, but really it's about relationships as well. And you have a retail broker that routes orders out to an off exchange market maker. That off exchange market maker has the first chance to interact with those orders. There's nobody competing with them. Those orders go through their platform first. So they're going to have the chance to match my quote. So if I bid a stock at $24.50, well, it might trade at my price again and again and again, and I might not get filled because the order that's trying to interact with my $24.50 bid is being routed off exchange and executed directly against, by another, probably a high frequency off exchange market maker. So it's very, very difficult for, a human being and, even an automated system, to compete with that. So in a market making capacity or scalping capacity, it's nearly impossible to compete with those top tier firms.
Mm-hmm. And just to be clear, when we're talking about scalping here, we're referring to equity markets, right? So futures and that sort of thing is a different story altogether, right?
Different markets, and I'm an equities trader, so I'm not even going to comment on how that's changed. I can imagine how it's changed in the futures markets as well. But I've always been an equities trader. I've dabbled into the futures markets there, but I never had any luck with it. I've always been an equities trader for 17 years, and you kind of stick with what you know best. So the equities markets, there's a lot of market fragmentation. When I was starting, like I said, 1999, 80 or 90% of your order flow went through on the New York stocks, went through the New York Stock Exchange, went through the guy standing on the floor. Now, there's 15 or 20% only going through that, and there's 11 other venues where, these trades can transact. So when I bid a stock, for instance, and this would be a good example, like a small cap stock, it doesn't apply as much on the real mega caps, but you think about a small cap stock, it's maybe got a market of $24.50 to $24.75. If I wanted to tighten that market, go $24.51, there's going to be an automated program that automatically steps ahead of me at $24.52. I go $24.53, they're going to bid $24.54 instantaneously. So they're trying, to be, it's all queue priority. They want to be at the top of the order queue. Or they're just going to match my quote, and then, so a lot of times you'll see $24.50, I'll bid, then 5 other exchanges will bid along with me. I'll cancel, they'll all cancel too. They all want to lean on my quote. And that's really what market making is. It's kind of leaning on the quote for protection. So I'm bid 24.50. They're bid 24.51. Somebody comes in, sell it to them at 24.51. If the going gets tough, S&P futures start tanking. They hit me at 24.50, lose a penny. So do you follow me on that?
Mm-hmm. Mm-hmm.
And if I'm talking too fast, just slow me down.
No, it's excellent. It's excellent.
But you can just see how everything has evolved and changed where, okay, so that's called the algorithmic penny jumpers. Those are prevalent in the small caps. But then also, to top it all off, a lot of your small caps, this is why the small cap space in the U.S. is a complete mess. So I bid 24.50. Let's say nobody else bids ahead of me. I can bid there all day at 24.50. Somebody comes in from a retail broker trying to hit me at 24.50, so they're trying to trade against my order. Well, that gets routed out to an off-exchange market maker that then actually has the luxury of being able to match my quote. So they're going to trade and maybe give them some small sub-penny price improvement, just a fraction above me, but they're leaning on my quote for protection as well. So really, in the small cap space and even in the big caps, for the most part, the quote now is just been being used to lean on by everybody else. Everybody that's got an advantage over you by speed or by relationships. So really, by me sitting out there with my 24.50 bid, trying to make a market, taking the risk. So my 24.50 bid, I'm the first guy there. I'm the guy taking the risk, but I'm not getting the reward of getting the execution. The only time I get filled is when the thing blows through when he has 24.40 offer in my face. So you know what I do? I say, no, I'm not going to bid my 24.50. Not going to give them my quote to lean on here because they're using it against me. So I'm not going to bid at all. So what I've done in my trading strategies, and this is the number one thing I've done to survive in this world, and this is goes beyond a lot of traders even, but what I do is instead of providing liquidity, and that's why when you sit out there with your passive limit order, what you're really doing is providing liquidity. Instead, I take liquidity. So when the spread tightens, if I was trading some small cap, I would lift the offer or hit the bid, or maybe I'll go midpoint because sometimes I get a fill. But for the most part, especially when I'm trading the mega caps, I never sit my orders out there because they're going to use those against you. I want to just hit the bid or lift the offer, and that's why I now focus on the mega caps because most of those have 1 cent spreads. So I consider that like your high frequency trading toll, basically, because they monopolize scalping, they monopolize the spread. They've brought it back, from, it's kind of went full circle when I think about it. On the floor they used to have, the monopoly on the spread. Then, it went to the E-traders that kind of took it away from them. Now it's kind of went all full circle. It went off exchange, it's doing some different things, but they monopolize the spread again. So basically when I'm talking spread, I'm talking the difference between the bid and the ask, just in case we have some newer listeners there. But that used to be my payday. That's how I got paid, was making the spread. Now I can't because I can't compete with those systems. So they're forcing me to pay the spread. So if they're going to force me to pay the spread, well, I'm going to trade the stocks with the tightest spread, so I don't have to pay very much. And that's like your Bank Americas, like your Johnson & Johnsons, like your General Electrics, like your Procter & Gamble's. Those kind of stocks have a penny spread, and I can get in and out of them with relative ease with some size.
Okay, so I want to pick up on some things you're saying there. What sort of orders are you actually using in your trading today? Like, what type of orders are you using?
Okay, so I would say marketable limit orders, but I'm not. So the difference between a market order and a marketable limit order is your price is set. So for instance, let's say I'm trading General Electric and I want to buy GE. It's 29, or I'll just bring it up here right now, give you the current quote. So it closed at 30.23. Let's say it's 30.23 to 30.24. So if I'm going to go in GE, am I going to join the bid at 30.23 and try to save the penny? I could do that, but what'll happen is I probably won't be filled until it's 30.22 to 30.23. So until the quote actually rolls through my bid. That means, that the bid has now become the offer. So I'm paying the spread anyways. So why not just lift the offer and make sure I get the trade? I always say don't miss a trade to save a penny. And that's really what you're doing. Now, the likelihood you're probably going to get filled, you're probably going to get filled. But what if you don't? What if your bid was the low of the day? Now, that's a huge opportunity cost. So the opportunity cost is too great in this environment for me to miss a trade to try to save a penny. So if I want to get in that, it's 30.23 to 30.24. I'm going to use a limit order of 30.24. I'm going to send a buy order with a limit price at 30.24. Maybe if I'm really aggressive and I really want to be in, I'll send a buy order with a limit price at 30.25. And, I'm probably still going to get to 30.24 because if the best offer is there, they've got to route me there anyways. So it depends how aggressive I want to be. But I'm basically using that price. The reason I don't send a flat-out market order is because we're in a high-frequency trading world where quotes can change very quickly. And that's like writing a blank check. So if I just send a market order to buy GE, maybe I could fill the 30.30. And maybe something happens in that time frame that from when I click the button till my order actually gets to the exchange, that I don't want to happen. Maybe I don't want to own that at 30.30. So that's why I never use market orders. I didn't use market orders back in 1999. I don't use them today. Bright Trading's taught me it's like writing a blank check. I always want to put a price on my order. So that's what I'm using as a marketable limit order. So instead of joining the bid with a passive limit order, a marketable limit order is an order that's a marketable order is any order that's actually trying to lift the offer. So if the offer price is 30.24 and I send a buy price at 30.24, that is a marketable limit order. I'm trying to lift the offer.
Okay, so I'm not quite sure that I understand the difference between a marketable limit order and a normal standard limit order.
A normal standard, and it is just a limit order. It's just a type of limit order. So
okay, it's the same thing.
Normal limit order, yeah. So a 30.23. I'll just give you another example. So same thing. 30.23 to 30.24 is the Merck General Electric. If I put a limit order to buy it at 30.23, that is a standing limit order. That's a normal limit order. Both are limit orders. But because I'm not going to get executed immediately, that is why it's not marketable. So I'm just going to sit and join the bid because the bid is 30.23. If I'm on whatever exchange I am, I'm going to be behind price time priority. So if there's 10,000 shares been at 30.23, I'm going to be behind those 10,000 shares. So that's why, I'm actually, putting myself kind of to the back of the order queue. And like I said, in a high frequency trading world, they've basically monopolized the top of the order queue. So my order is always going to be at the back of the queue anyways. So basically the difference though between the limit and the marketable limit is when I'm sending a marketable order, it's for immediate execution. I'm trying to actually take the offer. It's offered at 30.24. I'm trying to grab the 30.24 offer, lift it.
Okay.
Do you follow me?
Yeah.
That's the difference. Both are limit orders, though.
Right. So is a marketable limit order, is that something that's available through most retail trading platforms?
It's just a regular
brokerages?
limit order. So you would just say, I'm calling it a marketable order because that's what's actually called when you try to lift it. But you can just say for simplicity purposes, it's a limit order. I'm putting a limit on my price. So, it's called, technical definition because the offer is 30.24 and I'm putting a bid at 30.24. I'm trying to lift the offer. That's why it's called a marketable order. That's just technical jargon, though. It's just a regular limit order where I'm trying to lift the offer.
Makes sense. Okay, so one of the things I want to dig into a little bit more and ask you about is what is it about trading the open that really appeals to you? Where do you see your edge coming from during the first few minutes of the session? Why do you like trading the open?
I love the open, and I will tell you that I probably make at least 50% of my money in the first 5 minutes of the day. Why is that? The open is the price discovery phase of the markets. I love price discovery. And you know why else? Because your high-frequency traders hate price discovery because they, besides the ones that are actually trying to move the prices, your passive market-making high-frequency trading systems are hands-off at the open because there's a lot of risk. And imagine you being a high-frequency trader and you have your profit margin is fractions of a cent, like a half a cent. All of a sudden, you buy a stock like Microsoft and it falls 20 cents on you. Well, you're in big trouble. If your average, profit margin is only half a cent, you can't be taking risk on that, where the stock moves 20, 30 cents in the opening bar. The opening bar meaning the first minute or, depending on what, chart you're using. But you can't be taking on that risk. So the high-frequency traders are kind of hands-off. I always want to be trading, when they're not around because they're competition. There's not that much competition at the open. There's a lot of price dislocations as well because you have institutions that are coming in. There's orders, that have been sent from the night before, even from little retail traders. They all pull them together. And the other thing about the open that I like, especially on the New York Stock Exchange stocks, is that's the one time a day where the designated market maker, the specialist that I was talking about before, and they call them designated market makers now, That's where they actually are putting together that opening print. They have some automated help with it, but there is actually still a human element of involvement with that opening print. So a lot what I talked about and Don Bright taught us back, in 1999 still applies. You can try to get on the same side as maybe that guy on the floor, and there might be an advantage to doing that. But basically, the open, there's going to be the biggest chance. And if you look at any chart, intraday chart, a lot of times that opening bar, you see the most volatility. That's what I like. That's where the most action is, and that's where the most chance of making a decent profit. Like if I trade GE during the middle of the day from like noon, the thing moves to if the S&P futures aren't bouncing around, if they're just staying still, GE is trading in a 1 cent range. Well, as a scalper, that's great, but if you're not a scalper, that's not very good. You can't kind of make money on a 1 cent range. I was saying earlier, the high frequency traders are making that 1 cent. You're paying that 1 cent. So if it's only moving a penny, back and forth between 30.23 and 30.24, there's no money for me to be made. But at the open, there's a lot of movement. Even on a stock like GE, there might be a 10, 15, 20 cent run. And, and then it goes into different types of trading. Like I prepare for the open 3 hours before it actually opens. So my trading day doesn't start at 9:30. My trading day starts at 6:30 in the morning, and my trading day actually starts the night before. So if I look even for my notes here, my notes for tomorrow, so I've been watching the after hours action to know what to trade tomorrow because I'm watching what the news is, what stocks are moving. So I'm gathering a lot of information. I'm trying to inform myself. I want to be an informed trader on that open. And, once I have that information, I can, try to put a projection on where I feel that stock should open, where I've deemed the fair value of that stock. And if the stock opens way above the fair value, I'll short it. If it opens way below the fair value, I'll buy it. And I'll do that on a number of stocks. Sometimes I send 50, 200, orders there at the open. So, I use a little bit of automation to help me do that because it's tedious to do it manually. But some of my best ones are manual. And, I'm sending all these orders in there, trying to, get these opening print. And the opening, I use mostly OPG orders. And what an OPG order is, it's an opening order that says to give me the opening print or immediately cancel the order. So that I'm not sitting out there like a sitting duck. If I have, a limit order out there and I forget it out there, market tanks, I'm going to get picked off and lose some money. So the OPG order is nice. It just gives you the opening print or it automatically cancels it. So GE, hypothetical example, GE is trading at 30.23, close at 30.23. S&P futures are opening up 1% tomorrow. GE's beta is approximately 1. So it moves approximately with the market. So if that's the case, 30 cents would be about 1% move. So I would say maybe the fair value of General Electric is $30.53. I might put an order to buy GE below that fair value. Say I'm going to buy at 30.40. I'm going to put an order to sell short GE maybe at 30.65, both OPG orders. If it opens at 30.70, I'm going to get 30.70 short. If it opens at 30.60, I'm not going to get filled. The order is going to automatically cancel. So it all just depends on how I price those opening orders. But if a stock opens too high or too low, a lot of times it will draw back into where that fair value is. That's a simplistic example. Now, there's a whole bunch of stuff that complicates that, where trades can get crowded and other fun things can happen. But that's the basic strategy around the open, is projecting where the fair value of the stock is and selling it short if it opens too high or buying it if it opens too low.
Okay, and did I hear you correctly when you said you might place between 50 to 200 orders, like 200 trades on the open?
Orders. So not necessarily getting fills on those. I'm placing orders where, they're going to fill or they're going to cancel. So when I'm placing an order, a lot of stocks will open right around, where their fair value is. So I'm not going to get filled on those orders. But I would say, back, going a few years ago, I'd probably easily place 300 to 400 orders prior to the opening only orders, and maybe get filled on 20 stocks, 20, 30 stocks. And then I would trade out of those positions, all in the opening print. First minute, I got 25 positions. Okay, let's go. And sometimes, something funny happens, like on an option expiration, I get filled in like 75 orders. So now I've got like 75 positions. Okay, now this is fun. When I get filled on that many positions, I don't even care about the individual positions. All I care about is my net market exposure. So what I would then look is, okay, I'm long $1 million worth of stock. I need to hedge myself here because I'm trying to extract the alpha from the misprice opening. If the S&P futures tank on me and I'm long $1 million worth of stock, the alpha's gone. So what I want to do is sell short an equivalent amount of SPY to the beta of my portfolio. So, you know, there's a lot of figuring that goes on in this, but, you know, a lot of math behind it all. But basically, you know, from a simplistic, you know, if I give you simplicity here, if I'm long $1 million worth of stock, I'm going to sell short $1 million worth of SPY. And now I'm hedged. Now I'm market neutral. Now I can let, you know, my arbitrage portfolio, because I probably, you know, bought a whole bunch of stocks that opened too low relative to where the futures were. Now I can let the natural arbitrage bring it in and slowly work out of those positions. But, you know, if I'm long 1 or 2 or 3 positions, I'll just trade out of them and not even hedge it. But if I get long 20, 30, 40 different positions, or I'm too unbalanced, like if I'm long 20 stocks and short 20 stocks, that's a natural hedge in itself. But if I'm long 20 stocks and short none, that's where I've got a lot of market exposure. And I like to trade market neutral, where I'm always eliminating the market risk, because market, you know, tanks here in the next 2 seconds, I'm not positioned for that. So that's the whole key with almost all of my strategies, is trading market neutral. And that sounds crazy to a lot of people because they think the market's got to move to make money. But I'm trying to extract that inefficiency of where a stock is open too high or too low. So that's the alpha that I'm extracting from the market, is that inefficiency of the opening print. And the opening print is often inefficient. I mean, one institution that says, hey, I want to buy this stock, and they put in a buy order to buy 500,000 shares, might press the stock up way too high. Or one institution might, you know, say, I want to sell 500,000 shares in the open. That might push the stock way too low. I'll provide liquidity to those orders. And then, you know, and that's the alpha that I'm extracting, is, you know, I'm providing a service really to that institutional order by providing liquidity to it, so that, you know, their order isn't going to, you know, there's going to be less price impact with their order. And I'm not the only trader doing this. Is all, you know, all the other prop firms are doing this too. So, you know, as a whole, those stock, you know, isn't going to open nearly as low as it would without those liquidity providers.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So you said that you use some sort of automation to enter those orders, enter into those positions sometimes. If you're filled on, you know, what could be up to maybe 70 different trades, do you also use some automation to help you exit those positions? Or is that all done by hand?
We have proprietary software that will do that. I don't. I've always been a fan of I don't use that as much automation, like I said, as nearly as I used to. So going back to 2005, 2006, I used a lot of automation. I kind of, you know, pick and choose my spots now more from a manual perspective. So where I was sending, you know, hundreds on hundreds of orders before, a lot of times I might only be sending 30 or 40 or 50 orders before, and I can easily place those manually. So your original question, though, I've run on the tangent. I forgot your original question there, Aaron.
Do you use any automation to exit out of if you get filled on, say, 70 positions or something like that?
No, I would just go and do exactly what I did, hedge it. If you had the automated software, and I'm sure, you know, if there's high-frequency traders running these similar strategies, they might just automate out, and maybe they don't hedge it. You know, maybe they can just easily, quickly trade out of those positions because they can send 70 orders. The computer systems can do that. But, you know, I don't like doing that. I like to work out of them because I always feel like I can work the trade better. You know, like I'm figuring... I used to figure, you know, like I made hundreds and thousands of trades. Like, I mean, you know, and, you know, sometimes, you know, some days I would make 1,000 trades. So, you know, I've got a lot of trading experience. So I feel like I can, you know, work out of those trades better just because of my own 17 years of experience. So that's why I do the hedging technique, where I kind of automate in to get those, you know, if I need to, you know, get a lot of orders out there, I will use some automation to do it. And then I would hedge myself by just, you know, selling short or buying the SPY, whatever equivalent, to get myself dollar neutral. And then I can slowly, manually work out of those positions over the course of the next half an hour. So I don't have to be out immediately. The hedge allows me not to have to automate out.
Right. And is that where the remaining 50% of your money might come in from during the rest of the day while exiting out of those positions? You said that
somewhat. Yeah, and if I talked about my trading day, so obviously, I said my trading day starts very early. I'll trade pre-market too. So I think something's mispriced pre-market, I'll buy it. If I think something's mispriced, I'll short it too. It depends, if it's not where my fair value is calculated out, I'm not scared to trade in the pre-market or after hours, if I think something is mispriced. But I would say, like I said, the majority of my money is probably made in the first 5 to 10 minutes, not majority, but 50% at least. And then, maybe some throughout the day. But I'll tell you, at least in the U.S. markets, I know, it's the world markets are all different. Between 11 and 2, I don't even trade at all. 11 p.m., 2 p.m., I call it toxic. Those are your toxic hours, where all you got is high-frequency traders trading with other high-frequency traders, and for the most part, all the inefficiencies that, I'm interested in don't exist. They've been, the high-frequency traders are all over any inefficiency that's happening those hours. So between 11 and 2, or even I would say I've extended that, between 10:30 and 2:30, 10:30 a.m., 2:30 p.m., I usually take an extended lunch. I'll go do some other stuff. Maybe go out for with a friend or do an interview or something. I'm going to do something different. So 11, from 11 to 2, middle of the trading day, there's just not enough inefficiencies for me to extract to be bothered with. So that's kind of my time off in the middle of the day.
Okay, so you come back in at the close. Do you take?
Yeah, it's 2:30, 3 o'clock. Come 99 as a prop firm is pretty much available to the retail guy today. You just got to know where to look for it. But there's closing imbalances, which are your institutional orders that are getting logged in, and they're showing you, like today, for instance, was a great day for closing imbalances. It was the end of the month, and those are often a big day for the close. So the best days for the close and for the open, for that matter, are end of month, end of the quarter, on any rebalancing day where indexes are rebalancing, and on the third Friday, the options expiration. Those are the big days for the openings and the closing. Those are the best days. And today, this was one of the best closes I've seen in a long time, where you actually had a lot of stocks trading with some serious buy imbalances and sell imbalances. One is publicly available and gets publicly advertised to everyone at 3:45. But there's services that actually offer that information ahead of time as well. As early as 2 o'clock, that information starts coming out. So if there's a lot of buyers on the close, it could potentially push the price of the stock higher. If there's a lot of sellers on the close, it could potentially push the price of the stock lower. Why is that? Because traders are going to buy ahead of it or sell ahead of it. So if there's a huge buy imbalance, and for instance today is a great example. It don't always work like this, but it worked well today. In Berkshire Hathaway, which is BRK.B, there was a 700,000 share sell imbalance at the close. And if you bring up the chart of it, it actually shows going from 142.50 in the last minute, that thing falls 2 points in the last minute. That is just pure order flow based. There's no, people, and you'll have news media calling up and saying futures didn't tank that much, but Berkshire did. So if you see after hours, it's already started to bounce back. But that is the advantage of having that order flow information is that you see those closing imbalances, and you can actually trade on that information. It's publicly available. So this huge seller is going to be on the closing print. It could drive down the closing print. Back in the day, that was a slam dunk. Now it's not that easy. I would say 90% of the time those orders will pair off, or they just and pair off. I mean that another institution would come in and say buy the 700,000 shares, or that it just won't move the stock from that event. And, it's just an inefficiency. There, should it trade up 50 cents at the close? No, it shouldn't. It's just trading up because there was a huge buyer at the close pushing the price out. So what I would do is probably
get access to this information that you're talking about. Like, what are some of the services that are available?
I believe some of your retail brokers offer it. And I think Interactive Brokers has. And I'm on a prop firm, so I'm getting this information through my proprietary direct feed. So I'm not trading retail, so I can't speak exactly for each retail trader. But I know Mr. Top Step, he'll probably like the shout out there if he's going to listen to it. But he's got an early feed. Great, Danny Riley there, great guy at Mr. Top Step. He offers it. Rosenblatt Securities offers another one. So there's another one. A place where you can get that information. And it's not expensive. And that's the one thing about me. And I think it keeps me profitable too, is you'll have a trader and they're scared to spend money. You got to spend money to make money. And I probably drop $1,000 a month in information. And you've got it. You can't be scared. You can't be saying, "Whoa, I got to make $12,000 a year to break even." We can't be scared about that. You need that information to make money. And I just think if you're paying $100 a month for an early imbalance feed, and you get one trade off that, it pays for itself. So I've got different some of this stuff comes to me through the platform itself, through the Goldman Sachs platform. But I've also got different scanners and filtering systems that are looking for opportunities. I'm running a NeoVest scanner. I'm running MadScan. I'm running my own proprietary scanners that I've built myself. And I'm not a programmer, but that I've had built for me by other programmers. So I'm scanning the market, looking for information and opportunities to trade. So I'm not just sitting here. I make money off of information. I would say, if I'm really analyzing myself, I'm more of making money on almost all of my strategies, I would say, from information arbitrage, looking, at the information and then extracting, alpha from that information, all publicly available information.
Yeah, right. So just a couple last questions before we close this out. Seeing as you're a market structure guy and the term high frequency trading has been sort of flying around this interview a little bit, one of the things you said to me before we hit the record button was that a lot of people try to blanket HFT as either good or bad, but you sort of have the opinion that that's not really the case, that there's some HFT which is a positive impact for the market, and then there's some which is perhaps predatory. Could you just tell us a little bit about where you stand on the sort of the controversial HFT debate?
Yeah, that's exactly it. You've got to look at the strategy. So there's going to be, and just like in the pit and the bad day, there was always, bad, traders. But the pit, the nice thing about the pit, if you go back into the 90s, the pit would self-police itself. There was somebody, doing some, trying to fool you or doing some different stuff. They're gonna, the pit isn't gonna allow that. The traders can see, who's doing this. They're not gonna trade with that guy anymore. They're gonna take him out back and beat him up. It's a lot different. Where now you have so much everything's anonymous. You don't know these players. You just see their orders out there. But a lot of different strategies there that are trying to trick other traders, and and so that's why you've got to look and really break up. What is the strategy, and is that good or bad for the market? So you can't say, oh, high frequency trading is good for the market, high frequency trading is bad for the market. You got to say what's the strategy, and is that good for the market or bad for the market? And a lot of the high frequency trading market making is definitely beneficial to the market. These 1 cent spreads and stuff. You can argue and this gets a little bit going maybe beyond some of the listeners, but I've argued in the past that maybe we're too reliant on high frequency trading liquidity, where now I would say the majority of your liquidity, so your bids and offers that are out there in the book that will absorb, a sudden, price impact or, event are high frequency traders. So where before, if you look at the floor, you had a lot of different types of traders providing liquidity to the market. Even, me, myself, I said I used to be a high liquidity provider. I'm not anymore. I'm a liquidity taker. So now you're probably very reliant on high-frequency traders for liquidity, and that's one concern for me, is there's no affirmative obligations, so they can just cancel quotes and you get left with a vacuum. It's often what you see during these flash crash events, simply just not enough liquidity in the book to absorb the excess supply that's coming into the market. So, that's, but, if you're going back to your original question, is high frequency trading good or bad for the market? A lot of it's beneficial. The market making aspect is for sure. The stuff where, you get into is the more predatory market making that I don't like, which I talked about the penny jumping earlier, or the off exchange stuff where you have an off exchange market maker leaning on somebody else's quote for protection. I think that just discourages the original liquidity in the first place. I think that's something where, is probably not as helpful as, if that market maker was actually quoting in the lit market. So basically when I'm talking off exchange market making is they don't actually have to provide any bids or offers. They can simply match the bids and offers that are out there. So they're not taking on nearly as much risk. And that's where, I do have a little bit of an issue with that type of market making as well. So I'm not sure that benefits as much as if those participants were quoting in the lit market, the public exchange. But, you look into other things like layering, and layering is a strategy where you put fake orders out there, maybe some sizable orders, trying to, say, okay, well, you see some size, then, other systems might actually sell the stock, thinking, oh, there's some big sellers in the market, way to sell the stock, and, there was a fake order. So, you've heard a lot about layering in the past, and something like that can be automated very easily and probably, very harmful to the market because it's trying to trick other traders into, buying or selling off of information that isn't real. So, that's another example of maybe a strategy that's probably not beneficial for the market. So, but like I said, a lot of the strategies in themselves, the arbitrage is there. It makes the market more efficient. So, for the most part, your high-frequency traders employing arbitrage. It just simply makes the price more efficient. It gets to where it is faster. So that's probably beneficial. A lot of the market making is beneficial besides some of the off-exchange market making or some of this algorithmic penny jumping in the small caps. But for the most part, a lot of the high-frequency trading, strategies, there's probably a lot of really good firms out there doing a lot of good, but they need to crack down on the stuff that's more predatory.
Okay. Awesome answer, Dennis. Thank you very much. One last question. Is there any advice you'd like to leave with anyone listening who might still be learning the ropes today?
Yeah, and obviously, I've traded for a lot of years, and I helped educate the traders at Bright Trading, the new one. So it's those adjustments that you need to make. So if you're trading in a high frequency trading world, which we are, we can't control the environment that we trade in, so we have to adjust to it. The adjustments that I've made to stay profitable, and I think whenever I see other traders that are struggling, when they start to employ some of these adjustments, actually a lot of these traders actually start to turn it around. So number one thing, which I talked about before, is I'm a liquidity taker. I don't provide liquidity. I don't sit my bids out there hoping that the price comes to me, because it often will come to your price, you'll miss your fill, and it'll quickly go the other way. Especially in a small cap stock, it's very dangerous to just have sitting limit orders out there. I say when you have a sitting limit, you're a sitting duck. You're a sitting duck to get picked off by a more informed trader. So I take liquidity as opposed to providing liquidity. On that same note, scalping is no longer a viable strategy. If you're jumping in, trying to make a penny or two on a trade, you're going to just commission yourself to death for one thing. The second thing you're going to do is you're just not going to be able to compete with those high-frequency traders that are co-located or that have a speed advantage for you or a relationship advantage, and you're not going to be able to be profitable with that strategy. So scalping, no longer a viable strategy, not even for some of your automation. So you can say, I'll get automated, I'll scalp. Like I said, I ran an automated scalping system for a lot of years, and it's not profitable anymore either. So I'd say scalping, leave it up to the high-frequency traders. So lengthen your time horizon. Don't think about your trade in seconds or milliseconds. Think about it in minutes are okay. Hours are even better. If you're trading in swing trading environment, days to weeks, there's no competition in there. So because that's, going on, looking at trends and looking at a lot of different things. And we didn't even touch on the technical analysis, but, that's something I employ on my swing trades as well. And there's a lot to that. So, reading a chart from, an intraday perspective and understanding, different levels and, where stocks, tend to have support or resistance or where they're trending, that's all viable still. Just not having that short time frame, that's what'll kill you. Another thing is, don't show your hand. So if you're sitting there and when the way you're trading and you're putting your bid out there and then you're canceling, and you're putting another bid out and you're canceling, there's high frequency trading systems, predatory ones that are going to log that. And they're going to say, hey, we got a fresh one. This guy really wants to buy this stock right now. And they might try to buy it ahead of you and make you pay the most price. So that's why I'm a big fan of just lifting the offer or hitting the bid as quickly as you can. If you're putting a lot of, passive limit orders and trying to work the order, they might figure out what you're doing. And that's going to be used to your disadvantage. And then the other thing is, just remember that obviously you have a big advantage as a human being is that you can change your thinking on a dime. Any automated computer system there has to be programmed in, and they can't adjust on the fly like that. So that's the biggest advantage of being a human is that you can quickly adjust, your thinking or your strategy for the current environment. And, strategies change and, different types of trades work in different types of trading environments. So you have to understand the environment that you're in. When you're a 5-year bull run, the shorts are going to be tougher. When you're in a market that's, for the last year just kind of oscillating, well, range-bound trading is going to work better now. So, that's an advantage, and even looking at different time frames, maybe, the last day or two, we're trending down. Well, I can adjust my strategies on the fly where somebody running an automated system can't adjust as easily.
Great. Awesome advice there, Dennis. And where can listeners go to find out more about you?
Yeah, so I do a radio show every morning for Benzinga. It's called Benzinga's Pre-Market Prep Show. And you can just Google Pre-Market Prep and you'll find us. We're on every morning from 8 a.m. Eastern till 9:30 Eastern. I'm on from 8:05 till 8:55, and then I have to go prepare for my open. So I always get off 35 minutes before the open so I can get all these opening orders out there. Because the one thing I've learned is when you're doing a radio show and you're trading, that doesn't work very well. So, trying to trade and do a live radio show, don't do that. So, Aaron, when you're interviewing traders or doing a live radio show and you're trying to trade at the same time, that's a recipe for disaster because trading takes full concentration. So from 8:05 to 8:55, I don't do a lot of trading. I do the Benzinga radio show, and I'm on there with Joel Alconen, who was my mentor, who I started with back in 1999. And we've got the Benzinga news team, who is great. Benzinga's great. Jason Raznick behind it, and we've got quite a few listeners. So we got an active chat room there where you can come in and chat with us. You ask us questions, and we talk all this stuff. We basically go through what's moving here today, what we see. I try to identify the sectors that I think are going to be strong, sectors that are going to be weak. We're all trying to prepare our traders for the market open. So I'm giving you that information that I'm using in my own trading and trying to help you guys out with your trading as well. Again, sharing all the capital intensive stuff because, like I said, if it's something really small, I'm not going to just hand that out because then I'm just taking money from my own pot. But if something's capital intensive where there's millions of dollars that's a huge trade where there's millions of dollars available and I'm not going to take it all, I can share that stuff. And I don't mind trying to help traders. I've been in it for 17 years here now, so I like to help traders and I like to see traders turn around and succeed.
Absolutely. So where's the best place to find that out? Are we best just Google it, or is there a URL you want to give out?
Yeah, I wish they got a better URL. They haven't. So it's if I just gave you the URL on the Pre-Market Prep Show, it's pre-market, premarket.benzinga.com. And then so you can go there, or you just Google Pre-Market Benzinga Pre-Market Prep. Pre-Market Dennis Dick if you want. You'll find us. So
cool. Well, I'll put a link to that
fairly quickly.
Yeah, I'll put a link to that in the show notes anyway, so that's easy for listeners to find. And you're also on Twitter as well. Do you want to give out your handle?
Yeah, Triple D Trader. So TRIPLE, the letter D, Trader, TRADER. So Triple D Trader, and yeah, I tweet, and I was tweeting a lot about the imbalances here today. I'm one that tweets a little bit at the open, a little bit at the close. I don't tweet that much during the day. I probably tweet 3 or 4 times a day. I'm not a huge tweeter, but I try to, when I tweet something, I try to make it relevant or something important. So I'll tweet when the S&P additions or deletions or something come on, something that's going to be potentially market moving. I try to tweet it out.
Sure. Okay. No, sounds good. All right, Dennis, well, thank you very much for coming on the podcast, man. I really appreciate it, and you've given us a lot to think about. So, yeah, let's definitely stay in touch.
Okay, thanks, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, traders? Aaron Fifield here. For this episode, we have a returning guest, Jack Schwager, who was first on episode number 27. As I'm sure you already know, Jack has been involved with financial markets for many, many years. He's the author of the acclaimed Market Wizards series and others, and he's also the co-founder of Fundseeder. During our talk, we go behind the scenes of the Market Wizards, and Jack shares his experiences from actually conducting the interviews and some of his most memorable moments, which is really interesting. Of course, I asked Jack to flesh out some of the great knowledge he's learned from speaking with high-level traders. In particular, we talk about self-confidence, sacrifices, what separates a profitable trader from a super trader, and the problem with seeking comfort. You'll also hear an update on Fundseeder, some of the really cool things they're doing over there, as well as something you might be very interested to know, and that is what trading books does Jack recommend to others. Now, here's a very special announcement which I want you to jump on. Jack's The New Market Wizards is now available as an audiobook on Amazon. So if you go to chatwithtraders.com/Jack, you can actually get a copy of this for free. So go to chatwithtraders.com/Jack to get The New Market Wizards as a free audiobook. Make sure you check that out. Here we go. Welcome, Jack Schwager, to this week's episode. Jack, welcome back to the podcast for the second time. How's it all going? You doing all right?
Oh, great. Thanks, Aaron.
Thank you very much for coming back on. I mean, it's awesome to be speaking with you again. And at least I don't have a cold this time around, so that's a relief.
I forgot about that.
Yeah, I just remember sounding really horrible during that last interview. But anyway, this one should roll a lot smoother. So to get started, something we didn't talk much about last time, which I think would be interesting to hear about, is the actual making of the Market Wizards books, like almost going behind the scenes of the interviews and hearing about how you chose these traders, how you got access to them, etc. So let's just start right there. How did you select and find which traders you were going to interview for Market Wizards? Because I know, some you interviewed didn't make it into the book, and then there were also some you did interview who nearly didn't quite make the cut. So it'd be interesting to hear how you went about that.
Sure. And to touch on the second part first, the interviews that I didn't include, there were several reasons for those before we talk about the ones I did include. So one reason is that the interview was just a dud. So ultimately, the chapters that I get out of these things have to be, at least to my taste, interesting and have something meaningful to say. But some of these interviews really just were just duds, and so even if the guy was a good trader, but if he just had nothing to say that was particularly helpful or interesting, I didn't use it. There weren't a lot of those, but there were a few of those, across the years, over the different books. So that was one reason why a chapter wouldn't have been included, and another reason was, and this happened I think about once per book. But one of the things I do it for a couple of reasons. Let me tell you what I do. I tell people that I interview that they will get the chapter when I'm finished with it for review. And if they got any real problem with any part of it, then they can suggest a revision. And as long as we can agree on a revision, we'll do that. But ultimately, whatever the final version is, will be a version that they approve. Now, the reason I do that, journalists would not do that, and I can understand the reason why. Typically, they would not do that. I do it for two reasons. I do it, one, to be able to get the interview, to have a higher probability of getting an interview, particularly when there's people who have no real good motivation to even talk to me, or to do the interview and so forth. But secondly, to place people that I interview on a level of comfort. So, otherwise, if what they're saying is going to appear in a book, they're going to be really censoring themselves continually. And that doesn't make for good material. So I want them to know, kind of speak freely. And if you say something that you feel is, hey, you said something you don't want to appear in print for whatever reason, we can work, I won't publish anything unless you approve it. So that's kind of the guarantee or the agreement I make with people. And occasionally they'll actually pull out a sheet and have me sign, make it legal, and have me sign that as an agreement. But that's one thing I do. Now, most of the time, the vast majority of times, that's fine. And in most cases, there aren't any revisions, or the revisions are trivial. And even when the revisions are a little more than trivial, there's nothing that the trader and I can't agree on, and it's still become to an agreed final version. And usually, it's a matter of they want to say something in a way, and then I say, well, that doesn't read very well. It's not very grammatical. How about this? It says the same thing. It's that type of thing back and forth. Sometimes it's they don't want to say something, and I try to say, well, how about if we make it more anonymous in this way? Would that be okay? Or things like that. Sometimes it's a matter of, I had one interview for a trader who invested in emerging markets and did a lot in Russia and spent a lot of time, in Russia, and gave me a whole bunch of kind of lurid details and stuff, and said, after about an hour, he said, of course, you can't use any of this. Kind of feared for his life if I put any of that in the book. So that's an example of why I have this agreement. And now, very rarely, but it has happened, probably an average of maybe once per book, that somebody will say you can't use the interview for for different reasons, and so that's another reason why an interview wouldn't appear. Okay, so now the vast majority of ones that do appear, that I do, there's a high, I'd say the percentage of interviews that, if I go to the trouble of doing an interview and editing it all out. There's another example of an interview, why I wouldn't include an interview. I've had the circumstance of interviewing a trader who had a really, really good track record, and the interview itself was actually quite interesting and had stuff to say. But in the interim, the trader sort of, without going into any names here, I can think of at least one case where this happened. The trader had a risk management philosophy that he had gone through, which made a lot of sense. But clearly, in real life, between the point of doing the interview and before the book got finished, he actually violated his own rules to the point of really damaging his performance significantly, to the degree that, had that been the full track record at the time, I wouldn't have done the interview. So even though the chapter was fine and the stuff it said was good, because of that, I decided not to use it. That probably happened a couple of times. So that's a variety of examples of why interviews didn't end up in the book. As far as the majority, like 90% that do end up in the book, and as I started to say, if I go through the trouble of often traveling, in most cases the interviews require traveling to some location, and it could be a foreign country for that matter, and spending the time and doing the interview and spending the weeks of distilling the interview down from what might be 100, if transcribed fully. I actually work off the audio tapes, but if you transcribed it, in many cases the rough draft could be, or not the rough draft, not the draft, but the transcript would, if it was transcribed, could be as much as 100 to 200 pages by itself. So if I distill it down to 20 pages for all the work that involves, I'm going to be pretty reluctant not to use it. So it has to have to be a good reason to use it. So over 90% of the time, if I get that far, I'll use the chapter. Now, how do I find these people? How did I decide who to interview? The first book that I may as well start with Market Wizards, the very first one. I actually knew some great traders personally, and I asked them directly. So, for example, traders like Michael Marcus or Bruce Kovner of Caxton. I knew them directly. In fact, I had worked at Commodities Corporation where they were like stars at, and so I knew of their track records and of their great skill, and that they were perfect candidates for interviews and so forth. And so some of the interviews in that first book came from that. Then there were some traders I just didn't know personally, but kind of knew of, like Jim Rogers or Michael Steinhardt. People who had kind of notoriety. I mean, in being known to have done extremely well in markets, and were the type of people who would be quite worthwhile to do interviews with. And then I, for doing some research of people who had done well, and networking was always a big deal. So you kind of call the people and who. I'm doing this book on great traders. Who should I interview? And also, the traders themselves were a source of other traders. So, for example, let's take Michael Marcus, who was chapter 1 of Market Wizards, the first book. He, even though I knew him and he was a friend, he was very reluctant to do the book because he's a very private person. I don't know if he ever did another interview. I don't think he's ever appeared anywhere. I'm sure nobody would have known who he existed if I didn't do the book. Although he's one of the great traders, probably one of the great traders of modern times. I got him to do the interview, not completely on my own. It was a mutual friend that we both knew from Commodities Corp who interceded on my behalf and finally pushed Michael to the degree of doing a book. And so he had a degree of reluctance because of this great privacy. He's a very shy person on a certain level. So I flew out to California, specifically Malibu is where he lived, to interview Michael, and spent the day. Actually, I spent the day and night there. But during the day when we did the interview, we did it, throughout the whole day, kind of tape. I had the tape recorder running, and was on the beach, sitting outside during meals. Anyway, during this whole day of interviewing him and the dinner, which he had a private chef that worked for him that cooked the dinner and stuff. So when he's finished eating, he kind of pushes his chair back and he says, and remember, he's been very reluctant to do this interview. He said, this wasn't bad. It was actually kind of a cathartic experience because he sort of went through all his experiences, and particularly we talked in great detail about his multiple failures and several times in his early career when he completely blew out. And that's what he was referring to by talking about as being a cathartic experience. And he said, this was really not bad. Who you should talk to. And then he gives me a trader who I had never heard of, but who he termed the best trader that he knew. And this was kind of his protege when he was an early trader, a starting trader. And that person was Ed Sakota. So he asked if I would be interested in interviewing Ed. And hey, here's a guy who I know has turned a $30,000 account into $80 million. Tell me about the best trader he knows. So I said, sure. So he got Ed on the phone, and Ed was in Lake Tahoe at the time. And I spoke to Ed and asked if he told him what I was doing, and Ed was amenable. And I said, well, I was going to fly back to New York, but I can change my flight and go out to, and I can fly out to Tahoe instead. So that's what I did. And so right after I was finished with Mark, I had no idea existed. And thereafter, I would make it a standard question after I was finished interviewing somebody I interviewed, saying, hey, by the way, who do you know who might be a good candidate for the book? So that question led to a number of other traders as well. And in other books, there were a point in time where I was an allocator. I had worked in an allocating role, and I would know other allocators and would call them. And again, this is part of networking, and ask them who do they know who's really worthwhile talking to and who's good. And so that's generally the way I did it.
Sure. Okay. No, that's really interesting, Jack. Thank you very much for sharing that with us.
Sure. So that's the background story. That's not in the books.
So you mentioned something interesting in your answer there, and you said that a lot of these traders didn't even really have a motive to speak with you, like they had no real incentive to speak with you. Why do you think they did say yes and did agree to do the interview? Do you think it was the fact that they really did want to just sort of pass on their knowledge and sort of pay it forward in some way? Or what do you think led them to actually agreeing to do an interview?
Yeah, I think the motives were different. And in some cases, I don't even know what the motives might have been. But for example, a good example would be Bruce Kovner. I don't think I'm mistaken, but I believe the Market Wizards interview of Bruce is may well be the only interview on the record about Bruce. And he was also kind of a real private person and shunned publicity to a very high degree. And when I sat down to interview him, almost the first thing out of his mouth, maybe it was the first thing, he said, "You're probably wondering why I agreed to do this interview." And he said, and he kind of told me, I didn't ask him, this is something he volunteered. And he said, so there've been a lot of stuff appearing about me in the press, and a lot of it's inaccurate. And I figured if there's going to be publicity I can't avoid, I might as well have one thing that I trust that's on the record, that is accurate. So he knew me and basically trusted me, I guess. And he knew that what I would do would at least be an honest depiction of what the true story was. So that's why he figured he'd do the one interview for me, and anybody else was interested, he could refer them to my chapter. But he'd rather have that out and something which he had some control of, because he knew that what he said I would not distort, and that was his motivation. Somebody like Marty Schwartz, I believe, if I remember correctly, he agreed to it because he thought his parents would get a real kick out of seeing him in a book, and I think he did it for that reason. And different people had different reasons. Once I get around to the later, like something like hedge fund market wizards, at that point, I'm actually interviewing people more than 20 years after the original books, and I'm interviewing hedge fund managers that actually started out in the business in quite a number of cases. They started out where the original market wizards might have been one of the first books they read on trading, and in quite a number of cases was very influential. So there it was a matter of, I don't know what the right word to use here is, respect or whatever, I don't know, or maybe thanks, or just the fact that they had gotten some meaningful stuff and their career was influenced in a favorable way by information they pulled out of my first two wizard books. And so when I was asking them to do it, whether they had a motivation or not, I think they felt, well, they might as maybe a little bit of an obligation to say okay, because here's the guy who did the book that kind of influenced them. So I think in the latter book, the Hedge Fund Market Wizards, that helped. That was a motivation, at least in a number of traders that I interviewed. So that's an example of some of the range of motivation. Now, of course, you do have also traders who are still managing money, and in those cases, there is a potential self-interest, of course, because if they're not close to investment, then being in a book would help raise assets, and so there's a clear benefit there. But in many cases, the people I interviewed did not manage outside money, or if they did, they were not open to taking any additional outside money. So there was no real monetary reason for them to speak to me.
Okay, sure. So you said earlier on that you would fly out to these traders, sometimes at their home, sometimes at their office, wherever that may be, and you'd typically spend, a good part of the day with them. You just have the tape recorder rolling as you're there. How much preparation did you do before sort of showing up to meet with these traders? Or did you do very little preparation, just kind of learn about them while you were there on site to some extent?
Yeah, good question. I did some preparation, so I would know what areas to focus my questions on. So I would, there was no Google when I did the first book or two. I don't know how much. It was early in the first two books. I'm not sure how much information I was able to glean, but whatever I could get, if there was anything in the press or anything I could find. Or if it was a manager that was managing money, I would get whatever materials they would provide to investors. In many cases, though, there might not have been anything available. But where there was some information, I would try to get that. I wasn't trying to do deep research or anything like that, but just enough so I knew a bit about the trader, and just as an aid to having a conversation, asking questions. And also, to decide whether to interview somebody, I had to do some amount of research just to decide, hey, is this somebody that I want to interview? So I did that much. Even if there was a ton of information available, I still wouldn't have gone through it because I didn't want to be over-prepared because I wanted there to be a degree of spontaneity to it as well. And one of the tricks I did, for any people listening out there who are on the interviewing side, who may find themselves doing interviews themselves, I'll throw out this tip because this is something that I did that I think worked well for me at least. Is I didn't go in, and I think a lot of people do. What I didn't do is what I think a lot of people do, is that I didn't go in with a set of questions, because when you do that, you'll end up with something you'll end up with something that sounds too prepared, too stale, and you'll also fall trap to wanting to ask your next question and not really listening to what the person is saying, going from there. So my technique, which I personally think worked quite well, at least I was happy with it, was to go in and to have a conversation and to see and let it go where it went. Now, I actually had, when I did from the very first book, I had a stack of index cards with a question on each index card. Now, what I did with that is I didn't pull it out, I didn't use it, but when I was finished with the interview, I said, hey, that was great. I had some questions that I prepared ahead of time just in case to make sure I got everything. Mind if let me just flip through these cards and see if I missed anything. And then I would go through, and it would turn out that probably 95% of the cards I had touched upon one way or the other anyway. And there would only be very few questions, and pretty often nothing much that came out of that part of it. The advantage of doing it the way I did is that you don't have every chapter sounding the same. You don't have it sounding like it was like too rehearsed, and you can get much more spontaneity. And if you're listening to what the person says, the most interesting stuff can come out as stuff that you hadn't prepared wouldn't have prepared a question on, but somebody says something, and that can lead to a line of questioning that leads to interesting stuff. So that was the approach I used, and that approach, by definition, you don't want to be overly prepared for.
So while you are talking about questions, did you have, I don't know how many interviews you've done exactly. I presume it's probably somewhere around about 80, but regardless, did you have a favorite question that you like to ask the traders you interviewed?
Yeah, my favorite question probably is, I have no trouble coming up with it. My favorite question was what trades or trading experiences were the most painful in your career? Now, it may have been exactly those words, but he was trying to get them to talk about their failures. So that was always, now, the reason I was interested in that question is, one, the best stories that I got in all the books were always, I think almost always, an answer to that question. I got some great stories out of that question. So I'd have to say that was my favorite for that reason alone. But also, it's the failures that formed these people and led to lessons that were quite valuable and ultimately shaped the way they evolved as traders. So it was useful on that score as well. But that question was probably the most useful that I asked.
Okay. So I'd like to ask you, Jack, with these traders, who was perhaps the hardest trader to land an interview with? Like, who took the most persistence and perseverance to get time to even sit down and speak with?
Quite a number were difficult. But one trader that was both difficult to get and didn't want to do the interview and was a very, very difficult circumstance to do the interview, the one that stands out there. And this could have been an answer to your question, actually, the previous question, that is. And that is, what stands out. So this one I kind of remember very clearly was Tom Baldwin. Now, Tom Baldwin, when I interviewed him, was, I believe he may have been the largest trader in a T-bond pit. So we're talking T-bond futures, or at least certainly one of the largest. And so T-bond futures is a really super liquid market. You've got brokers there representing large institutions like Goldman Sachs and the like, and yet Baldwin is trading size that is of the same order. And this is a guy who, if I remember correctly, was working in a supermarket at some point, So, hey, that's a good story. But now Baldwin didn't really want to do the interview. There was another trader I interviewed, Brian Gelber, who was friends with Baldwin and sort of, I think, interceded on my part and got Baldwin to agree. So Baldwin agreed to do it, but he wasn't particularly eager. Now, my bad luck was that the interview was on St. Patrick's Day in Chicago. And I interviewed, I came in and Baldwin, keep in mind, didn't want to do the interview. And he's kind of finished with the trading day. And he goes back to his office, which is where I met him. And so there I am. And his buddies are coming in, and then they'll leave, and they're going down to the bar, and they say, "Tom, you coming?" He said, "I got to do this thing, but I'll be there soon." So here, he doesn't want to do it to begin with. His buddies are waiting at the bar. It's St. Patrick's Day. This was a tough interview for me. I knew that the minute I hesitated, I'd lose him. So that was an interview where I couldn't really think. As soon as he stopped talking, whatever, I just had to have another question. Right, I couldn't allow a split second to go between his response and my next question. And this went on for about a half an hour in sort of like bullet fashion. And then there was like, he said something and I was like hesitated for like, maybe it was a second and a half. He said, "Gotta go." He was gone, and so that was a tough interview because not only didn't he want to do it, but he continually didn't want to do it while he was doing it, and he had motivation to leave. So that one stands out in that respect. Then there was another interview that was really, really, really difficult. Was another great, and also a T-bond trader was Gary Bielfeld, who trying to remember what the name now. I can't remember. I think it was BLH. I think BLH was the company. I forget the letters. It was probably BLH. It might have been different, but I kept on hearing whenever. And I was back in those days as a research director, and you hear you put out summaries on different markets, or my analysts would put out summaries of different markets, and something. And or there was also the hotline. This is back in the days where analysts would have, maybe they still do, I don't know. There would be like hotlines to the offices, and they would like get on and say, and they would have information like so-and-so's buying and selling and stuff like that. Of course, that part of it's no longer relevant because there's no floor anymore. But this is back in the days where there were floors, and you would get those type of comments. And I kept on hearing when it was T-bonds, about BLH as a buyer, BLH as a seller. Now, some of the firms, like Morgan or Goldman Sachs or whatever, but who the hell is BLH? And when I was doing it, I dug around and I found out that BLH is one guy in Peoria. So that's interesting. And so it turned out that Bielefeld started in the business trading literally 1 or 2 quant contracts. And he did well, and he built that up, and he pyramided. And he went from that level, then he found the bond market, and he grew in that. And by the time I interviewed him, he was trading enormous size, thousands of contracts probably in the bond market, from a guy who started out with single and 1 and 2 contracts. So that was a great story. I mean, that is such a great story, So I went to Peoria, and it was a little town, and he was in this little 2-story office, 2-story building, and an old-style office, and I did the interview. Now, the best way I can describe what Bielefeld was like is for those listeners who at least familiar with old movies to the degree if they know Gary Cooper or some of the roles that he played, he would be like, often his roles would be a man of few words and very, very tight-lipped and just very stern and stuff like that. And so Bielefeld would constantly be giving these like 1 and 2 word or 1 sentence answers, and really tough to get him to say anything interesting. And finally, at some point, I asked him a question, and he said, well, I'll answer that, but turn off the tape recorder. So I turn off the tape recorder, and he gives me this analogy about trading and poker, I believe it was. And the analogy had to do with probabilities and risk and so forth. And it was a good analogy, and it was probably the first thing that he said that was of any interest. And I said, why didn't you want that? Why don't you want that? What about that? Do you need it off the record? And he said, well, I don't want to give people the impression that trading is gambling and stuff. I said, well, it's not. You're making this clear. So I finally convinced him to let me keep that in, which is really probably the only thing in the interview that's of interest. In any case, I ended up with very little usable material. But the story of a guy that starts out trading 1 and 2 contracts and ends up trading thousands of bond contracts, who's in Peoria, was just a good story. So that chapter is the only chapter where my narrative section is longer than the interview section, I believe. Of course, in the typical chapter, the narrative section is relatively short compared to the interview section. The narrative section might run anywhere from 2, 3, 4, 5 pages, whereas the interviews could be 20, 30, 40, 50, whatever, depends on the interview. But that case, the narrative section was longer, I think, than the interview section. So that was another interview that was particularly difficult to do.
Right. Just before we move on to a different subject here, I'd like to ask you one last question, about the whole Market Wizards series. Are there any traders who you would like to interview, but to date haven't had the opportunity or in the past have declined an interview?
Oh, sure. There are a couple that pop into my mind, and it was not for lack of trying. So if there's any trader that should have been in the Market Wizards books, and it's through no fault of my own that they're not, is George Soros. George Soros and Druckenmiller, who was a phenomenal trader. Druckenmiller's record is unbelievable. This is a guy who probably has a record around 30, 40 years, average probably in his own fund 30% compounded. Just probably one of the best, just a staggeringly good record. One of the best ever assembled by anybody. And Druckenmiller says of George Soros that George Soros is the best trader that ever lived. And he probably may be right on that. So Soros, and he worked for Soros, by the way, so he knows, he very well knows. Soros I never spoke to Soros myself. I tried to get him through his organization, but I just could never get through to Soros, and I never got a positive answer, an agreement to do the interview. And ironically, Soros has done some other interviews. I have no idea why he never agreed to speak to me. but he didn't. That's kind of one of my regrets, is that I never got to interview Soros, because I think that would have been a great interview and certainly a valuable one. And he had so many experiences in his lifetime that I would have liked to have gone into. Not all about trading. I mean, besides his from his early childhood days of escaping from Europe and during World War II, and to his interceding in the breakup when the Soviet Union broke up, and he tried to bring democracy and capitalism to that part of the world, and his experiences doing that. So there were a lot of things that I could have and would have been interested in talking to him about, but like I said, I could never get to Soros, and that's unfortunate. And ironically, I mean, I've read, I have read, he's written a number of books, but I only read one. But I oddly enough, I never found Soros to be a particularly good writer, to say the least. And I kind of felt that I could have done a better job writing his own ideas than he did himself. But in any case, I never got the opportunity. Another trader that wouldn't speak to me, although I did get to speak to directly, was Jim Simmons of Renaissance. And Renaissance may well have the best track record ever, or certainly one of the best ever. Maybe if they're not the best, it's tough to say who would be better. And Renaissance, the other problem was it's a very secretive, it's a quantitative firm, and a lot of your listeners may know, but Jim's a mathematician. He hired a bunch of brilliant mathematicians, and that's their approach. I knew it would be difficult to do the interview anyway, because they would be guarding their secrets and all that. And I tried to convey that to Jim that, hey, when you do this, I'm not looking for trade secrets and stuff like that, and I'll let you see the stuff. And one time I got him to think about it for 2 weeks, but he ultimately decided not to do it. So those are two, what I would consider exceptionally great, maybe all-time great traders that were not in the books, because I could not get them to agree.
Yeah. I imagine an interview with Jim Simmons would have been incredible. That would have been really, really interesting.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Anyway, so let's move on. Let's talk a little bit about some of the insight that you've gained from interviewing all these some of the best traders that are around from our time. So one thing that always interests me, and I always really fascinated by where their head was at, what's like, get inside their mindset and their self-belief. Did you find that the traders you interviewed anticipated that they would become hugely successful, like right from the very beginning? Did they always have that self-belief and that confidence that they would become, I guess we could call them market wizards?
No, I think some did. Some did. Like somebody like Michael Platt of Btcusd. I think he was successful almost from the beginning and always did well and had this tremendous confidence, and started trading actually when he was in high school age, which is actually a common denominator in a lot of traders. So there were so there were some traders that fall into that category. So yeah, some did, but there were quite a number of traders that really in their early days, early years even sometimes, did not do well. And it was only their persistence that ultimately paid off. So, but even then, they kind of still believed that they could do it. So they just, even though they met with significant failures early on, they still had some degree of confidence and persistence to at least keep at it. So, so I think it's a mixed bag whether they thought that way from the beginning or not. But after certainly a few years or so, they did reach levels where they had a high degree of confidence in their approaches, and that was indeed one of the traits that I pulled out that was a common denominator in most of the people I interviewed.
Okay, yeah. Now, something that is often common amongst those who are very successful in life and any walk of life, whether that's trading or something else, is that they've often made pretty significant sacrifices to get to where they are. Can you think of any examples of great sacrifices made by some of the wizards that enabled them to succeed in trading?
I don't know if it's sacrifices. Basically, they, in a case somebody like Marcus we spoke about, he kind of lost all his money more than one time. So I don't know if that's a sacrifice, but that was part of the process. That was that his case. But I don't know. Oh well, talk about sacrifice. I mean, to some extent, people sacrifice the rest of their lives to become great traders. In terms of that, trading becomes so all-consuming and time-consuming that it almost crowds out the rest of their lives. So that was a theme that occurred for a number of traders, because they tend to be, as a group, they tend to be very hard workers, and they tend to be almost obsessive sometimes. So that you can consider that a sacrifice. The most extreme case I ever came across was John Bender. Unfortunately, died at a very early age. But Bender was a brilliant trader, an options trader. And when I interviewed him, he was basically he considered his primary market, he considered Japanese options, which he stayed up at night to trade. And then he would typically almost always stay up for the European session and trade options there, and quite frequently continue on and then trade the US session. So he had his more often than not, he'd be up 20 hours a day trading. I would say that may have been part of his success, that he was so focused and so intense in the markets, but it's not what I would recommend as a lifestyle.
Right. Yeah, that's really full on. Wow. 20 hours a day trading. That's solid effort. So would you say that most of these traders who did appear in the Market Wizards lacked, a work-life balance to some extent?
Well, yeah, I think that's true to some. I think a number of them would fall into that category, because they're. In fact, I didn't get that on my own so much, but my wife, over the years, had met a number of the people I had interviewed, a number of the market wizards, and at one point, she said to me, "Jack, do you realize that all these people you interview are obsessive?" And I said, I never thought about it that way. But when I thought about it and then became aware of it, that was true. So part of what goes with that obsessive personality is it does crowd out a lot of the rest of life to the extent where trading becomes a real focus. And there's so many examples of people who just well, we talked about Druckenmiller, okay? I don't know, he did a lot of stuff, but when I was interviewing him, was a little post that point, but he had just come off of a period where he'd been managing seven funds for Dreyfus, plus his own fund, which he had been managing all along. So that's 8 funds. Now and for Dreyfus, we're talking about funds that have quarterly meetings and staff and everything else. and just think about, I mean, the level of immense work and obsessiveness to do something like that. It's crazy. I mean, managing one fund is a big deal, but to be managing 8 different funds, I mean, it's unbelievable, and it's incredible he was able to do it, and he did it well. I mean, he did it very well. He ultimately gave that part of it up when he joined Soros, but then he was managing Soros. He was managing the Quantum Fund and managing his own fund. So that gives you kind of a flavor. I talked about Bender. David Shaw. Here's a guy who runs it, and for those who don't know, D.E. Shaw is kind of like a Renaissance type of operation. So David was a brilliant computer scientist. He was actually one of the first developers of supercomputers, and when he did his hedge fund, he would basically be hiring the smartest physicists, mathematicians in the country to work at D.E. Shaw. And so he's managing this group of, I don't know, it's 50 or 100 brilliant guys and women, just brilliant quants, and in this extraordinarily complex approach. Now, he wouldn't get into real details, but I knew enough about it that they were trading virtually every liquid market in the world, and they were trading all different relationships, and they were using scores of different mathematical models, all operating simultaneously. So it's just an immensely complex approach. You'd think that's enough for anybody, but on top of that, within D.E. Shaw, he had this operation of starting new companies, and a number of companies were spun out of D.E. Shaw. And in fact, one interesting side bit is the most famous company was not directly that the founder left D.E. Shaw, but he worked for David Shaw, was Bezos, who started Amazon, of course, and that was incubated within D.E. Shaw. So, and then he left with David's blessing to start Amazon, but he had that side of it, and then he at the time he was also this is back when Clinton was president. He was on the President's Council for Education and Science, science education, and would be flying to Washington for that a number of times. And what else? Then he had this hobby where he became intrigued about the idea of using computers to design drugs, and there's a whole separate field that's involved in this, and he became very intensely interested into it, was reading all the academic literature, got involved with 2 specific companies that were doing this, ultimately left the hedge fund world to focus on this totally, but while he was a hedge fund manager, he was doing that. I don't know I don't know where he got enough time to do everything, but that clearly should tell you there wasn't really time to do anything else. And it also gives you a feel for the type of almost obsessive nature of these market wizards in terms of all the stuff they can do, and it got to be at the sacrifice of leisure time and stuff like that.
No doubt. Wow. Now that was a really interesting answer, Jack. Thanks very much for sharing that. Here's one question I'd really like to ask you. What do you think is the difference between a trader who reaches a point where they might make, let's say, something around, mid 6 figures a year, okay? So they're a profitable trader, they're consistency, they're doing well, they're comfortable, right? What's the difference between a trader like that and a super trader? So someone has the ability to pull, I don't know, $10 million a year out of the market year after year. Someone who becomes a super trader. What's the difference between those two traders?
So part of it is a level of skill, So you take any endeavor, could be a sports. There's only going to be so many top tennis players in the world, and there could be some very good players, but then they may not be in the top 10. They may, they might be the 200th best tennis player in the world. Hey, that's pretty impressive still. but there's only a certain amount that have a skill level to get to a certain point, or maybe the combination of skill level and a certain intensity. But I do believe there's a level of innate talent that only certain people possess. So that's one thing. Somebody like Ed Sakota would tell you that his famous line out of my interview with him was, "Everybody gets what they want out of the markets." And this subject sort of came up. And I said to him at the time, "Well, wait a minute. You mean that people who lose in the markets want to lose, or people who don't fully succeed don't want?" And he just repeated, "Everybody gets what they want out of the markets." And he did tell me a story about like a friend of his whose father was not successful, and this friend of his would always get up to a certain level and then blow it. And in kind of an Ed's opinion, he felt that it was because his friend didn't want to eclipse his father. He felt a certain guilt about that, and sort of would, at some level, self-sabotage, not consciously, but on some subconscious level. And I believe that's probably true to a certain level. I think that really is true. That what people, it's not so obvious. Not everybody, they may not always want to succeed fully in the markets or have it be all-encompassing, because that implies other things that maybe they don't want at a certain level. And so that's another explanation of what may differentiate one from the other. But there can only be so many, and I mean by so many, I mean some small amount of traders that really excel to a incredible level. And like any endeavor, there's only a certain amount of people who might have that skill level.
It's a really interesting concept. So, I mean, my next question was going to be, why do you believe so many traders fail? So if you go with Ed Sakota's concept, do you think...
Well, no, the answer that I wouldn't answer that question the same way. I think most cases, most traders fail because of mistakes. And they fail because they do the opposite of what the general advice one would glean from the various market wisdom books. So, and the most common failure would be they don't pay enough attention to risk management, and they're too worried about developing just a method or figuring out when to get into the markets. They really haven't worked out well enough where to get out, or how to prevent individual trades from causing damage, or how to preserve capital, those type of things. So if you ask me why do most traders fail, that would be probably the primary reason would be a lack of an adequate money management process. And also to be a lot of times, not everybody, I think only a minority of people will succeed in the markets, and it can't be any other way. Well, especially if we're talking about zero-sum game markets like futures or whatever, you can't have the majority win almost by definition. But I think that the markets are very, very difficult, and unless you have an edge, there's no reason why you should win. And here, to quote Bill Eckhart, and this is actually, to me, is one of the great quotes that came out of the books. And his quote was, and I'm paraphrasing a little bit, but it's pretty close to this, that human nature is so poorly attuned to trading that most people will do worse than random. Now, the key here is worse than random. So he's not merely saying that people will lose because they don't have an edge and they're paying transaction costs, so they have a less than 50-50 result. He's saying something even stronger. He's saying that the natural inclination people will have, the types of trades they will want to do, the actions they will want to take in the markets are going to be the types of decisions that would be worse than if they flipped a coin to make a decision. So his argument is that we as humans have evolved with characteristics that are not only poorly suited to trading, but are adversely suited to trading. And the way he would put it is because we as humans have evolved to seek comfort. And seeking comfort will lead to the decisions that are wrong decisions. So examples of seeking comfort are, let's say you're in a losing position and the trade is not done what you thought it should do. It's probably wrong. You think you probably made a mistake, but you're in the hole for quite a bit. Maybe you've already lost the money. If you get out now, you'll just cement it. Maybe you'll give it another 2 days, and you'll get out in 2 days if it doesn't bounce back. But if it does bounce back, maybe you can salvage the trade. And once you make that decision, or once somebody makes that decision, they feel better because they've got hope now. The trade isn't a locked-in loss yet. They've got the next 2 days, and if it bounces back, maybe that loss will come back. Maybe they'll even get ahead. But that feels comforting. But that's a bad decision, an example of a bad decision. That's a decision which gives comfort, but it's the wrong decision. So that's just one example of, and I give you lots of examples probably, but that's an example of the type of trading decision people make because it's comfortable, but it's a bad type of decision. And that's an example of what Eckhарт's talking about. So to go to your original question, why people lose, well, they lose because they have no edge, and moreover, if they don't have an edge, their human nature is going to put them in a position where they're likely to lose because they're going to want to make decisions which are just wrong from a trading perspective.
Okay, I like that answer, and I really like that quote as well that you shared. That was brilliant. Okay, so just before we move off this subject here, is there anything you've observed? Is there anything you've observed that's one of the hardest things for a trader to learn that can really only be learned from experience?
I think money management is very simple conceptually, but it goes counter to the human nature we talked about. And so I think for most traders, they only learn about that because they take early losses, myself included, and certainly true of a lot of the people I interviewed. So I think you almost need the market to teach you that lesson in many cases. There are a few traders who probably come in with that skill from the beginning, but a lot of traders had to learn it, and that's a difficult thing to learn. To develop a methodology that works. I mean that's not instantaneous. That can take years for people to actually end up with an approach that has an edge, which may be quite different from what they started out with.
Yeah, I think many listening to this podcast right now will second you on that, and I, for one, also do as well, so that's for sure. Now, Fund Seeder, I asked you about this last time you were on, Jack, but I understand there's been some pretty big changes since then, so would you be able to give us just a quick overview of Fund Seeder in case anyone missed the interview last time you were on the podcast here, and also run us through some of the new updates and features that might be interesting to listeners?
Sure. So first, to define what Fund Seeder is for your listeners who are not familiar. So the concept of Fund Seeder is to create a central website where traders worldwide, regardless of their background, regardless of who they know, obviously, can go on and link their accounts to Fund Seeder. And in that process, they're linking their account via the brokers, and in that process, create a verified track record of daily returns. So on one level, it makes it possible for somebody who's a skilled trader anywhere in the world to get their account up there and to have it verified, because again, the results are coming not from the trader, but the results are coming via the broker. We're getting the results directly from downloads from the broker. So that's kind of a nice feature. Now, once you do that, that trader creating a verified track record then has the opportunity to get noticed, and because of that, then to have an opportunity to ultimately, if they're good, to have an opportunity to manage assets. which would, for many of these traders, if not almost the vast majority, would not be a possibility. So you take a trader who's, let's say, well, not necessarily they could be anywhere. They could be in Eastern Europe. They could be in the Far East. They could be in South America. They could be anywhere. But you can have people who are successful as traders in any of these locations, but they have no network, no access. They haven't gone to an Ivy League school. There's no way in the world they could be a great trader, but they have no way in the world they'll ever get an opportunity to manage money. Now, by getting their track records verified, and if they're good, they have the possibility of getting discovered, and ultimately, whether Fundseeder, now I should make it clear at this point, Fundseeder is two companies. There's Fundseeder Technologies, or Fundseeder for short, which is this is the thing we've concentrated on, which is the product for traders, which is the website for traders and so forth. There's also Fundseeder Investments, which right now is more or less of a landing page. But Fundseeder Investments is the entity which has the registrations and everything else. But Fundseeder Investments will use the Fundseeder database to find undiscovered trading talent, and then to either take those traders and put them together in an emerging manager fund, or to, in some cases, maybe shape a fund around those traders, or in some cases introduce those traders to investors looking for emerging, undiscovered trading talent. So there's going to be that potential. So therefore, when you put it all together, what you have is Fundseeder sitting in the middle as a link between undiscovered traders. It could be discovered traders. It could be traders already managing money. We're not excluding anybody. But the real intent was to give traders who would have no access, who have skill, to prove it. And so connecting those traders ultimately with investors who have an interest in allocating to new traders and emerging talent, and getting away from the model where you have a small number of firms and entities curating the process and directing investor assets into the same small number of large funds managing billions dollar plus, and leaving the vast majority of traders, regardless of their skill level, out nowhere. So that's what the goal and function of Fundseeder is. Now, as part of that process, we've created a platform where traders not only get verified track records, but can do neat stuff like, well, at its most simple form, you can actually get a chart of your daily equity, which is very useful. So, in fact, I've often advised that one of the things people should do is plot their equity. Unfortunately, brokerage firms, as far as I know, don't provide this, and I don't know if any other software that gives you this opportunity. So this is a way of creating equity chart, daily equity chart, which can then be very instructive. You can kind of visually see if you're starting to go into retracement. Now, having done that, we then also have all sorts of chart and analytical tools which you can apply to that equity curve. So you can create underwater charts, which will show you every time you've gone into a drawdown. You can create rolling indicator charts, like let's say you want to know what's my rolling 3-month return at the end of every day going through time, or my rolling Sharpe ratio, or anything else. You could do stuff like apply technical analysis to your equity curve and see if you got out of your trading when you had, let's say, a trend reversal, and got back in when the trend turned back up. Would that be a good strategy? Would that improve your performance? Things of that. So you got all sorts of tools, analytical tools, on there for traders. All of this is basically free, not because we're just want to be a gift to the trading world. We have our own self-interest, but our self-interest is that we believe if we find a lot of good traders that are just undiscovered, so to speak, and we can create fund products through Fundseeder Investments that will allocate to these traders, that we will then benefit monetarily from Fundseeder Investment side. So we're kind of doing good for traders, but we also do, quite frankly, obviously have our self-interests involved as well. But what you do create here is a model where the investors seeking undiscovered trading talent and traders who have that skill level have an opportunity to get connected through the dual fund seeder companies. And you asked me at the beginning what's changed. Well, when we first spoke, I think fund seeder had just started, so we had the concept. And like any startup, anybody out there who's ever been involved in a startup will certainly be able to relate to this, because I think it's probably true of every single startup that ever existed, is that whatever you start up, however you start out, it's not going to be how you're going to end up. You're going to go through changes. Certain things will work, certain things will not work. You'll see mistakes, you'll see improvements, et cetera, et cetera. Now, we had started out at the time we did our interview, I think we were just very early on. The basic concept has been there all along and remains there. That hasn't changed. But we started out by partnering with another firm which had developed a platform that created equity curves and did analysis and so forth. And we had white labeled their stuff. Now, I was never enamored about going into the details with the particular software. I wanted to do everything differently. I thought everything could be done better. And so if people go on to FundSeeder right now, what they're seeing is more what my vision is of how the analysis and tools should look like, because it reflects what I've kind of worked with our technology team. By the way, our technology team is in the Ukraine. Work with them in terms of designing the indicators and what should be in there, what should not be in there, how they should be displayed, and all of that. So anybody who's familiar with FundSeeder in the very early days and went on now, they wouldn't recognize the platform. It's because the old platform is totally gone. We've actually, I would think I'm safe to say we've replaced it 100%. But if it's not 100%, it's 99.9. Maybe there's some remnants that are there, but the whole look and everything about it is different. So that's been the big change that has occurred, is the platform itself, the tools, and the other big change is there was a very small amount of brokers that could be linked. We're in the process now of building that out. So there's a lot more brokers that can be linked now, and as we go through time, that's one of our main objectives, is to get as many main brokers linkable to FundSeeder as possible. One of the difficulties, of course, different brokers have different processes, and from a programming standpoint, you can't use the same program to link all brokers. You've got to customize a lot. So that's one problem. The other problem is you have to get brokers to agree to cooperate with you. As we get larger, that will get easier and easier. But we've made good strides on that score. So there are a lot of avenues now that traders can get and link their account through different brokers. And the third big thing that's changed is for those traders who have brokers who are not yet linked to, or can be linked directly to FundSeeder, we've created the ability to upload your own data to FundSeeder. We have a template. All you got to do is have an Excel sheet, copy and paste it into our template, upload it, and then you get like I was talking about, the equity curves and all the analytical tools. You can get all of that by uploading your own data. Now, that is not going to be verified, so that data will be labeled unverified, and it will not be eligible for the leaderboard that's on the site, for example. But you'll be able to use all the same analytics, and you'll be able to plot your equity and do all the analysis just like it was coming directly from the broker. But it will be labeled as unverified. Those traders, we will still be looking at those traders, because in every case if we would allocate or consider or FundSeeder Investments would allocate to anybody, or any investors would allocate to anybody, there would always be a due diligence process and a further checking. So we will still be looking at the unverified data because on the assumption that the majority of those will be honest, and we'll certainly double check that they are. And there would be no reason for anybody to put up fictitious numbers, because they'd only be fooling themselves, and it wouldn't get them anywhere anyway. because everything would have to be verified at the end, in the end result in any case. The key thing, though, is that ability, though, if you've got a broker who's not yet linked, it gives you the opportunity to use the platform. So those are the three big things that have changed, and it's kind of night and day from what it was when. Well, yeah, I think Aaron, you saw it in the beginning, and you saw it now, so you can attest that it's totally changed.
Excellent. Yeah. I had a look at it earlier today, and no, it looks great. The new platform looks really slick. So yeah, I definitely encourage guys to check it out. A lot of really cool analytical tools as well. So no, you're building a great product there, Jack. One of the things I'd be interested to know is what's required before a trader can actually get access to funding. Like, do they have to have a certain length track record? Do they need annualized returns above X%, or like what are you guys kind of looking at there? Like, how does someone actually get funded?
Yeah, so there's no formula here. I mean, it's not like I can tell you, you need a minimum 3 years or something like that, or whatever it might be. And a couple of comments on that. So one thing to say right off the bat is that we're dealing, unlike most databases out there, or the vast majority, we're dealing with daily data for traders, not monthly data. So that means a couple of things. First, it means that traders can't hide bad performance like they could in monthly data. So you can have traders whose monthly data looks like, they got a reasonably good return, they don't have any huge monthly drawdowns, but you're looking at it and maybe you see a worse monthly drawdown of 5% and say, oh, that's not too bad. But for all you know, that in many cases, that trader might have had a 25% drawdown intra-month, but managed to recover. So all you're seeing is a 5% drawdown. But since we're dealing with daily data, everything is uncovered. So you get the ability to see, it's like a microscope. It's like, as opposed to just seeing things at an eye magnification level, you can look at a microscopic level, you can see a lot more detail, get a lot more information. So that's one big deal. Also, statistically, if you're dealing with daily data, you've got about 21, 22 times as many data points as you do with monthly data. So statistically, it's much more reliable and meaningful. And so you don't need as long to do. If you're doing analysis and performance evaluation that is based on daily data, then that type of feedback can tell you meaningfully that a trader has a real edge. Well, on a much shorter time period than you might be able to do with monthly data. So that's one element of it. And the other part of it is that traders come on to FundSeeder. It doesn't mean that that's where the track record begins. In almost all cases, obviously, these traders are trading before they come on to FundSeeder, so there's a prior track record. So you can have people on FundSeeder who've been trading 5 or 10 years. You might have much lengthier track records. Now, as far as what we haven't yet, we've, as I said before, focused entirely on building out the trading platform. The investment side is a second stage in a separate company, and we're only now beginning on that, to focus there. But what we will do there, in searching the database in FundSeeder, we will use the filters we have. We have a proprietary indicator, the Fund FS performance measurement, which is our own proprietary measurement that gives a little bit different rankings. It's a more sophisticated measure, and that will rank traders. We also have programmed in one indicator that I probably spoke to you about last time, which has been my favorite indicator, which I've tried to push in the investment world, which I call the gain to pain ratio, and that's built into the site. So I will always be looking at ranking traders using that. So between using the gain to pain ratio and using the FundSeeder indicator and looking out at the traders who come out best of those measurements, you can pull out a subset of traders who are worth looking at more intently, and then going over their track records more precisely, and then the interesting ones following up, getting more information, interviewing them, and if it's going to get to the point of allocation, doing due diligence. So that's the process.
Okay. And who's actually providing the funding? Like, is it individual accredited investors, or are they other money management firms that are looking to, invest money with these traders?
Yes. So since we're right at the beginning, we have right now, we have one angel investor that in Fund Seeder who will be allocating money to start a emerging manager fund. That's through Fund Seeder Investments. That will probably an initial product. That fund is currently just beginning to be structured. When I think structured, I mean just the legal part of it, and to be able to do it the way we intend to do. We'll have some fairly unique elements to it in terms of how fees are charged and so forth. If you want to make a product that's very friendly to investors. So in any case, that product will be funded by, like I say, one investor to start out with, and of course we'll have other investors will then potentially, before it gets started, I assume there'll be other investors. I may very well myself allocate to the fund myself. So that sort of in-house wise will get a fund started, but the CEO and the founder and the person whose idea Fund Seeder was, Manuel Bellari, his particular domain and expertise is he has lots of contacts in the investment world and investors and so forth, and so he will be introducing managers that come from the fund, not from the fund, come from the technology side of Fund Seeder to potentially interested investors, and so I assume there are going to be a number of institutional type investors, and we also envision alliances. We have the preliminary discussions, nothing in writing yet, but there are other types of discussions that he's had. There are networks of like family offices or groups that represent high net worth individuals that may work with us. So by the time we get rolling through Fund Seeder Investments, there'll be lots of different sources of allocators.
Great, good stuff. And when's that likely to kick off?
I would expect, like I say, it's the legal work is, the first meeting with the lawyers was just this last week. And so we've only outlined what we want, the flexibilities we want this fund to be able to do. And so we're creating, so that document needs to be created and the structure needs to be created. And that'll probably take a few months just on the legal work and stuff like that. But I would imagine that sometime this year, the first fund should be underway. And I would also expect allocations to people through Fund Seeder Investments will occur this year as well. So before the end of the year, I think you'll be seeing allocations that are connected with Fund Seeder Investments.
Awesome. Okay. And I know you're planning on writing another Market Wizards book, the Undiscovered Market Wizards. When can we expect this? I think I might have asked you this last time as well, but is this, you're going to be sourcing the traders for this book from the Fund Seeder platform? When can we expect this book? Is it going to be another couple of years yet? Or?
Yeah, it's going to be another couple of years. I actually don't want to even do that until this new, the new platform is only really launched about a month ago. I personally didn't, I spoke to you a while ago, and we kind of mentioned Fund Seeder in passing, but I kind of avoided, and we avoided, Fund Seeder, we really avoided marketing because it wasn't really ready for prime time. But now with the new platform, which was launched about a month ago, we're starting to do some marketing, starting to get out in the public, and I've started to do podcasts and interviews, and we'll have a number of others scheduled. So we're only now beginning that process. So there's going to be, I think, a tremendous increase in the number of traders that will come to the site over the next year or two. So I want to give it enough time, and I don't actually want to begin that project until about a year and a half, 2 years from now, at which point I will do the search through what is then the database on Fund Seeder and narrow it down to a list of maybe 15 traders who seem totally exceptional, and will be probably almost all traders who are unknown. And so that's hence the name Undiscovered Market Wizards, and also means that there are people out there who will have the opportunity to go from complete anonymity to some to recognition, assuming they've got the track record to prove it.
Yeah. No, that's awesome. Something to definitely look forward to. That's for sure.
Oh, on books, I should say I have one other book. I have another book coming out late this year, which is my first book, Complete Guide to the Futures Markets, which is being revised this time with the help of a very able co-author who's doing the legwork on the revision, Mark Escon. And that is a book, if you've got for futures traders out there, it is really sort of an encyclopedic type work. It'll cover basically everything, from technical analysis, chart analysis, system trading, performance measurement, fundamental analysis, regression analysis, trading approaches, money management, on and on and on. So that is almost more of a reference work, but it's hard for me to imagine that anybody can go through that whole thing and not get some useful ideas. And that book the Complete Guide to the Futures Markets, will come out in the fall of 2016. So that will be really the next book I have coming out.
Right. Okay, cool. Well, that's one to keep an eye out for. And I believe you're also in the process of releasing the new Market Wizards as an audiobook. When will that be available?
Yeah. And so I'm excited about that one because this is the first time I've got control of the process. So there are audio versions of Market Wizards, Market Wizards, Hedge Fund Market Wizards, and a little book of Market Wizards. There are audio versions of those books, but there was never an audio version of the new Market Wizards. And thanks to my terrific agent who got the rights back for it, so I've got the rights for the new Market Wizards. And I went through a process of there's a site called ACX, which is a division of Audible, I believe, or Amazon or Audible. But in any case, they allows authors to manage the process of turning their books into audios. And so they've got a lot of great narrators. And I went through a process of posting some excerpts from New Market Wizards. And I got, like, in the first couple of days, I got submissions, narration submissions from about 40, 50 people. And most of them were really good. And it was really, really tough. I finally had to kind of put up a thing saying, stop, it's no longer look at anybody because I couldn't take anymore. But I got it down to I got it down to 10 people, and then I got it down to 4 people. And they were all really, really, really good. And I just couldn't decide. And I sent it out to 10 other people I knew. In fact, you were a part of it. Aaron, I sent you a copy, right?
You did, yeah.
Of those, right? And so it turned out that one of these narrators, I couldn't have predicted which one, but one of these narrators, I had about 8 to 10 people I sent it out to, said, hey, this is the, I should have 9 out of 10 picked them as number 1 or 2, but most of them picked them as number 1. And for some reason, 1 out of 10 put them 4, But virtually everybody liked this guy a lot. And so I went with him, and he's been doing a phenomenal job. So he's just doing it's a thrill for me to listen to my own book with his narration. His name's DJ Holt, and that book is now well into about almost halfway through. The expected final production completion is in May. So we're only we're a month away, I think, or less, before the audio becomes available. And it's personally, by far, my favorite will be my favorite audio version. So some of the audio versions, they're okay. The other ones are okay. Some are pretty good, but I think this one is a great one. And I'd actually like to see. I would have thought I don't know if it's possible to have him narrate the other ones. I'd have to speak to my agent what the rights are and everything else. But he's been doing a great job. So that's one thing I have coming out where I give credit to the narrator because he's really turning his book into a different type of product and really bringing my words to life.
That's awesome. Yeah, you'll have to let us know when it's out. Actually, it'll probably be out by the time this podcast is released. We're recording this in April 2016, obviously.
It'll be very soon, or maybe it'll already be out. Like I say, he expects to get it done by May. So before the end of May.
Great.
It could be early May.
Okay, awesome. Yeah, well, you definitely have to let us know, and we'll put the good word out. So one last question before we wrap this up. I've always been curious. As an author of trading books, I think we'd really value opinion on this too. What's one trading book apart from your own that you would recommend to anyone listening to this podcast?
Okay, so the one book that I recommend, and that many of the traders that I interviewed mentioned in their interviews, and which is a classic that was written around the 1920s. So we're now getting pretty close to 100 years from its publication, and it's still pretty relevant. And that's a book that some of your listeners will certainly be familiar with, called Reminiscence of a Stock Operator. It was to be completely upfront, was probably the incentive, part of the incentive of my writing my own books. In other words, I read Reminiscences back, probably close to 30 years ago. And at the time, the book was about 65 years old. And what struck me at the time was, hey, here's this book. It's an old book. And it's still really, I highlighted certain passages, and it was still relevant to trading. And therefore, when I did Market Wizards, I did a different style and a different approach, and it's not the same type of book. But what I had in mind, and this is quite honest, I kind of said to myself, I want to do a book that 65 years from now, people will still be reading as being relevant, still relevant. So that was my goal. I said, if I'm going to be successful, then just like I'm reading this 65 years after its publication, there'll be people reading Market Wizards 65 years after its publication. It's certainly still true now, which is like, 27 years or so after its publication. So hopefully I will be successful in that objective. But it was an inspiration for me, and it is a classic book, and it's a book that every trader should read. Interestingly, Steve Burns, who does a lot of posts, and he's actually, if you're a Twitter follower, and if you want to get a lot of interesting stuff and a lot of good quotes, Steve Burns is probably a good guy to put on your list to follow. But he had one tweet out recently where he did a poll of his followership of what is the best trading book ever written. Market Wizards came in second, and you can guess which one came in first. And there was no sore feelings there on my part. Now, other books that I think are quite worthwhile reading, I think Nassim Taleb has a lot of intelligent things to say about markets and trading and the world and risk and not getting, as he called in his first book, Not Getting Fooled by Randomness, which is a great title. Actually, Fooled by Randomness is my favorite book that he wrote. I think I've read just about everything he wrote, and I think everything he writes is worth reading. The Black Swan is probably his most famous book. My own personal favorite is probably Fooled by Randomness, but again, Nassim Taleb is an author well worth reading. Then there's, if people are interested in sort of hedge funds, a good history of hedge funds, an exceptionally good history, in fact, because I've interviewed a lot of the same people, I knew some of the same funds, and sort of the best history of hedge funds that is out there is More Money Than God. I don't think it's a particularly good title, but I think it's an exceptionally good book. So that's a book that I would recommend. One writer that's really good is Lowenstein, Roger Lowenstein, and he did the definitive book on the failure of long-term capital management when Genius failed. So that's a really good book. Another writer that's just who writes the absolute who makes me jealous as a writer. I mean, just in fact, I just think he writes so well. Is Michael Lewis, and he writes books across the spectrum. Certainly not just financial books, but he's written he's done, of course, a number of books just in the financial area, and anything he writes is a great read. His most recent book, which is not the most recent book, but it's actually not. It's the second most recent book, but The Big Short on finance. The Big Short is a terrific explanation of what went on in 2008. and just both a great narrative and a great demonstration of someone taking extremely complex ideas and making it understandable to the common reader and making it a compelling reading. So Lewis is somebody I greatly respect as a writer. Some other good books. There's a good book called Fortune's Formula by William Poundstone, which covers some of the same territory I covered in my Market Wizards books. In fact, one trader, Ed Thorpe, who's one of the great traders of all time, plays a prominent role both in Fortune's Formula and in hedge fund Market Wizards. He goes through the Fortune's Formula is the Kelly criterion. There's a lot of interesting stuff about probability and win-loss ratios and statistics in a readable format. So that's a good book. And The Quants by Scott Patterson, who covers traders, quant traders, in a very interesting and readable format. You got me going now. Robert Shiller, the Nobel Prize-winning economist, sort of has a distinction of writing books before things happen and being right about them. And so the classic being Irrational Exuberance, but he's somebody who I think anything he writes would be worth reading. Anyway, I think that's a good sampling there.
Yeah, I think that's enough to keep any listener busy for a good while. Great suggestions, though. And all right, Jack, well, thank you very much for doing this. I'm grateful to have had you back on the podcast again. Just before we wrap this up, do you want to give listeners the best place to go to find out more about you, maybe a website and your Twitter handle?
Sure. So it basically, the best site to go to is, as we talked about, is fundseeder.com, and that's one word, fundseeder.com. So that's pretty straightforward. I have my own website that I don't do too much with. I will put stuff like links to some podcasts and stuff that I've done, and my books are up there and stuff like that. But that's jackschwager.com. And so those are the two spots where readers can go to, or listeners, I should say, not readers. Listeners can go to.
Okay, and your Twitter handle is?
Jack.Schwager.
Okay, excellent. All right, Jack, well, once again, thank you very much for doing this, and let's speak again soon.
Okay, great.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, traders? Hope you're well. I'm Aaron Fifield, and you're listening to episode 79, which I speak with Raoul Pal. Raoul has a history rooted in the hedge fund industry and carries with him more than 25 years of experience in financial markets. For a number of years, he worked at Goldman Sachs, where he co-managed the hedge fund sales business in equities and equity derivatives. and formed relationships with some very well-known names and funds, which you'll hear about in just a moment. He later moved on to GLG, which is one of the largest hedge fund groups in the world, where he launched their Global Macro Fund in London. Today, Raul no longer manages client money, but continues to invest his own. He also writes a premium research newsletter, which is called The Global Macro Investor, and is the co-founder of Real Vision TV. In this episode, we navigate through some uncharted waters which have not been explored previously on this podcast. So in addition to macro investing, technical analysis, and hedge funds, we discuss the issues with theoretical economic models, business cycles, negative interest rates, and why the world is economically in a frightening position. Also, I have something for you which I'd like you to check out. Just recently, I released a second edition of The One Thing. So this is a free guide where I asked more than 20 traders to share the one thing they wish they would have known before they started trading. Like I said, it's free to download, and you can get a copy right now at chatwithtraders.com/ebook. It's very easy reading, and there's a lot of wisdom packed into it. So again, that's chatwithtraders.com/ebook. Okay, you're listening to the Chat with Traders podcast. Here is my guest from the Cayman Islands, Raul Powell. How you doing, all right?
I'm good, how are you? Where are you?
I'm in Brisbane, Australia.
What time is it for you?
It is 8 a.m. on a Tuesday morning.
Oh.
So it must be, what, Monday evening for you?
5 o'clock Monday evening, yeah.
Okay, nice. And you're in the Cayman Islands, is that right?
Yeah, it's even nicer than Brisbane.
Yeah, no, I imagine it would be very nice out there. How long have you been there for?
I've been here for a couple of years now.
Okay.
I lived in Spain for 10 years before that.
Right, okay. So were you ever living in the States or always?
No, I was London, for most of my career, then moved to Spain, lived in Spain for 10 years, and then moved to the Cayman Islands a couple of years ago.
Good stuff. Just to get back and enjoy life, eh?
Exactly. Well, keeping busy with this Real Vision TV and then my writing, Global Macro Investor. So I had the idea of not being very busy, but I seem to be extremely busy now for some reason.
It sounds good in theory.
Yeah, exactly.
Cool. Well, anyway, man, it's awesome to be speaking with you. I've obviously got a whole bunch of notes here. So, yeah, there's definitely a lot I want to talk to you about. We'll talk about how you came up, your various roles that you've had in the industry. We'll talk about your approach using macro investing and also some general chat just about economics. How does that sound?
Sure. Yeah, perfect. I could talk about pretty much anything.
Excellent. Well, I think this will be very different to most of the interviews I've recorded to date. So it should be very interesting also, not only for myself, but everyone who's listening to this right now. So it's going to be good. So one of the first questions I'd like to ask you is, where did you first enter financial markets? I mean, tell us a little bit about how you got started.
Yeah, by luck, I think. I got a summer job working for a company called Dow Jones Telerate. So they were like the predecessors of Bloomberg. And then after that, I got offered a job after university, and I started in supporting a technical analysis product. So I learned about technical analysis, and that got me really interested in markets. And I realized that markets is what I wanted to do. And I managed to then get a job at one of the brokerage firms in the UK in equity derivatives. And that's where I started. And before you knew it, it was the start of the hedge fund business back in the early 90s when hedge funds just started appearing on the scene in bigger numbers. And that got my interest peaked. And suddenly I realized that was where the opportunity for me lay, was both in understanding the world of how these guys operated and what they did, and which led me to macro as well. So it all came from that.
Excellent. And did you have any financial education before going into this?
Yeah, I had a degree in economics and law when I wrote my dissertation at university about junk bonds. So I was very interested because I was at university in the late 80s when finance was everything. Everybody wanted to be Gordon Gekko. And so, finance was the thing that I was really interested in. So it was ideal for me at the time, I guess.
Got it. Okay. And were you doing any sort of investing or trading just on your own during this period in time?
Yeah, I mean, I had to dabble, as everybody did in the late 80s, in punting in stocks and losing money. And then obviously I started investing myself once I moved into the financial world. I mean, technical analysis made it really easy for me as a place to start investing because you didn't need to know anything except about how to read charts. It then, after a while, I realized that not only reading a chart, but understanding why gave you a much bigger edge. But yes, that's where I started investing.
Excellent. Okay, so talk to us a little bit about, you said that your interest in sort of the hedge fund world had been peaked. What was kind of the next move from you, for you? What was the next step from there?
Well, it was interesting. I moved banks at the time, and our team moved across to this other UK firm, and about 120 people joined from Morgan Stanley at the same time, which we didn't know about. And then so my role changed, and somebody said to me, well, what do you want to do, Raoul, then? Because, we're going to change things around. And I said, you know what? I quite fancy getting to know the US hedge funds. So he said, well, who do you want to know? And I gave him a list of, naively, of Paul Tudor Jones, Stan Druckenmiller, all of these, the most famous guys in the industry. And he said, yeah, well, I know them all. They're all friends of mine, and I'll set you up. And that was it. So off I went to New York and met Paul Tudor Jones and met all these guys. And it seemed that I kind of understood how they thought, which was great. It really was a perfect fit for me. And then I suddenly started really understanding the world of macro, and I became completely focused on that, and then built out a big hedge fund business there. I was involved in long-term capital. I was involved with, all of the kind of famous hedge funds of the time, Tiger, Soros, Tudor, all of these guys, More Capital. And then eventually moved to Goldman Sachs, where I built the hedge fund business there in both equities and equity derivatives.
Wow. Okay, so I've got to ask you, what was it like meeting Paul Tudor Jones, and sort of what was that whole experience like? Were you with him sort of for a day, or was it a working relationship? How did that go?
Well, it was interesting because the big guy at NatWest, where I was working at the time, took me over there to meet Paul, and Paul was walking around with a Nikkei chart, and he was talking to my boss at the time about stuff, and he said, "So, Raoul, what do you think about this?" And luckily, Paul Tudor Jones is a big chartist, and so was I. So I looked at the charts and, I gave my views. He said, "That's exactly what I think. Brilliant." And that was it. After that, we were chatting away, and then before he knew it, I'd speak to him every day.
Wow. And do you guys still keep in touch to this day?
No, I have not spoken to him for a while now. I guess since I left the hedge fund business myself back in the early 2000s or mid 2000s, I haven't spoken to him for a long time, actually. I've been meaning to get hold of him again to speak to him, but I've not done so for a while.
Very cool. I noticed, I think he was on Real Vision TV. Is that right?
No, Paul's not been on yet, but I will get him, trust me. We've had a few of the other legends on there, but not him.
Yeah. So you said in your response just a little while ago that you were involved with a lot of these really big hedge funds, including like George Soros hedge fund, long-term capital. What was your sort of involvement with these guys?
Well, I was running hedge fund sales at Goldman Sachs, so we had a team of people. In fact, I started it from scratch. It was just me doing it. And then we had a whole huge team of people where we were selling equity derivative products, but basically my job was to talk macro or to talk markets with them, or with long-term capital and people like that. We were looking at risk arbitrage opportunities, using derivative structures or other structures in how to, take advantage of various discrepancies. But, with the macro guys, it was just talking about what was going on in the world. I see this going on in Japan, and we think the economy's weakening here. Maybe there's a good opportunity to, short this market, be long that market, or this sector versus that sector. So that's kind of what I was doing on a daily basis. And I dovetail in with the foreign exchange guys, the fixed income guys, the commodity guys, because when you find that global macro is the connection between all of those asset classes plus economics, you kind of need to know all of those component parts and understand how these hedge funds operate between various asset classes, because there might be shorting copper. Well, then you have an opportunity that there might be opportunities within shorting copper equities as well, because they may not have priced the same as the commodity was. So it was kind of like that.
Got it. Okay. And that's actually something I want to ask you about is your time there at Goldman Sachs. So like you said, you were hedge fund sales. I think you may have sort of described it there a little bit, but what actually is hedge fund sales? Maybe if you could just really dumb it down for us sort of on the outside.
Yeah, I mean, at the time, hedge funds were the new growing client base, and they operated in a different way to anybody else, because what they do is they, and there's different types of hedge funds as well, but in essence, they can short things as well as buy things and speculate on them rising. So that's the real difference with hedge funds, is they can bet on something falling in price by selling it at one price and buying it back at a lower price. But also the hedge fund world tends to also have different strategies. It can be with different asset classes like commodities or credit, or it can be with different investing styles like global macro, which I mentioned before, is kind of looking at the global economic cycle and looking how that interacts with prices of assets. Or there may be arbitrage where, for example, there may be a company that has a share listed in both Holland and England. Those shares are the same shares, but they trade at different prices for some reasons. And to try and trade those discrepancies is known as arbitrage. Or there might be merger arbitrage as well, where a company is being bid for and they're bidding a price of, let's say, 100, and it's currently trading at a price of 80 because of the probability of that deal not going ahead. And hedge funds would try and calculate the probability of the deal going ahead and then look at the opportunity of making money out of that. So there's a number of things that we did, but basically it's advising that group of firms, the hedge fund client base, which is probably the most kind of interactive, exciting client base that there was and probably remains today.
Okay, very interesting. And so I think you were at Goldman Sachs for, was it maybe about 5 years?
Yeah, that's correct.
Yeah. So where did you go from there? I think you went to, was it GLG? And I think that was actually one of the world's largest hedge funds. What was your experience like there? What were you doing there? Was it much the same?
No. So what happens, I decided to move across to the dark side, to move on to the trading side, because I really enjoyed the global macro world. And I'd had a really good understanding from learning from some of the very best, and also advising many of the very best on how to look at global macro, that one of my clients approached me and said, would you like to come and work for us and run a portfolio? So GLG at the time didn't run macro strategies, so I came to join them and trade macro. And then it developed and we launched a hedge fund, the GLG Global Macro Fund. So at that point, I was then trading myself all asset classes in all markets worldwide. So it's a very broad remit, but it's looking at the world top down again, looking how economies move, how flows of funds move, and understanding how that impacts asset classes. And that was through the tech bust and the subsequent recession, and then a few years after that as well. And so I would spend a lot of time trading fixed income, a lot of time trading currencies, and then suddenly you'd be focusing on equities or suddenly commodities or precious metals. So it was a really incredibly broad remit and a fascinating remit, but not very good for getting much sleep because you're trading 24 hours a day in different markets around the world.
Okay, and I imagine you would have had a team of traders underneath you there. How many guys were sort of working for you with that fund?
In our team, there was one. We had an analyst, we had a guy who ran execution, and 2 other portfolio managers.
So, did you find that there were sort of any challenges going from your position at Goldman Sachs over to GLG, where you were now actually sort of hands-on with the trading, whereas beforehand you'd kind of been more involved with sales and advising? Were there any challenges in that transition?
There are huge amounts of challenges with that transition. Originally, as you come from a sales mindset, you think about doing as many trades as possible because that's how you get paid. When you go to the trading mindset, you have to learn to do the least amount of trading possible. And people found that also when people were market makers at banks. Again, what they were trying to do is tons of different trades, but when they moved to the hedge fund side, the key is to do the right trades. So learning what trades to do and which trades to ignore is a hard lesson. It takes people time to learn that because it's all about assessing what the risk reward is, what the best probability is, and where to focus your attention. So that's by far and away the largest learning curve you have to go through initially. And then it's about the overall risk management and what your true trading style is, because many different people have different trading styles, and how you trade a fund is very different how you trade your personal accounts, because you have investors to report to, you have time horizons you have to adhere to, because you report your net asset value every month, for example. So what you have to do is figure out how to trade your style and your views around the liquidity and market volatility that your investors expect.
Yeah, okay. And you said that while you were operating this fund, was actually during the time of the tech bubble. How did you go through that period of time? And did you kind of anticipate that was coming, seeing as you were very focused on sort of macro events?
Yeah, very much so. I mean, like many of the macro guys, I was about a year early to it. So many of us by 1998 had realized what was coming after the Asian crisis. And then 99 was the big squeeze up into the final top. And then it was a very complicated market to trade because it went up and down, much like the market is today, up and down a kind of a volatile range, didn't go anywhere for a period of time until the economy started weakening properly. Then there was a big opportunity because once the Fed start cutting interest rates, you knew they had a lot of interest rates to cut. So it was a very easy trade from the fixed income side. And equity markets then followed suit. They tend to be more volatile as an asset class and more difficult because they're less driven purely by the economic cycle than bonds are, for example. So those were the two markets that that I was very, very active in at the time, and it was immensely profitable time as well. I mean, we were one of the best performing funds over that period.
Oh, that's good to hear. Very good to hear. So, since 2005, you've been out sort of doing your own thing. Can you share with us what you've been doing since then?
Sure. I mean, I decided to leave the hedge fund game back in 2005 because I noticed about the issues I talked about before that if you had a 6-month view on a currency, you still had to trade only on a month-to-month basis because that's how your assets were reported to your clients and they wanted monthly liquidity. And I realized it was actually becoming a very institutionalized world where the ability to trade long-term themes and have some sort of volatility to drive higher returns was disappearing. So I decided to opt out of the rat race and move to Spain and kind of semi-retired and decided to write because I love financial markets. I was investing my own capital. So I thought maybe I'd start writing for a living. And I started writing macroeconomic and investment strategy because I'd learned so much from so many people over the years. I'd also had spent a long time building a research product within the GLG Global Macro Fund and for my own trading that I kind of had a very different view on how the world worked and so started writing about that. And my client base was and still is the world's largest hedge funds, sovereign wealth funds, some government organizations, ultra high net worth individuals, because it's a very expensive research service. But that's what I've been doing for the last 12 years, basically.
Okay, and with that research service, you've got some pretty big clients there that you're serving. What's sort of in that research? Like, what are you sort of presenting to them?
Yeah, so what I did is basically try to give an insight into how I thought as a macro manager and the sorts of things that they need to know as a manager of assets, what information might be interesting. So basically, the first thing is I look at how the global economy is working, and that's the business cycle. So I look at the business cycle because that drives asset prices. So once you understand what's happening, is the global economy weakening, speeding up, stable, whereabouts it is on the cycle will give you a much better idea or probability of the direction of asset prices. So I spend a lot of time looking at economies, and I have various ways of looking at it, including the ISM survey in the US, which is a very good indicator of the business cycle. Then I start overlaying big secular themes. What are the demographics? What's the debt profiles of countries like, or markets? Then we start looking at technical analysis. What does the market look like technically? And what you're trying to do is build a kind of onion layers about a particular theme. Because what that does is it allows you to isolate better probabilities. So what you're trying to do is figure out what is the best odds. Because if you just look at a chart, your odds are not as good as if you look at a chart and understand the fundamentals. If you look at the chart, understand the fundamentals, and understand the flow of funds, your odds are better again. And if you understand some of the underlying fundamentals of the stocks within that indices that you're looking at, or the sectors, then your odds are better again. So that's what I try to do, is I try and help people understand the probabilities of certain outcomes and create a view on the world to allow them to make investment decisions. And I run model portfolios, which mainly replicate my own positions as well in the kind of bets that I would be taking. And that can be, again, across all asset classes, whether it's crude oil to gold to emerging market currencies, emerging market stock markets, credit default swaps, volatility, everything, all asset classes. And so that's what I do basically.
Right. Okay. Well, let's focus in on this a lot more. I'm really keen to hear, about some of the finer details of how you invest using, these macroeconomic themes. So, I guess just to take it back one step to the very basics, what is a global macro investor?
Global macro investing is a theme. It's a name I don't even know where it came from, but it basically is a description of an investment style. And what it means is that you're a top-down investor. And again, that's another terminology that people may not be familiar with. What it means is you trade asset classes based on what is going on in global economies. So global macroeconomics is the driver of the asset classes or the types of investments that you make. So, for example, in a recession, you tend to find that interest rates fall. So therefore, you can bet on bond markets rising because bonds go up when interest rates fall, or you can bet on interest rate futures. You also might find that in a recession, stock markets fall, so you can invest in those. You might find that countries that have good demographics and have low debt tend to have strongly trending stock markets. So you might want to be long stock markets of those kind of countries. You may find that in a boom that certain types of sectors do really well because maybe consumers are spending, so you're buying consumer-based stocks. You may find that when currencies are there's a lot of volatility in currency markets that people flood to gold, for example. So you may bet on that. You may look at recessions again and understand that if a country, if the global economy is going towards recession, then something like crude oil will probably fall in value. So there's a number of different ways of looking at things. It's a very complex world because you're trying to piece together the world's most beautiful jigsaw puzzle that's always evolving every second of the day. But that's kind of what global macro is.
Okay. No, that was a really great answer. That was awesome. So how data-driven versus sort of opinion or, I guess, instinct, I'm not quite sure what the right word is there, but how data-driven would you say your approach is as a global macro investor?
Investing in economics is an art, not a science. So even though I am data-driven, it's not everything. So how I look at things is, for example, again, I mentioned before that stock markets tend to rise and fall when the economy is rising or falling. Well, interestingly enough, I can have a proxy for the US economy in what's known as the ISM survey, the Institute of Supply Managers survey, which they interview a whole group of purchasing managers across America, ask them what they think business conditions and inventories and sales are like, and they built this index, and that actually rises and falls almost exactly in line with US GDP growth. But also, if I look at the rate of change of the S&P 500, the year-on-year rate of change of the S&P 500 mirrors that movement in the ISM index. So I can pretty much choose, if I know where the economy is going, I know roughly the performance of the markets. So then if I can anticipate where the economy is going, I can anticipate where the markets will go. And then, as I said, I blend in technical analysis and then other analysis to give me a better understanding. So it's partly data-driven in terms of I look at economic data a lot and look at correlations between economic data and asset prices, correlations between data in one country and data in another, looking for leading indicators and indicators that give you the current state of affairs, and then try and express that in what is the best risk-reward opportunity. So that becomes less data-driven, and then that's experience-driven and partly hunch-driven, partly, again, more data-driven. What's got the highest beta to that particular theme? What reacts the most to that particular theme? Or what's the weakest sector in a certain situation? What's the strongest sector in another? So that's kind of how you do it.
Okay, so talk to us about the technical analysis aspect of what you do. Like, how much of what you do is sort of technical based? Like, would it maybe account for maybe 10% of your approach, or how do you use technical analysis, and what are some of the chart patterns that you actually find to be credible?
I mean, I can't do anything without a chart. I'm a very visual person. So the good thing is you give me a chart and I can have an opinion about the direction with a rough probability of how much I'll be right or not right. I'll know the full history of what it's done over time, so I understand how something trades, how volatile it is. So all the contextual information you get out of a chart is huge. So charts are incredibly important to me. But I also need to have the macro overlay, the economic overlay, because I won't just trade with a chart. Many people do, and very successfully so. But I like to see the macro overlay as well. So those two are equally important. I couldn't do anything without a chart, I guess. And then I use a chart to give me probabilities. And probabilities allow you to, for example, look for a stop loss where you may say, I'm wrong on my idea, and maybe I'm going to risk 2% of downside in that. But I could make 10% in upside, then you have a 5-for-1 risk reward. So that'll be an attractive risk reward bet. If something is 50-50, you tend not to want to do that bet. So you're looking for things where you can see a price objective that is many multiples of the risk of you losing money. So you look at those and then try and apply the economic overlay as well. And once everything agrees, it gives you a much higher chance of success. So in terms of chart patterns, I look at a lot of continuation patterns such as wedges or triangles or pennants, as other people call them. I find those incredibly useful to me and probably the most reliable of all technical patterns. They're not always right, so you always know there's a probability of you being wrong, but there's a relatively high chance of you being right. The hard thing is sometimes guessing the time. But generally they work. Head and shoulders tops and double tops and things like that. Those kind of patterns work pretty well. Rounded bottoms, those kind of things work too. And then I use technical indicators on top, things like relative strength index, stochastics, and I use something called DMARC, which is quite voodoo-like and complex to describe, but I use that as well, which was developed by Tom DeMark and gives you entry and exit points, exhaustion points in markets.
Okay, and as someone who's looking at the sort of the really big picture, what sort of charts do you spend most of your time looking at? Are they daily charts or even weekly or monthly charts?
Yeah. Good point. I look for my ideas in a monthly chart because I like longer term time horizons. I find there's less competition in the longer term time horizon because all the hedge funds are always forced into the shorter term time horizon. So I prefer that time horizon. So I look at a monthly chart first. What's really going on in this sector? What's really going on in this market? Then I'll then zoom in to weekly and then down to daily. Daily is the least interesting to me. That just gives me an update of where we are in the current trend, but I really need to understand the bigger picture trend. And then for me, what really is great is when I'm looking for reversals, for example, because I've identified an economic theme or a particular theme that I think is interesting, then I try and look for reversal patterns at monthly, weekly, and daily level. And then when you've got that, your probabilities are extremely high of success.
Right. So because you do take into account technicals and you do, like you said, that charts are incredibly important to you. Does this make you somewhat unique to most global macro investors who are maybe more focused on, just the economics and that sort of thing over what's really happening on the chart?
No, I don't know any of the kind of better known traders who didn't start with a chart. So Paul Tudor Jones, always a chart. Stan Druckenmiller, always a chart. George Soros, always a chart. Many of these guys, or most of these guys, are all chart-based.
Okay.
That's the way you can feel. Because don't forget, global macro, you're having to look at an enormous amount of things, enormous amount of markets, sectors, asset prices, from wheat prices to sugar prices to palladium prices. I'm just looking at my screens now, the amount of different things I look at. There's no way you can follow that without looking at a chart first.
Okay. So for someone who might be a very short-term trader, maybe they're an intraday trader or a swing trader who typically holds a position for, 2 days to, let's say, 2 weeks, do you think there's any added benefit for someone who trades a style like that to be aware of the economics and fundamentals? Is that any benefit to them?
Yeah, so some of the best short-term traders I know, and again, Paul Tudor Jones will be one of those. He was brilliant at trading short-term because if you know the trend from the economy, if you know the long-term trend on the charts, and you want to capture where the best risk reward is in the next 5 hours, Well, let's say both of those are going up. So let's say the economic cycle is improving, and that's driving your particular asset class you're trading. Let's call it the S&P 500 futures. Let's say that's giving them a potential to rise over time as opposed to fall over time. So therefore, you've got a trend. So then you would be more inclined to buy the dips in the shorter term, to look for new highs and take profits, than you would be to keep looking for the reversal, because keep looking for the reversal is very hard in a trending up market. Some people do that reversal strategy and wait for the exhaustion points, but it's a harder trade. So yes, I think it's for short-term traders to understand the bigger picture is really helpful. And some of the best short-term traders I've ever met also understand the bigger picture.
You know, one of the things I'd like to ask you, still sort of continuing on this, is that, like, once you've formed an opinion, you know, from looking at the bigger picture, how do you kind of time the trade to capitalize on it? Like, where do you enter? You know, like like we're talking about short-term traders here, they might look for a technical signal, like a certain level to break or support to hold or something like that. Are your signals much the same? Like, what screams a green light buy to you?
Yeah. So once you've got let's say it's an idea that you think is going to, let's say, for example, right now I'm looking at the dollar, and my big thesis for a long time is the dollar's going much higher. We've just had a sharp correction the last couple of days. So you start thinking, okay, do I add to my position now? So that goes down to technicals and market positioning, the same as it is for everybody else. Because again, if you can bring, even if it's a long-term trade, that I'm in this trade. In fact, I've been in this trade for several years now, but I will trade around within the theme, even though I'll keep my majority of my trade on. Is when I want to add and reduce, I will look at the short term and I'll come down to the daily time horizon. I mean, sometimes I'll come down to the hourly time horizon, but very rarely. But I'll come down to the daily time horizon and look for the technical setup or the confirmation, as you said, the right reversal, the right trend line break, the right price break, or whatever it may be.
Okay. So the way you actually sort of time the trade is predominantly based on technicals. Is that correct?
Absolutely. I mean, I've found that a lot of people try and trade catalysts. And catalyst, it's really difficult because so often, you buy the rumor, sell the fact. It does the opposite of what you expect, and sometimes it doesn't do anything at all. So I like to see the chart line up with the catalyst, and again, it just increases the probability of success.
Sure. And you said in your answer just before that you've been in a trade. You're in a trade at the moment which you've been holding for a couple years. Is that the sort of the typical hold time of your trades? Like, how long are you usually invested in the market for any given position?
Firstly, it's how long is the theme? So my dollar theme is, I've been long the dollar versus the euro from 148.5. It's currently 113, and that was several years ago. So I've had that trade on, and I'll increase it and decrease it during the course of the trend. I mean, there's whole periods of time, months and months and months, where it goes against you, does nothing. But my entry was good in that trade, so I've been able to stomach that for those ups and downs for a long time. So it really depends in that way. But it's I have a longer term time horizon.
Okay, so I'm really interested to hear a little bit more about how you decide to increase or decrease your position. So, I mean, is there any reason why you don't just sort of go all in, all out? Like, what's your sort of thought process?
Because I've done that over time, and I've found that if it's a long-term trend and you think it's going to go on for a few years, and you go all in and all out, you have to be really good at being right. But if it's a long-term trend, you don't have to be really good at being right, because it trends that way anyway. You could have been a fool in the stock market from 1991 to 2000, as long as you were long. If you kept a long position over time, you made money. But if you sold it because it got overstretched and you're waiting to buy it back, you often miss the trade, you get it wrong, you don't get back in again, you buy at the highs, you're always on the back foot. But if you're kind of in a trade that's working for you, I don't use huge levered trades in this kind of situation because you can run them for extended periods. But then what you do look for is, has it got really extended? Well, then I can take some of my trade off, but I'm still in the trade because I know the trend is in my favor over time. It's only when you start getting towards the end of where you think the trend may finish, do you start saying, well, maybe I close the whole position, take profits, or you take losses. I mean, we will take losses all the time too.
Yeah, so that's what I want to ask you about is how do you actually think about profit taking? Like what determines a time or a price to exit a position?
Really, again, because I'm a longer term guy, so I look at the long term chart pattern. I think the euro goes to 75 cents against the US dollar. I could be wrong, but that's my view. And so I look at the probabilities, look at the chart patterns as they evolve, and I still think, okay, that's the most likely outcome. The odds shift over time when the market doesn't do what you want it to do, but that's where my idea is. So I'll just keep with the trade unless I see something really major changing that view. And because I'm in from 148.5, I know I've got plenty of wiggle room, and if I give back some profits, that's so be it. That's how it goes. So it really depends on how long your trade time horizon is. So I'll look at monthly charts to assess that. So, for example, I'm looking at a chart pattern that's very interesting to me in the European oil stock sector, SXEP. That, if I look at the monthly chart, is one of the biggest head and shoulders tops I've ever seen in any sector ever before. Now, it's not broken the head and shoulders top, but when it does, then that will give me a price objective of a fall of maybe another 75% from here. So then I will look to try and hold the trade over that period of time. And so what I'm looking for is the right entry now to enter the trade, look for where I'm wrong and where the chart pattern will be morphing. And I would say, okay, it's not the head and shoulders top I thought it was. So where am I wrong and where am I right? And, do I need to be the last guy in the trade? Probably not. So in which case, even though I may think it's falling down 75%, if I can make, X percent in it, I'll say, that's enough. I'll walk away and look for something else.
Okay, and then just going to the other end of it, sort of taking a loss, how do you think about and how do you manage your risk? Like at what point do you determine your initial analysis to be incorrect?
Well, if you're using a chart pattern, then you tend to know if the chart pattern's not working. So if it's not working, if it's not playing out like a head and shoulders top should do, then you should stop yourself out. I don't use tight stops because I'm not one of those kind of short-term traders. I just think of the amount of capital I'll be willing to risk. I'll have a much wider wiggle room than most other people. You get used to taking a bit of pain over time as well. But as long as the amount you're risking is a fraction of the amount that you hope to gain should your trade play out, then you can do that, over time. I'm not I find stop losses not good because everyone gets stopped out in the same place. I'd rather be kind of a bit more vague in my stopping out process and entering process. So I might scale myself out as I might scale myself in on entering trades too. So I tend to be very different to other traders in that respect because I really don't like hard stops unless it's a really obvious line that I've shorted or bought against and said, right, if it doesn't do that, then I'm wrong. Then I'm happy to use stops.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
I'd like to sort of move a little bit away from your strategy now and spend more time discussing, just economics in general. Now, you gave a presentation, I found it on YouTube. I was watching it just before we hopped on this call. One of the things you talked about was some of the problems you see with economic models and forecasts versus what actually happens in the real world. Can you talk to us about some of the issues that you see between these two sort of theory and reality-based sort of ideas?
Yeah, and this is a really huge concern of mine is Economics has now gone down to two schools of economics only, is taught pretty much anywhere in the world, and that's Keynesianism and monetarism. They're two different schools of thought based on different principles. Some principles overlap. But basically, they're theoretical models is how they're built. But as we know, humans don't fit into theoretical models. We have behavior patterns. Theoretical models in pricing of options suggest that all outcomes have an equal possibility, but they don't because markets trend. So there's a whole loads of things where, in monetarist policy, if you increase the money supply, then it will create inflation. That just doesn't work in the world because you have something called velocity of money. And so many of these kind of deep theories about how economics work are based on assumptions that are not correct because they're based on theoretical assumptions. And they use words like ceteris paribus, all things remaining equal, which means that in the real world, this doesn't work. So what you find in the real world, things like the business cycle works. We know what the business cycle does. It goes up and down over time. And you can project how long business cycles generally are, how deep they're generally going to be. And we know then how asset classes work. But economics doesn't do that. So this is why we've got ourselves into the big economic mess we've got into with the amount of debt that we borrowed. We've got this hybrid world of Keynesianism and monetarism, which is governments spend enormous amounts of money bailing out banks and spending money on stimulating the economy, while the central bank prints money by quantitative easing. So this is both Keynesianism and monetarism running all at the same time in a desperate attempt to revive an over-indebted economy, which was caused in the first place by slavishly following model-based economics. So I think it's a really dangerous thing. It's really important that people learn that economics is not a science. It's an art, and it really is the art of behavioral science, if that makes any sense. It's all about behavioral economics is the new school of economics, which is basically understanding incentive patterns and how people operate within incentive patterns. So that's a really key behavior thing. You know that if you offer certain people money for certain things, they'll make certain outcomes. If you tell people something hurts, they tend not to do it after a while. If they've done things that hurt in the past, they won't do them again. So that's behavioral economics. The reason people aren't spending money or borrowing money now, because even though the central bank are pumping money into the system, is because they learned from the last two recessions that having too much debt is a dangerous thing, and they're nervous about it. And that's behavioral economics, and that's not really model-based. The models break down with this kind of thing. So I think it's crucial that people understand things like the business cycle and things like behavioral economics and ignore a lot of what you're taught about, model-based economics.
Okay, so I just want to pick up on something you said there, business cycle, and I know you mentioned it earlier on as well. What does business cycle actually refer to? Could you explain that a little more for us, please?
Yeah. Basically, if you look at the chart of economic growth, GDP, of any country in the world, or even the world itself, it rises and falls. And it rises and falls. Generally, if we look at the US economy, but it's growing really fast, it might have grown at 5%, and if it grows really slowly, it might grow at negative 5%. So what you have is it's like a sine wave. A cycle goes up and down, but it's not perfect, so it doesn't go up and down, in a perfect rhythm, but there is a rhythm. And if you look at how the economy has gone up and down over time, you can tell that the average length of a business cycle, is X number of months or X number of years. You can tell that once the business cycle is peaked in the future, it is likely to reach a recession point. We're boom bust. That's how the world has always worked and always will work. It goes back to even the agricultural cycle is a boom bust, the commodity cycle is a boom bust, and the overall business cycle is a boom bust. So, we have excess spending, excess speculation, excess euphoria, excess optimism, too much borrowing in good times, and in bad times, nobody takes enough risk, nobody borrows, nobody's hiring new workers, nobody's doing all of the things that they should be doing at the bottom of the cycle, because it usually means at the bottom of the cycle things are only going to get better from here. So it's understanding the business cycle that's really crucial. And as I said before, it drives asset classes because corporate earnings are based on the economy. If the economy is doing well, corporates earn more. Right now, for example, corporate earnings are negative in the US, and that's because the business cycle has been particularly weak. And it may be a forecast that the business cycle will get weaker, for example.
So, what are some of the things which should be taught in economics classes at universities, but as of right now aren't? Like, how would you change that?
Well, I was speaking at Cambridge University in the UK the other day, and I explained to them that I could make them an expert on forecasting economies in 10 minutes. And they're like, well, how can that be? How's that possible? And I showed them the chart of the business cycle, exactly as I'm talking about, and said, once you understand that economies rise and fall in a obvious cycle, you know that you can never do what economists do, which is always forecast economic growth going forwards. So that's when nobody forecasts recessions. So if you're building a business, forget trading financial markets, you're building a business and you never forecast a recession, well, then when a recession does come, it'll be a surprise to you, and you'll have made bad investment decisions or bad decisions for your overall business. So to teach people to understand that economies rise and fall and they trend is a crucial thing that people don't know. And I can then teach people how to forecast when the next recession will be, or when the next boom will be, and to understand, therefore, that you could then forecast what asset prices do. And I think that's a really crucial thing. I think also people need to be taught at university how to use common sense. If you say to somebody, if you take away from studying economics and study personal finances instead, and say, okay, imagine you're the most indebted guy and you really have huge amounts of debts, you're struggling to pay them, and somebody says, what you need to do is borrow more money. You might do that once or twice, but then you realize you've got even more debt to pay off and you're never going to pay it off. And after a while, even if somebody offers you debt, you won't take it. That kind of common sense is not in economics. It's not, it's not in the economic models. They don't really realize that happens and don't know how to deal with it. So many of the economic problems, as I said earlier, have come from not understanding that the world works in a different way. The world is based on human emotion and human decision making, and not a model based around perfect competition.
Right. So with that being said, is there anything that scares you or should be concerning for most people about the current state of economics?
Economics or the economy?
Economy, yeah.
The economy, yeah. I mean, the world is the most indebted it's been as a percentage of global GDP in all of economic history. The US is the most indebted economy as a percentage of the world economy of any economy in history. We have crazy experiments where we're seeing interest rates, which none of the finance industry ever thought was possible, where governments are getting paid to borrow money. Makes no sense. Companies are being paid to borrow money as opposed to having to pay to borrow money. You have huge amounts of debt that's causing deflation, driven by demographics, that's creating a problem that's so big people don't know and central banks don't know how to deal with it. It's crushing economic growth and it's crushing inflation, and which makes the debt burden rise. Now, the issue is how do we end up getting out of it? And usually, anytime we've had anything similar in the past, and remember, this is the biggest order of magnitude of this kind of event we've ever had before, is usually you end up with a huge loss being taken by somebody. And in this case, it's usually the savers. And that comes from either a default where somebody doesn't pay you back for the debts that they owe you, or it's from inflation, and particularly in such extreme financial conditions, more extreme inflation, or it's through a currency devaluation to take away your purchasing power of other people's goods. And one of those three things is the likely outcome. And Rogoff and Reinhardt, who wrote the book about This Time is Different, about the current debt crisis and how it is not different from last time, that any other debt crisis tends to end in these three outcomes, is absolutely right. And that's concerning many of the people. I mean, my business now is I also own a television company, the world's first video-on-demand platform for finance, which is kind of the Netflix of finance, called Real Vision TV. And we interview probably the most famous and best investors, economists, strategists in the world, and give people access to these incredible minds. And what's amazing is the amount of people coming on and saying, this is out of control. What central banks are trying to do by printing more money to try and control too much debt is a really dangerous economic outcome. And we don't know how they're ever going to get out of this. With interest rates at zero and people borrowing at near zero interest rates, how can you ever raise interest rates again without bankrupting everybody? And therefore, what happens if inflation comes? It's a really complicated and pretty grim world in that respect.
Yeah, no doubt. So can we just pull that apart a little more? What's, there's been a bit of talk about this lately, negative interest rates. What are negative interest rates and what's the actual effect of such a thing?
Well, if you think about normally in the old world of the last 2,000 years longer, if you would go and put money in a bank, you get paid interest because you are essentially lending the bank money and they would pay you a rate of interest. So in some countries right now, you could probably get 5% interest. There's very few left because interest rates have been falling and falling and falling. But then the weird world happened that negative interest rates have happened where central banks have said, you know what, we're going to charge people to lend the bank money. I put money in a savings account in a bank. So in some countries now, you're losing 1% a year by paying somebody to keep your money in the bank. And the idea is to try and force you to not save money, which is crazy because, everybody wants to save for retirement or save for a wedding or save for college or whatever it may be. But now you're being penalized to do so because they're trying to get you to spend money to get the economy going. But what it is a terrible way of taking your money away from you over time. And that's negative interest rates.
Okay, so what countries right now, as we're recording this, actually have negative interest rates? Is that taking place anywhere?
Yeah, so I'm looking down through bond markets and not even official rates, and we've got negative rates in Germany right now, negative rates in Spain right now, negative rates in Italy right now. In fact, most across all of Europe, all of Japan, Sweden, Denmark. So there's negative rates in many, many countries. Switzerland having the most negative rates right now. So if you hold your money on deposit in Swiss 2-year bonds, if you buy 2-year bonds, you're lending to the Swiss government for 2 years, you get charged 1% roughly to lend to the Swiss government, which is an incredibly weird situation. It's the complete reverse of anything that everybody's ever learned about finance.
It's very bizarre. So you would be best to just sort of take your money out of the bank in that situation and tuck it under your pillow. Is that right?
Well, exactly right. But what's interesting is what happened in Switzerland recently. One of the big pension funds, saw what was happening to negative rates and said, well, what we want to do is go to the bank and take our cash out and put it in the safe in the bank. So they went to the bank and said, can we have our cash? And the bank said, no. They said, what do you mean? It's our cash. They said, yes, it is your cash, but we can choose how to pay you. And we refuse to pay you in cash. So we can send you a wire transfer if you want to send it somewhere else. And that was a really concerning thing because it was setting the precedent to show that that negative interest rates are a form of financial repression or indirect taxation, where they can basically suddenly tomorrow turn around and say, well, interest rate's going to be negative 10% tomorrow. And what happens is there's nothing you can do about it except leave that currency and put your money in a different country, which is why currencies have been moving around a lot recently as countries have tried to lower interest rates and force money into their financial systems. They've actually ended up forcing money outside of their financial system and elsewhere.
Yeah, I mean, that's very concerning. So, I mean, how far could negative interest rates go?
Well, considering they'd only been done once before, which was in Switzerland in the 70s or 80s, we don't know. I mean, nobody believed this could happen. And we're now at 1% in Switzerland, and who knows? It could be 5%, it could be 10%. We have no idea. What does that mean for savers? I mean, it's a terrifying situation. What does it mean for baby boomer retirees? It's a terrifying situation. What does it mean for you with a mortgage? Well, it probably means you don't pay any money on your mortgage, really, which is kind of weird. Or will they find another way of getting back that money? We don't know. It's the big financial experiment. So going back to what concerns me about global economics right now and the global economy is we're in the middle of the biggest financial experiment the world has ever seen. And we just don't know the outcome. So we can all pretend we're smart and know. We don't know because this has never happened before. So there's very few parallels to draw on.
Yeah, so what does happen if you owe the bank money? We've talked a little bit about if you have savings with the bank and there's negative interest rates. What happens if you actually owe the bank money, like you have a home loan or you've got, credit card debt or something like that?
Well, in Germany, we've seen some banks offering to pay people to take out a loan, which is quite bizarre. Now, that's only a short-term thing, and it's based around incentives, much like zero interest loans on cars. But we don't know. It's possible that as a borrower, you could actually get paid to have your debt. Maybe you can't borrow more debt at that price, but maybe your mortgage, if it's set to some particular base rate that's gone negative, that your mortgage will go negative, which is why the banks have been not trading very well recently, because people realize that for a bank, this becomes a very complicated world in which to make money because nobody understands what the outcomes are or what the knock-on effects are.
Okay. Wow. Scary times ahead, eh? So,
yeah.
So in 2012, you did a presentation that was quite a hit online. It was called The End Game, and I know Zero Hedge actually called it the scariest presentation ever. What's changed since 2012, and do you still think something like this, like a big crisis, is still on the way?
So what happened in 2012? I mean, some people said, you were dead wrong, Raoul. And yeah, I was wrong, but I wasn't trying to say that nothing I do is about certainties. It's all about probabilities. And what was happening before I wrote that article called The End Game is I was one of the few people to say, listen, Europe is on the very brink of default. And that was what that was, is that article was about, listen, if Europe starts defaulting, if one of these countries goes, then the knock-on effects of all of these other indebted countries could be massive. And we have to be really, really vigilant right now because things are getting dangerous. That was a probabilistic outcome. Now, what happened eventually, the banking system almost did go bust. The ECB had to step in, do whatever it takes. And we had to do, they had to force Spain to take a $30 billion bailout of its banks because the banks would have gone. Now, that's incredible that the entire Spanish system would have gone under if only 30 billion had not been taken by the banks at that time. So we got very close to the edge. That situation has not gone away. So the European economies are massively indebted. The European banks are hugely indebted. The Japanese, massively indebted. The Chinese, enormously indebted. The UK, incredibly indebted. South Koreans, massively indebted. So all of these bits of kindling are still there, and you just don't know where the spark is. Is the spark going to come this year? Is it going to come next year? Is it going to go in 5 years' time? I don't know. But I know that, again, if I look at risk-reward, I see a very large outside risk of a catastrophic event. So therefore, that's going to bias how I view markets right now because it makes me concerned by certain risk rewards. There are other markets that are not involved in this at all, with low debts and excellent demographics, and those are the markets I'd rather be involved in.
Okay, so either way, you feel as though that there is, quite a serious financial crisis looming.
Yes.
Okay, and we're just not sure when that's going to be.
That's right. I mean, there is an outcome, which is to muddle through for decades, which is basically what Japan has done. But Japan had the benefit of other nations growing. Right now, we're in a situation where very few countries are growing strongly, and certainly nobody has enough firepower to hold up the world should somebody have a really big problem. So, my radar screen is up right now because all of the business cycles are starting to trend lower. I'm concerned that we could be heading towards a recession. I'm concerned that none of the debt issues have been resolved. So there's several signals out there that make me, sit up and pay attention.
Sure. Okay. Well, I mean, this has been very interesting. It's definitely been an eye-opener for myself. I mean, this is something I'm probably a little bit in the dark about to a certain extent. But this has been really fun. Royal, why don't you tell us a little bit about Real Vision TV and why you started this?
Yeah, I mean, for many of the things we talked about is back in 2008, I had been writing about the global economy as one of the people who forecast what had happened, what was going to happen, back from 2006, 2007. And what happened by 2008, people came up to me and said, well, why didn't we know about this? And this was more normal people, the average investor. Why didn't we know? And the answer was the media had let them down and the banks had let them down. They didn't want to say the truth. They didn't want to say, this is a risky time. There were not good things going on. People are borrowing too much money. There's a risk. The markets have run too far. And people, the financial industry didn't want to do it because it has an inherent bias within it to keep things running as they are. Once you understand there's a business cycle, you understand that things don't always remain as they are, so don't lie to people. So I realized that, I probably had a moral duty. I hadn't been doing this. I've done this for 26 years or so now. That's to give people better access to information, that they don't have to pay for a ridiculously expensive research service like Global Macro Investor, my other business, that there must be a better way. And we realized the best way of communicating with the largest number of people at the cheapest possible price was television, or in fact, to be more correct, video on demand. So we decided crazily to start a media business from scratch, knowing nothing about media. We built this beautiful video player and this whole platform. Then we went out and spoke to some of the best investors, some people have never heard of, and other ones household names, some of the biggest hedge funds in the world, biggest pension funds in the world, some of the best technical traders, the best economists, analysts, strategists. And we said, right, guys, this is our mission. We really want truth in finance. We don't have a bias. We want you to tell us what you think about the world in long format. We'll give you plenty of time to explain yourselves. And you just tell us how you think the world is, or what opportunities are out there, or what risks are out there. And we'll let our audience decide. We won't treat them as sheep, or, we want to treat people with integrity and intelligence. And everybody came on board and said, this is a fantastic idea. We'd love to do it. And so we launched it about a year and a half ago, and it's been a phenomenal success. People have just been completely enamored by the ability to have access. The average guy on the street, the average trader who trades from home, or the average guy advising clients suddenly gets access for an hour to pick the brains of the greatest hedge fund managers alive. I mean, it's priceless. They'd never get this kind of access before. And that's what we've done. And I think it's really empowering for people, and it helps people make better investment decisions and really understand what's going on in the world. So it's been a really exciting journey.
Yeah, no, you've done a really nice job of it. And especially because it is, that long format. It's not just like a 3-minute segment on, Fox News or CNBC or something like that.
I mean, trust me, I appear on CNBC quite frequently in the US, and it is a terrible experience because I'm on it for 2 minutes, three and a half minutes. You can't explain anything. So nobody actually gets to learn anything. Everything gets dumbed down to a soundbite. And much like, with your podcast, what you really want to do is drill down into people and understand how they think and why they think, and, what made them have those decisions and that kind of thing. And I think that's really adds true value.
Absolutely. Absolutely. No, I totally agree. So, I mean, Raoul, is there anything you'd like to add before we sort of close this out?
No, I think I've hopefully I haven't scared people too much. Hopefully I've taught them a bit about the business cycle. I mean, there's Real Vision, it's a very inexpensive service, and you can go and have a free trial. And there's a lot of videos on there. I'm about to do a whole video on the business cycle. So if anybody's interested in that, I really urge them to have a look at that and any of the other content of that kind of thing, because I think, educating yourself is the best thing you can do.
No doubt, no doubt. So what are some, good resources for learning more about, economics and the economy and some of the topics you've discussed here? Like, are there any books? Obviously, Real Vision TV is a good one, but are there any books or, any websites or blogs that you follow religiously, or, anything you can suggest that listeners check out?
You see, it's really difficult because there is nothing that does what I do. The business cycle analysis, there was some business cycle analysis from the Austrian School of Economics in the early 1900s. There's not been much updated textbooks on it, so there's not much about the business cycle. So that's a matter of process of learning yourself and just experiencing things. I tend to find that learning from traders, and one of the reasons Real Vision was inherently appealing to me, is the books like Market Wizards and New Market Wizards. Jack Schwager, who wrote those books, and he's been actually on Real Vision as well. But he dug down into some of the greatest minds in the trading world. Those kind of books are really helpful. History books, stuff like Manias, Panics, and Crashes by Kindleberger is a fantastic understanding of the cycle, of the investment cycle, of a mania, a panic, and a crash. That's really useful. There's a brilliant book by Liaquat Ahmet called The Lords of Finance, written about the Great Depression and what happened with currencies, etc. at that period of time. That's a great learning resource. I tend to look at websites like, I enjoy Zero Hedge, even though I know it's a bearish bias. But what I find is there's an integrity to some of the information that they put on there that is not found elsewhere. So there's a wealth of information and it's free. I like to do that. I then subscribe to various services of people I'll pay for the opinion of, whether it's a technical analyst or a particular strategist that I think adds value to me. And then it's learning how to read financial headlines and read anything and apply it to an economic principle. It's understanding how knock-on effects work. And that just takes time. You need to understand when you read a headline, it might not be the obvious thing that you get out of it. And that's a whole big different topic that we could talk about another day. But, I urge people to read broadly and try and think along themes. Technical analysis, I would start with John Murphy's technical analysis of financial markets. I find that pretty invaluable as well. And then there's a couple of books about DMARC, which is some technical signals that I use as well, that I find pretty useful as well. And also, I'd go to any of the books written by George Soros, like Soros on Soros or The Crisis of Global Capitalism. And that'll give you a great idea into the mind of one of the greatest investors the world's ever seen. Okay. Hopefully that helps.
Yeah, no doubt. So I'll put a link to some of those resources you just mentioned there in the show notes at chatwithtraders.com. So, Ruel, where is the best place listeners can find out more about you?
Two places. Again, there's a bio and more about me on realvisiontv.com, where there's also the free trial for Real Vision, or if they want to find some more about my Global Macro Investor research service, that's globalmacroinvestor.com.
Okay, and your Twitter handle is?
Raoul GMI. So RAOUL GMI is my Twitter handle. And I'm very active on Twitter, and I engage with people as well. So I'm happy to talk markets, talk ideas, or elucidate some of my thinking.
Good stuff. All right, Raoul. Well, let's call this a wrap. And once again, thank you very much for doing this, man. I really do appreciate it. I've enjoyed it.
Thanks very much for inviting me.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, longer